Professor of theoretical mathematics. No. We all know this equation, right? Or you could use Workday to better decisions faster. For solve problems like a genius world. Workday for a changing world. I think the officials I think the message, and that's why we got the press conference today, a bit of softening in the tone. So I think the overall direction is still gradually easing that very strict COVID-0 strategy. So it is a great thing, but it's going to be done in a two-step forward, one-step back kind of process. It's never going to be easy, and the market will be very, very sensitive to the developments. But overall, I think it's a positive trend.
So, Janet, overall, what does it mean for China's contribution to the world economy? Are you also expecting less lockdowns going forward, or how does that develop?
Yeah, I think if the current situation stands, we do expect that the lockdowns will be more infrequent because there's a macro and the top-down guidance of gradually easing policies, and I think the regional officials also get that. So we expect more measures, more activity going forward from the consumer side of things. Services side has been absolutely hampered by the zero COVID strategy, so it would be very positive domestically. And from a global perspective, there has been a lot of concerns on the ongoing disruption to global supply chains. I think that would alleviate that concern, and that would help to further dampen that global goods inflation story.
And so, Jen, overall, does it directly impact, energy in the immediate terms, or is it oil and energy prices, or is it just supply chains that we need to look at?
Yeah, I think so. We have seen oil prices slumping basically in the past months or so, and I think a big part of that is due to China still not reopening. But I think if there is more concrete evidence that China is going back to its normal, it will be very positive for the commodity sector, especially energy and also gas. We've both seen prices slumping quite a lot. So it will be short-term positive, but longer-term factors, of course, that still depends on the Russian side of things, the OPEC supply side of things. But yeah, it will be positive for the oil and gas.
So, Jen, overall, are we reaching peak inflation? I know there's you can see peak inflation, but core inflation being very, very sticky. And is this the point where finally the market realizes what Fed officials have been trying to say, that maybe they'll ease off, but the trend is definitely higher interest rates?
Yeah, we do think that we are seeing peak inflation. We are seeing that in the US in terms of the headline. The core is still very sticky, but eventually that would also turn because of the slowing housing market. First of all, that will have a more significant impact on demand, general demand next year. We're not seeing that yet, but next year probably more noticeably. And
that's not exactly the message we're hearing from central banks.
No, I think that's the biggest question, Francine, for next year. There is a view that we've passed peak inflation, certainly maybe in food prices and in certain commodity prices. Obviously, the European energy crisis is a standout from that, though. But the big question is less about has inflation peaked, where does inflation come back to? Does it plateau at a high level, or does it come back to somewhere that the central banks are comfortable with, somewhere near those mandate targets that they all have to observe? That's probably one of the biggest questions, and that, by extension, will dictate where, of course, interest rates go and where people's mortgages will go next year. And that, of course,
To adapt in a fast-changing world, you could hire a professional fit crew. They deliver real-time data to help you stay ahead of the curve. Or you could use Workday to make better decisions faster. Or accelerate your decision-making world. Workday for a changing world. suing the FTX founder, Sam Bankman-Fried. Now joining us now is Ana Herrera, our senior crypto editor. Ana, I mean, first of all, it feels like every day, every week, maybe not every day, but every week, there's something going wrong with a part of someone that had exposure to a crypto market. So what's happening with BlockFi?
So BlockFi wasn't doing well already because they were exposed to the fall in prices, obviously, because they're a lender. They were bailed out by FTX, and we know that now FTX needed a bailout, and they've gone bankrupt. So obviously they're exposed to FTX, and that's sort of what drove them to their bankruptcy. And clearly, obviously, they're probably not the last because they had their own counterparties, and we've not been able to see from sort of their filing who their major counterparties are. I think we saw the SEC creditors. We saw the SEC is one of their major creditors, which is funny, and I guess in a way, but still there might be more dominoes to fall when we figure out who the other counterparties and creditors might be.
So what's the market reaction? You're right. This is like an ecosystem, right? So it's lenders. They're all intertwined. How difficult is it to find out who's next?
Yeah, you'd think that it'd be easier because of blockchain, blockchain transparency, everything is there. But really, like a lot of these exchanges and centralized institutions are sort of like black holes. You don't really see what's going on. So it's hard until, you actually see the creditors list to figure out who was exposed, or if they come out and say some firms have said we were exposed. But obviously, like it tends to be the ones where maybe the exposure isn't completely too big, or where they want to minimize contagion. We don't know really if keeping the names not open is actually helpful or not, because in a way it might slow down. People might be thinking, who do I trust now? And so that might be stalling things.
So are you expecting more pain until? And I don't know how long that pain lasts until we find out who the last domino is.
Yeah, we don't really know. This has really started earlier on this year, so it's actually continuing since May. We had a bit of a lull in pain, but it's back now. We were watching Genesis last week. They were raising money, and they said if we don't raise money, we might file. So obviously we're trying to figure out and trying to wait and see if they've raised money or if they're going to file as well.
Right, Anna, thanks so much. Ana Herrera, they're our senior crypto editor. Now, from crypto to Twitter, Elon Musk has tweeted that Apple has mostly stopped advertising on Twitter. A few minutes later, the Twitter chief claimed Apple might boot Twitter from its App Store. Now, for more, we're joined by Bloomberg's Giles Turner. I mean, so much drama in Twitter sphere. And what is this? Is Elon Musk just baiting and picking fights?
I get this feeling that he's come into the office and realised that Apple gets a 30% commission for all the money that he possibly make via the App Store, because the real problem is Twitter needs to make money, right? Yeah. He's bought this for a huge amount of money. It doesn't make a huge amount of profit, if any. He wants to charge $8 for every user to use Twitter, and Apple's going to get 30% if he ends up managing to charge people, $8. So he's realised this and thought, I need to take them on. But all this has been done before. Epic Games has had a huge fight with Apple, went to law courts. This is the time in 2019. This is the company that made Fortnite. Every kid was playing that game, on their mobile, and they lost, right? And so let's see if Elon Musk, is he going to go to the courts again, or is he going to try and bully Apple? It's very hard to bully the biggest company in the world, so it's going to be a fascinating fight.
I mean, is Apple also a huge advertiser on Twitter? So does it impact revenue on that front?
Yeah, Apple's one of the biggest advertisers on Twitter. I think it's a huge amount. They do advertise. Most of Twitter's revenue comes from advertising as well. I think it's about 4.1 billion last year. Apple, we saw in the Twitter fight, Apple's pulling back from advertising. So is everyone else, right? They're not the only one. So this is a huge problem for them.
So does Elon Musk have any leverage?
I think he has some. It helps owning Twitter, for example, the place that most people like to pick a fight. But also, Apple doesn't advertise on Facebook, for example. Apple's got an amazing advertising machine, but it didn't really focus on Twitter. And so, pulling back from that, I'm sure they'll find ways of selling their goods. They don't have a problem with that. But still, it's not a great fight to pick.
Giles, overall, I watch Twitter all the time, and it's really Elon Musk tweeting 24/7. Is this working? Is it too early to say whether people are leaving the platform or coming back to the platform? It's unclear exactly what's happening right now.
Well, he says it's going great, but I guess he would say that. But I think with this particular fight, this is a really good fight for him to pick, because lawmakers both in Europe and the US don't like Apple charging 30%. It's a gatekeeper. They think it should be fairer. This is a fight that he could potentially win, because he's got a lot of, especially Republican lawmakers, on his side with this. And you can see him doing plenty of lobbying in the politics sphere with the upcoming US election. So maybe this is all part of that, and maybe this is the fight he could potentially win, or at least bring down that 30% figure.
He would have known this before, right? That they charge 30% because of the Epic fight?
I don't know. I can say sometimes I get the feeling he comes every morning, learns a new thing, and then says it on Twitter. So I can't say.
All right, Giles, thank you so much, as always, for your insight. Giles Turner there from our media and tech team. Now, the other thing we're watching is European football. Yes, this is Juventus plunged into crisis this morning after the chairman, but also the entire board resigned amid a probe into alleged wrongdoing related to the company's last 3 financial findings. Also coming up, Paul Mashatile, tipped to be the next deputy leader of South Africa's governing African National Congress. He already holds 3 of the party's top positions. We'll get his views on reviving the economy. This is Bloomberg.
Great food straight to your door. Download the Deliveroo app now.
At Standard Chartered, we believe that no matter how you start in life, every young person has the right to reach their full potential. We're Standard Chartered, and we're here for good.
Inflation's been stubborner than I would like. And I don't start with the idea of a rate path. I start with the idea of getting control over inflation. And as long as inflation stays elevated, it just makes the case to me we need to do more.
Further tightening monetary policy should help restore balance between demand and supply and bring inflation back to 2% over the next few years.
They will come down, I think. That's my baseline, but they probably won't come down quite as fast as markets would like.
It will take some time, but I'm fully confident that we'll return to a sustained period of price stability.
Very supportive of a path that is slower, probably longer, and potentially higher than where we were.
Only recently moved into restrictive territory, and we're going to have to move farther in order to keep inflation under control. I think we probably have to stay there all during 2023 and into 2024.
Well, Fed officials, they're stressing with that they will raise borrowing costs further to curb inflation. Now let's get straight to the Bloomberg. First word news, here's Laura Wright. Hi, Laura.
Hi, Francine. China says it's going to ramp up COVID vaccinations for senior citizens, a move regarded by health experts as crucial to removing tough COVID zero curbs. But Beijing stopped short of announcing mandates for compulsory jabs. Last night saw a heavy police presence deployed in major cities, which prevented a repeat of the weekend's protests over anti-COVID measures. Christine Lagarde said she would be surprised if Eurozone inflation had peaked. The ECB president's comments suggest the central bank's recent ramp-up in interest rates is not close to being over. Speaking to lawmakers in Brussels, she also warned growth will continue weakening into next year. UK Prime Minister Rishi Sunak says the so-called golden era of British relations with China is over. In his first major policy speech, Sunak said Beijing cannot simply be ignored, especially on issues such as global economic stability or climate change. He says the UK will work with allies to manage what he called sharpening competition with China. Hawaii's Mauna Loa, the largest active volcano on Earth, has erupted for the first time in nearly 4 decades. Local officials opened emergency shelters after the volcano began erupting late Sunday, blanketing the sky with ash. Officials have not issued evacuation orders and air traffic remains unaffected. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Laura, thanks so much, Laura Wright in London. Now, let's also look at what Juventus is doing. The share price for Juventus dropping after the chairman, Andrea Agnelli, and the entire board has resigned. Now, this is a pretty dramatic exit. It follows an investigation by the public prosecutor's office in Turin and Consob into these market regulator into some of the football club's recent financial balance sheets regarding alleged false accounting and market manipulation, something that the club has denied. They have denied any wrongdoing. Just a reminder, Juventus currently ranked third behind Napoli and AC Milan in Italy's top football league, that's Serie A. In the meantime, this is what the markets are doing, a bit of a lift-off for these European stocks. They opened higher. Nationwide unrest in China over COVID curves seem to be easing, and that's boosting sentiment for riskier assets. Coming up, we go live to the World Travel and Tourism Council Summit in Riyadh to discuss post-COVID travel trends and expansion plans with Accor's chairman and chief executive. This is Bloomberg.
I joined Gigable to earn some extra cash, basically. You get to be your own boss. Who would want that?
Future Makers by Standard Chartered has supported more than 650,000 young people from low-income communities in the last 3 years, empowering them to learn, earn, and grow. We're Standard Chartered, and we're here.
Right, guys, so there's some people in here, so I guess we can go through a market update. Bear with me. So yeah, we've uploaded a full market update on our TradingView account, so go and check that out. Nonetheless, we'll go through one here. Now, this is so we'll go through a market update in the stream, and then yeah, just it's a live trading session as well. So we've got some trades open currently. As you can see, there is a Litecoin trade that we are giving you guys just for being in the stream. Now we'll go through the TA on that as well. But yeah, so it's looking like we're going to get a bear market rally now. Obviously, the markets are running on better CPI data from the previous month. Okay, so that's what they're holding to. Okay, so obviously Wednesday and Friday we get US labor market data, which is looking likely to come in weaker. So if that is the case, then again it's pushing towards a narrative of bear market rally. so just obviously bear that in mind. The way that we're basically trading this market is so with our perspective. So in terms of the current price action, we're going to be trading it long, so buying long trades. But as the market makes a new high, we'll basically average it into our long-term short positions. Okay, so our long-term perspective is for the market to come down. Obviously, we've got this 12 to 10k area that everyone's talking about now, and that's got a lot of strength. However, there is a target beneath that. Well, a target or two beneath that. So I guess it's to push up higher. So yeah, we just need to bear that in mind. Now, again, we are looking for a push up in crypto prices, especially after the price action that we got last couple of days. So I guess we'll see what's happening over the next few days in the market. Just give me 2 seconds. Geography, financial resources, and expertise and access to brands. So what's happening here probably never happened in the world for the last 20 years. So we just want to be a participant, but you know who I am. I hate to be a spectator, so I want to be an actor of my own life. So I just want to participate, collaborate, and be useful. But I will. Now, in the market update that we sent out today, we also discuss the equities markets, right? And they are starting to set tops and starting to turn over at current time. So hopefully they can stick to that and they can kind of hold those levels or those current levels that we're at. Now, if they start to push up higher, then we'll kind of have to gauge as to whether they're breaking that bearish structure. If that's the case, then probably going to see a bit more of a sustained push up in prices moving into the month of December as we get our CPI reading and our Fed interest rate decision. Okay. Ultimately, the Fed's interest rate decision is the most important, but closely followed by CPI, which again we get. I think it's like a week or two before that interest rate decision. Now, once we get the non-farm payrolls data coming out on Friday, the markets will look ahead toward that CPI, and then the interest rate decision. So. Yeah, if we get another weaker CPI reading in December, again, probably looking at prices pushing up higher. Okay, until probably looking at pushing towards next year, where we could see a very sharp and quick push down in prices. Now, the decline in crypto's valuation recently has obviously come off the back end of the FTX situation, and then kind of the companies that are in collateral to it. So it will also kind of depend on how things develop on that side. Are there going to be any more companies that are going to file for bankruptcy? So the latest one was BlockFi. So again, something that we'll have to keep a close eye on as things advance. But again, in hindsight, Accor has a huge procurement activity. We do 5 billion of buying. We've been buying energy for 60% of the network up to 2024. So they will not see any energy inflation because of what we've been basically pre-buying a year and a half ago.
Seb, you're going through a reorganization internally. I'm wondering to what extent there's room for further job cuts as part of the reorganization, given the reality that you're seeing in the economy. No?
Sorry, bear with us, guys.
40,000 people within my 280,000 people organization.
So don't even think about a job cut. I need people back at Accor. That reorganization is only trying to have better expertise, more focus in the right segment. So we're splitting Accor in two autonomous divisions. Accor mid-scale premium and one on luxury lifestyle. It happens to be different segment, different owners, different clients. And I was dumb not to have done it earlier. Probably did not do it because I didn't have the skill, ability to do it, but it's indispensable.
What else have we got to go through?
The sense of ownership from my executive team is far better than I ever expected myself. It's going to work extremely well, but he will not be at any job expense.
Sebastian, always a fan of our conversations, very candid discussions. Thanks again for your time. That's Sebastian Bazin, the CEO and Chairman of Accor, joining us here at the WTTC in Riyadh.
Youssef, thanks so much. Youssef Gamal-Din at the World Travel and Tourism Global Summit in Riyadh, there with the Accor Chief Executive. Now, coming up, we speak to the man to be the next deputy leader of South Africa's governing African National Congress. Paul Mashteel joins us next after the break. This is Bloomberg.
We are facing a perfect storm of uncertainty. But with over 225 years of experience, we know there's only one way through: forward. An unstoppable sustainability transition is already transforming.
Let's go and touch on Litecoin, right? You're right. So Litecoin, guys, we did put out an update not too long ago on Litecoin, on its kind of price action, very bullish price action, lots of volume. It's kind of set its cycle. Okay, so we kind of got a whole load of nothing happening, especially in the last bull run for Litecoin. So majority of that bull run, Litecoin was very stagnant. Then pushed up heavy, but it's kind of come out and raring to go now. As you can see, huge amounts of buy side volume. Yeah, huge amounts. So prior to this break, this was the structure that we put out on that market update. Obviously, we got that push straight back out as it came and tested the bottom of that structure, that order block, and straight push straight up. How much did it go up by? Bottom to top, 40%, huge. So next target. So obviously we placed a signal on that other on the other chart. So we've got the 1618 is very top, so it could very much push that high due to the amount of volume that you see and the amount of institutional buy side action that we're seeing here. So it could very much be the case that we could reach there. However, we're going to the top of this or at the very beginning of this order block here, so we're going for a target at $95 as our very last take profit. But the most likely is 87, so you can be quite comfortable at 87 once we break the structure here. However, again, with the amount of buy side action that we're seeing here, it could very easily spike all the way up towards 95 and even past it. It's very likely. The amount of buy side action is, I mean, you're not seeing it in many other places. So yeah, something to look at. And also, I do apologize. I mean, yeah, the internet this morning is being very slow. I mean, we've tried to do live streams in the past, and it's the same thing. It's simply the case that we're just in an area, kind of just basically in the middle of nowhere, so we just naturally don't get very good Wi-Fi infrastructure here. But it's something that's, I mean, we've been I've been having issues with Wi-Fi companies and broadband companies, and we've done about 20 different switches. It's always the same thing. So, I mean, yeah, we'll try and continue trying to resolve the issue with the connection. But yeah, it's just going to have to do right now. I mean, as long as you're seeing the signal on the screen, that's all that you need to see, really. In terms of Bitcoin, technically you've got two signals here, right? Now you've got take profit 1, 2, 3. It could push up, but this is where there's a decent amount of resistance. So yeah, and it kind of breaks through the structure. So I'm going to see if I can fix this. So just bear with me. Yeah, so I'm going to see if we can get this connection sorted. We're just going to try and move the booster in a suitable location that works better for us. So yeah. What else have we got? See what's happening. So see, the dollar index is really trying to set some levels. In terms of so even in the update that we said that we put out today and yesterday, we're expecting this price, the price action of the dollar just to literally move within a range and fluctuate before making a decision on the direction. Now, again, if we start getting the data to come out in terms of weaker labor market data, we could potentially breach that 200 moving average. And if we do breach this, then it's breaking through this kind of long-term bullish structure that we've been in for a very, very long time. We've had a very, very large dip, a continuation back down to the downside after the better than expected CPI. So yeah, if we break through this level here, then I guess, I mean, we're definitely getting a bear market rally if that's the case. And then once it kind of finds its bottom, wherever it may be, maybe at these moving averages, maybe at this order block or this one even here, we should see a nice spike back up, right? So if we get that spike up, that's when we'll topple over quite quickly on the risk on asset markets, and then probably start looking at the bottom being set in then. But yeah, we're at a very key pivotal point here. So we do need to just bear that in mind and keep a very, very close eye on on the dollar index and what it does next. Because if we do break this low here, that 200 moving average on the daily, that's starting to move towards a more bearish outlook on the markets. But yeah, guys, I mean, feel free, ask us anything. Just do your thing. We're more than happy to go through some alts with you. Whatever suitable, really. We'll leave it on this one, yeah. So at least you guys got some targets to look at. Right, okay, so the connection should be much better now, hopefully. Right, we can get this back on, up and running. Beautiful, beautiful, beautiful. Right. Well, yeah, that up.
Women continue to be globally underrepresented in fields such as science, technology, engineering, and math. This reality inspired a series of initiatives designed to accelerate women's professional development within our operations. Discover how Aramco female researchers have been granted 352 US patents and counting. Aramco, powered by how?
Thing here. S&P futures up about 0.2%. So Anna, you're right. We have faded the gains that we saw earlier on hopes of China reopening, at least sooner than previously had been thought, but still looking at gains. And I think that's because we are losing the headwind of a strong dollar. In fact, a lot of people, JP Morgan is one of the banks out there saying maybe the dollar run is over here and we could start seeing new lows. That's why we see gains in European currencies. We saw that yesterday as well as today. NYMEX crude is up 2% right now, but only to 78.84 a barrel. So a little bit of gain after the drop that we saw yesterday morning or Sunday night. We were looking at a 73 handle. So it's actually a pretty big jump from there. And then Bitcoin right now about 2% as well. Still holding around 16,000 and a half right now, 16,517. So not a heck of a lot of movement there. What do you see in terms of the European fade today, Anna?
Yeah, so we were looking at gains, Matt, across the European map of around 0.5% for some of the major markets, but those have faded, certainly in France and in Germany. The German market now is down by around 0.1%. Including gain in London, and London is up by 0.6%. You'll see that is really to do with energy and energy markets.
Raphael, sorry, what do you mean by what market?
Those particular stories we have Brent crude.
Let me know in the comments what you mean by what market.
So whilst we've overall seem to have shaken off some of the enthusiasm around the China reopening story, more on that in a moment, it does seem as if certain sectors are clinging to that theme, and energy markets is one of those. 85.15 on Brent, lost substantial ground yesterday as a result of concerns around China protests, now gaining this morning on expectations that perhaps there'll be some further reopening of the Chinese economy, and that is positive for crude. Basic resource stocks also helping out the London market, then up by 2% this morning. And here's the Italian 5-year yield. We've got yields coming down across Europe, and this is across the Eurozone. This seems to be quite a convincing move in today's session, particularly at the end of the curve. It was Italian data we got today. It was Spanish data. We just got one building block of the Eurozone picture.
Right, bear with me. I need to sort this Wi-Fi out. I'll leave the stream running. Raphael, if you let me know what market you mean, then I can answer your question, but just give me 2 seconds.
G20, this is where we're seeing the biggest, most unusual outside move in markets, but that's where we yield right now for Italian 5-year debt. And keeping it Italian, this is a football club, a soccer club based in Turin, in northern Italy, and the stock is down by just over 3%. The Juventus chairman and the whole of the board stepping down. Some controversy around the way the players have been valued in balance sheets. It seems that there's now an
Beautiful.
Creating lift in the opposite sense. We're pushing the tyres into the ground. The only bit that actually touches the ground are the tyres, so as much downforce as you can have is just key to going faster through those phases.
Aerodynamics is the prime performance differentiator on a Formula One car. So that's also why we dedicate a lot of resource, a lot of focus on aerodynamics.
We have seen quite a significant softening in tone from Chinese health authorities in
Just going
particular.
to see what's happening elsewhere.
Acknowledging in their own way, and at very least acknowledging there is a need to respond to what they've said is a reasonable request to tweak policy around COVID. Over the last few days, we've also continuously been hearing that
earlier saying that they'd reported a number of COVID cases and saying that 23 makeshift COVID hospitals are in use. Things are changing fast, it seems, in China. Rebecca John-Wilkins joining us there with the latest news on the COVID fight. Let us get to some news from the tech sector coming overnight. Billionaire Elon Musk is publicly attacking Apple in a battle that pits the owner of Twitter against one of the company's top advertisers. Musk says that Apple has cut its Twitter advertising and threatened to block the social network from its app store. For more, let's speak now to Bloomberg's Giles Turner, who joins me on set here in London. Good morning to you, Giles. So explain how we've got to this point.
Well, I mean, everyone loves a Twitter fight, first of all. I mean, we've got the world's richest...
when it involves Twitter.
Exactly. I mean, we've got the world's richest person against the world's biggest company, so, I think it's going to be pretty epic. We get to how epic in a bit. But really, this is about Twitter making money, right? They want to charge everyone $8 for using Twitter. If you're going to charge that money, then Apple's going to get 30% of that. So $2.04, I think. So... He doesn't want to have that because he needs to make money. Twitter hasn't made money for a long time. I mean, it makes plenty of revenue, but not much profit, right? Not hardly any. So he's got to solve this problem, and one way to do it is try and claw back some of that $2.04 for every user.
So, we keep asking this question ever since Elon Musk took over or really kicked off his bid. What kind of risks does it have to Twitter's ability to operate at all?
Well, I think even if it gets banned, for example, let's go for worst case scenario, you and me can still use Twitter. You won't get any new users, but everyone else can still use it. There also is a way around it. You can still, the revenue problem that is, you can still avoid, Twitter can still avoid paying that $2.04 to Apple if you download it from their website, for example. But really, I think it's a great opportunity for Musk to have a fight with the regulators on his side for once. We've been talking a lot about how he's had plenty of issues with regulators, especially around safety, because obviously he slashed the workforce by 50%. But regulators and lawmakers, both in Europe and the US, they really don't like the fact that Apple charges this 30%. It's a gatekeeper problem, and they don't really want it. They don't want it to happen. Now, they had a huge fight, Apple and Epic Games, the company behind Fortnite, back in 2019 that lasted for a few years, about this 30% problem, and Apple won. Right? Maybe not technically, but they still won. They can still charge 30%. Right? We might have this fight happen all over again, and maybe the result will be different.
Right. I mean, charging 30%, it should be said on the App Store that they invented to put an app on the phone that they also produce. So it's interesting to say the least. Giles, thanks so much for joining us. Bloomberg's Giles Turner talking to us about Twitter v. Apple. In other TMT news, Disney's returning CEO Bob Iger has told employees at a company town hall that he'll look into some of his predecessors' more controversial decisions. One of those is requiring reservations for guests attending theme parks. Iger also said he'll focus on profitability in streaming and shot down a rumor about a possible merger between Disney and Apple, calling it pure speculation.
All right, Matt, and Disney shares right now up about 0.4% in pre-market trading. So let's take a look at some stocks moving to a larger degree in pre-market here in the U.S., and a lot of them are in the energy sector. Of course, these stocks were under some of the most pressure in the selling of yesterday, but they are rebounding this morning as we see oil moving higher. Halliburton, ConocoPhillips, Occidental Petroleum, all up in the ballpark of 1.5 to 2.8%. Another group of stocks that is moving higher is the Chinese technology companies that have listings here in the U.S., really following on the rally we saw in the Asian session overnight. Alibaba, Baidu, JD.com, all higher to the tune of 5.6 and even 7.25% in the case of JD. One stock moving to the downside, though, is Roku. This is after an analyst at KeyBank cut his rating on the stock, saying that the consensus is too optimistic for both 2023 and 2024. And as a result, Roku shares down about 2.6% before the bell, Hannah. Okay, we'll keep an eye on that one. Coming up on the programme, we'll discuss the economic impact of the unrest in China and the policy response around COVID-19 that we've heard overnight from Chinese authorities. Diana Joy joins us, Inodo Economics chief economist. And on the markets, Sharon Bell, Goldman Sachs European equity strategist, joins us. What does she make of the latest inflation data out of Europe? A question we'll also put to Irene Tinagli, who is the chair of the European Parliament's Committee on Economic and Monetary Affairs. She was hearing this week from Christine Lagarde. What does she make of the testimony of the president of the ECB? We'll get to that conversation and talk crypto with her as well. This is Fleabag.
We challenge the investment status quo by challenging each other. Welcome to the power of independent thinking at scale.
Welcome to Wellington.
Wellington Management. Invest in unique perspectives.
By the way, guys, feel free to ask us anything if you want us to do. Kind of TA on anything, literally anything, even Forex if you want to do Forex, altcoins, commodities, anything, feel free, we can do it. More than happy to. We will, throughout this stream, kind of go over the market update as kind of new people join the stream. We've only just done kind of gone through the update of the market TA not too long ago, but I mean, if you're new to the stream, you obviously didn't hear it, just type into the chat. I'm more than happy to go over it again for you. That is not an issue at all. But yeah, in terms of outlook this week, it does look like we are going to push up higher on relatively low volume. Okay, but the majority of the price movements is going to come between Wednesday and Friday. Now, the market is going to uptick on the expectation of better kind of or weaker labour market data. Okay, remember that good news is bad news, bad news is good news in this market currently. So that's what the Fed wants to see. So yeah, that's what we are following now. Yeah, obviously we're coming off the back end of weaker CPI data last month. If we get weaker jobs data from the US, then put two and two together, that then pushes towards that CPI reading coming in lower again, which again is exactly what the Fed wants to see. And again, pushing towards that narrative of a Fed pivot, or a Fed pivot towards a dovish stance and a slower rate hiking cycle. And yeah, that's going to push the dollar's value down, risk on assets coming back online. So markets should see a bit of recovery, so we'll see what kind of happens on that end.
Chief economist at Inodo Economics. And Diana, yesterday it seemed as if the protests would only strengthen the resolve of the party to lock down the country in the face of COVID. Now it looks like they're offering a bit of an olive branch. How do you see it?
I see this as the most minute olive branch, really, and market optimism seems misplaced at this stage. The Chinese authorities' first reaction was to make sure that they ramp up their propaganda apparatus and clamp down on social media and the dissemination of information, but as well as that on the protest, as you said. And they seem to have the upper hand. In the system that China has, it's extremely difficult for these protests to gain momentum. The levels of control and the use of technology in achieving it are pretty extraordinary.
Diana, why is Xi Jinping so intent on this incredibly draconian COVID-0 policy rather than, using vaccines that work from the West or letting the disease run its course?
He's in a difficult position, really tight spot, and actually the protests are making his situation worse because he would have been much more willing to relax the zero COVID policy more substantially on the basis of the economy underperforming and really struggling. The problem he faces now is that these protests are linking the lockdowns with a more generalized pushback against increased authoritarianism in China, which really gains the very top rather than the local governments. She's actually facing an even worse dilemma of how to exit from the zero COVID strategy without losing face. And if you get Western vaccines or you change dramatically your policy and start accepting significant deaths that they will have to have, then that is really untenable from a political perspective.
Can I ask you, as an economist then, Diana, what kind of assessment do you make as to how long it will take China to open up? If you think about the things that will be important here, the vaccination rate, the number of ICU beds that are available, and the death rates that China is prepared to tolerate from this, how long does it take to China to lift all of the COVID rules?
Look, China is in a kind of a slow motion real economy crisis. Clearly, they're ramping up monetary stimulus and debt-fueled investment, but that's really hitting against not just the lockdown dislocations and disruptions and the devastating impact that these lockdowns have on consumer spending, but also actually on the fact that China really is over-indebted and can't afford this debt-fueled growth for much longer, and certainly is going to get a lot less bang for its buck. So the economy is in a really tough spot, and she doesn't have a clear-cut exit strategy. And any exit strategy will involve continued economic pain. So this is a situation that I think the way markets are reacting today, it's very surprising, given that what the Chinese came up with this overnight was a lot, one could argue, even weaker than the 20-point relaxation that they had earlier, which we also described as just tweaking.
Well, we are continuing to get headlines out, Diana, from China. Beijing's Chaoyang district says that elderly and kids can skip daily COVID tests, so maybe some degree of relaxation there. We've talked a lot about kind of the near to medium term impact on the Chinese economy, but I'm wondering about longer term effects. How much damage has been done to China's reputation as a place for companies not based there to produce their goods, like Apple, for example, is the one that comes to mind, or really just as a partner in trade? That seems much longer lasting as companies look to reshore.
Well, this is part of the general great decoupling theme that has been our key investment theme over the last 3 years, the bifurcation of the world into two spheres of influence, the US and the China one. And COVID and China's response to COVID has exacerbated that split. And actually what China is doing right now is damaging its reputation as a reliable trading partner, which is adding to the geopolitical concerns that are causing reshoring and the great decoupling.
There's a huge question about what that means for the growth and inflation trajectory in the global economy. Diana, we have to leave it there, but thank you so much for joining us with your insight. That's Diana Treleva of Enodo Economics. Now, keeping you up to date with other news from around the world, let's get the first word. A bill in the U.S. Senate protecting same-sex marriage has cleared another procedural hurdle. A vote on final passage could take place this afternoon. If it passes, the measure then goes to the House. The bill would recognize same-sex marriages under federal law and ensure benefits for all married couples. Former Vice President Mike Pence is calling on Donald Trump to apologize for having dinner with a white nationalist. In a TV interview, Pence said the former president showed profoundly poor judgment. Last week, he dined at his Mar-a-Lago resort with rapper Ye and white supremacist Nick Fuentes.
President Biden and House Speaker Nancy Pelosi are moving to prevent a strike that would shut down the nation's freight railroads. The House is preparing to take up legislation to impose a labor settlement despite the objections of some unions. A rail strike could hurt the economy by crippling supply chains. And BlockFi has become the latest crypto firm to collapse in the wake of the downfall of FTX. The digital asset lender says it will use the Chapter 11 process to recover everything it is owed by its counterparties, including FTX. But BlockFi acknowledged that recoveries are likely to be delayed by FTX's own bankruptcy. So, Matt, another domino has fallen. It's one we all were largely expecting to fall, considering BlockFi already had its issues, got bailed out by FTX, then FTX itself needed a bailout. The question is, what's the next shoe to drop? We're still looking to see if Celsius got the funding it said it needed.
Yeah, absolutely. And I think the BlockFi shoe was already had already dropped. I think it'll be very interesting. You're right, to watch what happens with Genesis and Gemini. I think that's what a lot of market participants are kind of holding their breath for. BlockFi seemed beyond saving, the other two not so much, Anna.
Yeah, absolutely. And we'll get to the regulation conversation on this. We talked about this yesterday, didn't we? Talk about the sort of regulatory arbitrage in different parts of the world, and certainly the Europeans ploughing ahead with regulation, the MiCA framework. We need a MiCA 2. Christine Lagarde was talking about that just yesterday. Before we get to that conversation, we will talk to Sharon Bell, Goldman Sachs European equity strategist. What does she make of the London market right now? It outperforms on days like today when we see energy and mining stocks jump. Is that enough to get in and buy that market, or do we need further confidence in the UK infrastructure and the UK market more broadly? We'll have that conversation shortly. This is Bloomberg.
Why do we get up in the morning? We'd say, to pass on what matters.
Great food straight to your door. Download the Deliveroo app now.
Future Makers by Standard Chartered has supported more than 650,000 young people from low-income communities in the last 3 years, empowering them to learn, earn, and grow. We're Standard Chartered, and we're here for good.
At SAS, we love bold questions, because with the right analytics, we make data do amazing things, like make the world safer, faster, healthier, and kinder. All we have to do is ask the data. SAS.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed makes it clear more rate hikes are on the way. Policymakers stress that borrowing costs must rise in the fight against inflation. China is making some quiet concessions on COVID limits a day after police blocked more protests. Authorities are easing up on some restrictions and also pushing to bolster vaccination among its senior citizens. And Elon Musk picks a fight with one of Twitter's top advertisers. He's asking whether Apple hates free speech and criticises its app fees. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, global markets, risk appetite was wobbling a little half an hour ago. I don't think it was anything we did, but it seems to have recovered slightly. It was pushed along overnight by the better news out of China, it seems.
Yeah, slightly better news, right? I liked how Diana Troileva put it earlier. She said it's a minute olive branch. You really have to squint to see those concessions, but as we know, the markets love to front run good news. They want to get it before everyone else does. So when it's not there, sometimes they kind of make it up. In any case, we're looking at S&P futures gaining about 1/3% right now. We did close down 1.5% yesterday in the cash trade, back below 4,000. So we're trying to claw some of that back. The Bloomberg Dollar Index, which, the strength a month ago or 2 months ago had been a real headwind for equities, has dissipated quite a bit, and it continues to come down with the number of banks saying they now think that their bullish bets should be reversed on the dollar. So you can see gains in the euro and other currencies against the greenback. Right now, 12.73 is the BBDXY. NYMEX crude coming up a bit, 2.7%. Maybe this is on reopening hopes for China, now up to 79.33. And remember, we saw a 73 handle early yesterday for WTI crude. So that's a substantial gain. And Bitcoin is up, but it's not terribly substantial, still hovering around the same $16,000 level we've seen ever since the implosion of FTX, right now trading at $16,499. Kaylee, what are you seeing in terms of pre-market movers this morning?
Well, Matt, it may not be a massive move for Bitcoin, but it's still enough to give a little bit of a lift to crypto-related equities like the exchange Coinbase, which is actually higher by about 2.3% in early hours this morning, recovering some of its 4% loss yesterday. That was in part spurred by the bankruptcy filing of BlockFi. Other stocks that are moving higher include most in the energy sector with the gains in oil that you were mentioning, Matt. Exxon is one of them, up about 1% in early hours. And then following on from the gains we saw in Asia, all of that optimism around the China news that you and Anna were just discussing, we are seeing that some of those Chinese tech stocks that also have listings here in the U.S. are gaining. The ADRs of Alibaba up about 5.8% and JD.com up about 7.5% before the bell, Anna.
We're seeing here in Europe, Kaylee, then a bit of a bounce back from yesterday's losses for European equity markets, and this is all to do with China and the reopening trade there, getting people excited, rightly or not. So the stocks Europe 600 up by 0.3%. Brent crude is up by 2.9%, again bouncing because of that change in the China dynamic overnight. Basic resources, one of the sectors doing well in London, up by 2.4%. That and energy names help to cushion the London market from any downside on a day like today, and helps the London market outperform. I've got the Italian 5-year yield here, just to underscore what we're seeing on Italian debt markets today. We got the Spanish inflation number. The inflation number came in lower than had been expected, and so that has brought yields down across European markets. And this is a member of the G20 for you, just showing where we're seeing those yields coming down. But if you want to see the bigger moves, Spain, Portugal, the yields there certainly making some big moves lower as a result of changing expectations about how much hiking the ECB has to do. We get the full Eurozone inflation print tomorrow.
Well, Anna, let's continue the conversation about the European economy and how it translates into an equity thesis. Joining us now is Sharon Bell, Goldman Sachs European equity strategist. Sharon, your colleagues at Goldman put out a note related to the U.S. economy and markets yesterday, saying that essentially U.S. equities are not correctly pricing in the risk of a recession, which Goldman puts at about 39% probability in the next 12 months. They say equities are only reflecting about an 11% chance. What's the risk in Europe, and is that appropriately priced?
So I think the risk of recession in Europe is a lot higher. In fact, we think that would be our base case, that you see a recession. We think Europe is in recession really now in the fourth quarter, and that will probably last into the first couple of quarters of next year. So I think the risk of recession is very much higher in Europe. Europe doesn't have energy independence. We have very high inflation, worry that cyclicals have bounced a lot. There's a lot of enthusiasm priced generally into global equities, and we think that's a little bit overdone.
Okay, so maybe the economic growth story is more appropriately priced in. What about the earnings growth story? Are those expectations still too high?
In our view, yes, on both sides of the Atlantic, and that's really because margins are still coming down, companies are facing higher costs, labour costs, material costs, etc., and it's going to be trickier to pass those on to households and consumers when growth is slowing and pretty weak. And in Europe, a very similar picture. We're expecting actually earnings to fall next year by about 8% in Europe. That reflects the kind of gloomier picture we have for European economic growth. And again, we think consensus, which is still for a little bit of positive growth in Europe, is a bit too high. And the main difference between us and consensus is on margins. We think companies face higher costs and it'll be trickier to pass those on.
Sharon, good morning to you. What's the Goldman Sachs view on how substantially we should view the changes overnight from China on COVID-0? And I ask this, I know that your role in European equities, of course, will be watching this your team will be watching this very closely, because there are so many industrial businesses in Germany or luxury goods companies in France that have made so much money in China. So what is the take as to whether these are really micro moves? It's the thin end of the wedge. It's the start of something that really gains momentum in the spring and summer.
So, look, absolutely, China is really important for European companies. And although I sort of painted a gloomy picture for the European economy, we do think Europe is in recession at the moment. European businesses, particularly the large listed ones, are global. They make less than half of their money in Europe itself. And China in particular is a big portion of sales and trade. We sort of tot up the numbers and come up with about 10% China exposure for European companies, but it's probably even a little bit larger than that if you consider the interconnections with China globally go very, very deep. So China's recovery is really important, and a move away from the kind of rolling zero COVID policy that we've seen is important. We think that the moves so far are really incredibly small on that front, and it will take several more months. We probably won't see really a move away from zero COVID into perhaps the second quarter of next year. So the market is right to anticipate it, but perhaps again a little bit too early in doing so.
I saw some comments today, and thinking about your view on the FTSE 100 or the FTSE 250, Sharon, it's a day like today where we see outperformance in London because of exposure, of course, to mining, basic resource, energy stocks. I saw a comment from the Lloyds Banking Group CEO, Charlie Nunn, earlier, who says that global investors are nervous about investing in the UK. Does that come up in conversations about UK equities?
Happy with the concept that FTSE 100 is not very exposed to the UK. About a quarter of FTSE 100 sales are domestic to the UK, but more domestic. They also tend to suffer at times where you've got higher costs and higher wages. They tend to find that more difficult to pass on to their customers. I do think there will be recovery in the UK as we go through 2023, but at the moment it is a difficult patch, and there is nervousness from global investors in investing in those kind of more domestic focused companies in the UK.
Are there recession-proof sectors or companies that you like, Sharon?
I mean, companies don't tend to ever be totally 100% recession-proof, but I guess the businesses that tend to have the lowest beta, the economic problems, say in the UK, would be global companies, would be healthcare companies in particular, would be companies which have got businesses which make a lot of dollars, things like commodity companies, mining companies, oil companies. They suffer with economic downturns globally, but bear in mind there's a lack of supply in most of those areas, so they are still seeing quite high prices. And finally, one thing about this downturn is it's coming with higher interest rates, and higher interest rates is generally quite good for financials, so that's another area, perhaps of more resilience this cycle than it's been typical.
You're speaking at the Goldman Sachs Resilient Business event at Oxford, and I wonder, especially small businesses, how resilient can they be?
So in some ways, I'm surprised at how optimistic and resilient the small businesses are. The conference that I've been attending and speaking at, it's great to meet smaller businesses. These are the people that are growing the economy. These are the entrepreneurs that are hiring, creating jobs, creating growth for the economy. So, and they absolutely are aware that from a kind of big macro top-down angle, things are pretty bad. We have inflation, we have a cost of living problem in the UK, we have very weak growth, we are probably in recession. But all those things also create opportunity as well, which they're looking for. And I think we call this conference resilience because we think businesses should be thinking more broadly about their resilience. We know there's a lot more volatility now, given the scarcity of labour, given the scarcity of energy, given the scarcity of resources generally. It's going to be really important for businesses to be resilient.
Yeah, and resilient to higher interest rates. Sharon, thank you very much. Sharon Bell is there from Goldman Sachs. Thank you for your time. Coming up, we will talk to Irene Tinagli, who is the chair of the European Parliament's Committee on Economic and Monetary Affairs. She was hearing yesterday from Christine Lagarde of the ECB. What does she take away from that conversation? We'll talk about monetary policy, inflation. This is Big Bang.
Why do we get up in the morning? Is it because we want to go somewhere, be someone, or beat someone? Is it to put capital where it counts, to make a change, or simply to make our kids proud? If you asked us, we'd say to pass on what matters.
Out of snacks? Get Doritos in minutes.
You've got it. Get here.
At SAS, we love bold questions because with the right analytics, we make data do amazing things like make the world safer, faster, healthier, and kinder. All we have to do is ask the data. SAS. At Standard Chartered, we believe that no matter how you start in life, every young person has the right to reach their full potential. We're Standard Chartered, and we're here for good.
In this environment of high uncertainty and with complex shocks hitting the economy, the Governing Council decisions will continue to be data dependent and follow a meeting-by-meeting approach. How much further we need to go, how fast we need to get there, will be based on our updated outlook, on the persistence of the shocks, on the reaction of wages and inflation expectations, and on our assessment of the transmission of policy stance.
That was the ECB President Christine Lagarde, of course, speaking at a hearing before the European Parliament's Committee on Economic and Monetary Affairs just yesterday. Joining us now is the chair.
Guys, so we are live on TradingView, obviously, as well as TikTok. So feel free to join us on the TradingView live or stick around on here. Now, as you can see, we do have a signal up, or two signals up. We've got obviously our BTC signal. With three take profits, as you can see here, the price levels, and then we've got a Litecoin update here. Now, if you go over to our TradingView account, you will see that we have uploaded a crypto market update where we kind of just basically discuss the outlook for this week. Now, something that we do need to bear in mind is the fact that we do have, well, it's US labor market week, basically. So it's the first time where we actually getting some US data since the CPI reading that we got last month, or sorry, earlier on this month. And the markets have obviously been waiting for this. Now we are expecting prices to push up higher. So yeah, we're expecting a bear market rally. Prices pushing up higher. Altcoins pushing up much more. It's going to happen. So yeah, bear that in mind. What else have we got to touch on really? We also get some European CPI data. I think it's either tomorrow or the day after we actually get the EU CPI. Today's German CPI reading, which is basically out of all the EU countries, the most important one, followed by France. So a lot of data to come out. We also do get US bear with me, US PCE reports, and it is obviously the Fed's preferred inflation report, followed by the headline CPI. So kind of core CPI is what you kind of really want to look at, because it kind of gives you the idea as to the other aspects of the economy. So it takes readings. Well, it takes energy and food prices out of the equation, which are obviously the two main aspects of inflation. So obviously, if inflation is persisting in the other parts of the economy, then it tends to be a worse situation. Okay. Naturally, food prices, energy prices all push up, but yeah, you do want to also keep a very close eye on the rest of that goods basket to indicate whether inflation is going to persist or not. But yeah. Expecting prices push up higher. As you can see here, we are holding current price levels. You've got the dollar index, as you can see just here, making a move down. Let me just get the camera on just here. So yeah, it does look like the dollar index is going to push lower, okay, somewhere around this region here, the 786. Hopefully it can hold. Now the problem comes if we get, and then kind of on each high, as we get each high forming, that we on each high that forms, we average into our long-term short positions. Okay, that's what we're looking at in terms of our kind of trading strategy moving forward. Our long-term outlook is for prices to come much lower. I still do see that happening. Equity markets are actually starting to turn around, which is fantastic. But yeah, it's one of them.
When we are regulating emerging phenomena, new phenomena, we have to adopt a gradual approach, trying to regulate what we know about, avoiding the over-regulation or avoiding, things that may not work. So we adopt a step-by-step approach again. So this regulation, I think it.
But yeah, guys, ask us anything in the comments, whether it be on TikTok, whether it be on the TradingView live, anything, any TA that you want us to do, whether it be Forex, equities, commodities, bond, even the bond market, yeah, just ask away. Altcoins, more than happy to smash off some altcoins here for you. Obviously, we've got that Litecoin trade earn. So we'll see how things kind of develop. There is very, very much holding onto price levels. And I mean, just look at that volume coming in. It's insane amount of volume. And it's currently holding some nice support. So yeah, let's see whether we can continue moving up. All we need is for the market to follow structure, push up higher, break through some levels, and we're talking in terms of Bitcoin, dollar index to make that push down to about 786 level, and then we can expect a rally in alts. Yeah, I mean, just look at that. We're holding on to this nice level. As long as we can hold on to this, guys, we will be pushing up higher. As you can see here, this is a nice level of support, held for a long period of time. So yeah, I mean, 80 is on the cards. If we breach this previous high here, we're looking at 87. So yeah, some very, very nice levels. Still a lot of juice left in this one to go. So yeah, let's see where we can go with this. We have got our final TP at 95. Okay, but the 1618 on the trend-based fib is taking us all the way to 110. Which is at the very top of an order block pulled from a previous price action. So again, that's likely. That's where the liquidity is being held at. It could very, very much happen. As you can see here, look at that 1618 at 10935. Might not make it quite to that level, but we've got this nice order block here, and there is another order block above. So yeah, it wouldn't surprise me if prices do really push up and out of that. As you can see here, we were ranging in an accumulation stage for a decent amount of time. We've breached it. Now just testing this level off. So hopefully we can get continuation. If not, and if we start pulling back quite heavily, then it's going to come back into that range, reaccumulate. But yeah, this is very, very good news. Look at that. We've got institutional buy side action here, institutional buy side action here. Pick up, pick up, pick up. And yeah, that full on explosion. So it's looking good. As long as we can get this bear market rally going and prices pushing up higher, we'll get that follow through across the board, which will be fantastic. Yeah, I mean, let's see. At the moment, we're holding on to this level quite nicely. As you can see, I tested that 100 moving average on the hourly, finding a little bit of resistance, but I don't think this is going to hold very well and for very much longer. We'll get a straight push straight back up into the short term levels of resistance, which is the take profit 2, and then potentially see a little bit of a move down. If not, depending on how much steam this move has, we'll get a straight push into this next order block here at Steed 900. Okay, so there's plenty of volatility to be had in this market. So some good trades to capitalize on. Yeah, you don't want to miss it.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Let's take a look at what's ahead today. NATO foreign ministers have begun 2 days of meetings in Romania. We're also watching Germany for inflation data. That comes out at 7 a.m. Eastern our time. At 10 a.m., we'll get U.S. consumer confidence data for November, as well as BOE Governor Andrew Bailey speaking in the House of Lords. So that's it for Early Edition from me, Anna, and Kaylee. Bloomberg Surveillance is ahead with Lisa, John, and Tom. I think they're all here. We'll hear from former New York President Bill Dudley, among others. This is Bloomberg.
Let your customers choose their preferred way to pay by accepting Amex payments.
What if you were a trendy apparel company facing an avalanche of demand? To ensure more customers can buy more Sherpa-Line jackets, you call IBM to automate your IT infrastructure with AI. Now your systems monitor themselves. What used to take hours takes minutes. And you have an e-commerce platform designed to handle sudden spikes in overall demand. As in actual overalls. Let's create IT systems that roll up their own sleeves. IBM. Let's create.
Those are joining us on this live stream. Feel free to message in the chat any questions that you may have. We are more than happy to answer, as well as any TA that you want us to do. Feel free. We're more than happy to do TA on any market whatsoever. Forex, commodities, equities, literally anything. Feel free to ask us. We're more than happy to touch base on them for you. See what's happening throughout this live stream. We will obviously kind of go back over kind of market update, the market sentiment, but simply just looking at the chart on your screen. You kind of get an idea as to which direction we're expecting things to go in, right? And it is up Dollar index is just setting some levels. Again, something that we touched on our update. It's going to be volatile, as obviously it's looking, or the markets are kind of looking towards that jobs data to come out in the next, well, between Wednesday and Friday. Tomorrow we get JOLTS job openings from the US. Which is obviously expected to come in weaker. And then we get some PCE data coming out on Thursday. And then we get the big day, our non-farm payrolls. That is the figure that you really want to look at coming in on Friday. So that's what you want to kind of gauge on. Now, if we start getting weaker labor market data, that's exactly what the Fed wants to see. Hello, everyone. Which again is going to go hand in hand with a bear market rally. Okay. Now, fingers crossed, we don't get a break of this 200 moving average on the daily on the dollar index. Now, if we get that break, things are going to look a lot more in favor of prices on risk on assets actually pushing up. Okay, so we do really need to bear that in mind. At the moment, obviously, we got a very nice test of that level, and we're holding. Very nice reaction, but ideally we want to hold this level and start pushing up. We want to break through this previous structure here. Ideally, if we can push up towards this 100 moving average and test it, that would be perfect. Kind of test it, reject it, move back down, test this level here as a new support, and then continue it, its move up. But again, guys, it's going to be very much dependent on the data that we're going to get. Well, this week, next week, the week after, as we get closer towards the next CPI reading, and then the next interest rate decision from the Fed, well, in December. Yeah, let's see things kind of advance on this side. Markets had their time to kind of really gauge on things. Obviously, they've kind of been pushing higher, kind of capturing liquidity up and below. They're coming off better CPI data, okay, which is exactly what the Fed wants to see. It's exactly what the market wants, to hold on to that dovish pivot. Yeah. It is looking like we're going to get a rally. That's just how it's looking. A push up towards the top of these ranges. That's what's looking to be the case. As you can see here, we're still moving down, but as soon as we start breaking these levels here, yeah, we can start looking at some higher price targets. We had a huge sell-off, mainly due to the FTX situation, and basically a continuation as the problem unraveled, and the companies that were very much involved with FTX all started to file for bankruptcy also. The latest one being BlockFi, which kind of instigated that last leg down. But yeah, markets will quickly switch over to that CI reading, kind of slow down in the Fed's interest rate hiking cycle. So yeah, that's how things are looking right now. As you can see here, if we break through here, we got these kind of levels, top of these ranges to look at next. Okay, we could very much push all the way to probably top 17,600, if not the very, very, very top at 18,000. But again, Depends on how much fire this move has, how much momentum, how much volume really starts to come in. The equities market's at $65, so bear that in mind. Okay, but yeah, the signal that we got out here for you all is 1 Bitcoin and 2 Litecoin. Feel free to end on the rest. That's what we're positioned into as well. So yeah, go for it. Treat yourself. Some very nice profits to be made here. Very nice opportunity to capitalize. So bear that in mind.
Ending near 5%. What are the odds of a 4-point miss next year? What if it's 1 percentage point miss next year and the markets think it's a 6% funds rate instead of 5, where it's priced now? You'd see the type of repricing in markets that you saw most of this year, but it probably wouldn't go that far because it seems like between the 3 F's, the Fed, fiscal policy, and financial conditions, it was enough to cause meaningful disinflation, and that therefore the lower interest rate volatility will benefit lots of assets, agency mortgage-backed securities for one, ultimately credit, ultimately equities, etc. But the real volatility might be in spreads in the bond market, not in interest rates.
Hey Tony, can we get a forecast for TD sector?
I'm a baseball player, so you're asking the wrong person, John. But Tom King, that's it. So you can only say I'm saying in the United States.
I know it's just ridiculous.
Let's go with the United States.
It's not ridiculous, Tony. Thank you. Tony, thank you. Tony Crescenzi of Pimco. It's one of Tom's mates.
No, can I just say I love
It's one of Tom's.
you did something today, and I want you to do it every day. So you put out every morning a morning note on Twitter, and you put sort of top stories. They typically, and then you put out the stuff that you actually cared about, which Binotto quitting Ferrari. He is the Formula One. Yeah, exactly. Juve's board resigns, and the Group B final games.
Yeah,
and that's what you care about. Yeah, exactly. And so you're basically like, this is what
I'm still going to talk
this is what I'm paid to talk
about. Market stuff. That's what I get paid to talk about. I assume I get paid to talk about some sports stuff now and then as well.
Yeah, but and actually, I will say that in 4 years' time in the U.S., I'm going to guess that more people will have cogent responses to you with respect to football games.
This is why I'm so bullish, Team USA. I want to see them do really, really well.
Guys, feel free to ask us anything in the chat. Again, more than happy to go through any updates on markets. But make yourselves at home on this live trading session. We're just waiting for a breakthrough. It's currently 11:15 in the UK. However, obviously we're waiting for the volume to kind of come into the market on this New York Open in just a few hours. So we should start seeing markets kind of ramp up. It could be very much the case. And then we get that break coming in on that New York Open, or between the New York Open and the European close. Okay, that's obviously when we get that introduction of volume.
Still, Beijing stopped short of announcing mandates that help raise inoculation rates in the country. Comes after a weekend of protests demanding an end to COVID limits. British Prime Minister Rishi Sunak says the UK cannot rely on what he called simplistic Cold War rhetoric against China in his first major top foreign policy speech.
Our message to peaceful protesters around the world is the same and consistent. People should be allowed the right to assemble and to peacefully protest policies or laws or dictates that they take issue with. We're watching this closely, as you might expect we would. And again, we continue to stand up and support the right of peaceful protest.
That's John Kirby, the White House National Security Council spokesperson, responding to the events in China over the weekend. Live from New York City this morning. Good morning. Equity futures just about positive, up to 0.2% on the S&P 500. Chairman Powell speaking tomorrow on Wednesday. They get payrolls data on Friday. Yield to come in a basis. Why is that 2 basis?
So yeah, that's something else to touch on. We do get obviously Jerome Powell saying his part. That's fine. So something to bear in mind as we move towards that non-farm payrolls data on Friday.
All 12 unions failed to sign up to that tentative agreement. We've got a problem.
And how does this president deal with it? Because he is the president of unions. And this is interesting. So he comes out and he's asking Congress for help to force some sort of deal here because some of the unions won't sign on to this. How does he message this in a way where he still sounds pro-union, even though he is going above them and injecting Congress?
Anne-Marie is back in town, I'm pleased to say. AMH, welcome back down in Washington, D.C. Anne-Marie, what's happened here, why this is broken down, and what's on the table now?
Well, for the labor unions, it really comes down to this paid time off. They want this medical leave, and they say that's even more important than raise wages. So that's why you see one of the biggest labor unions, or the biggest labor union, voted this down. And that's really when tension started to rise, and it looked like they wouldn't be able to get this agreement. They have till December 9th to try to negotiate this, but clearly that's just around the corner, and the White House doesn't look like that's happening. So now the president is out with a statement calling on Congress, because Congress could be the ones to step in to avoid a strike. And what the president was trying to say yesterday in the statement, I'll bring you some of that, he is saying, let me be clear, a rail shutdown would devastate our economy. To Lisa's point, at the same time, he was saying, I am one of the most
starting to see an uptick. So we should start seeing some volume, some movement coming in closer towards 12 o'clock. Midday, and then between midday and about 1:30, 2:30, as the US starts to open up we should start seeing a bit of a stronger move, a bit more volume coming in, a bit more of a reaction coming in. That's exactly what we want to see. Okay, beautiful. Guys, feel free, give us a follow. We do update every single day of the week. Market updates all throughout Monday to Friday. We then normally get the news and any reports that we are to expect in the week starting the following day. So yeah, you are kept up to date every single day of the week, so bear that in mind, guys. You don't have to worry about one thing, we've got you covered.
Their message with the Communist Party over in China in terms of wanting to end COVID-0 while also encouraging companies in the U.S. to diversify some of their supply chains away from just their reliance on that nation. Well, you heard Admiral Kirby says they're watching these protests carefully. Quite a muted response from the White House. That statement about the fact that they support peaceful protests around the world could be said for a number of protests happening right now in countries. Iran as well comes to mind. But the fact that they're watching these protests in China carefully is all they've said, or closely, and they don't see an impact yet on supply chains. But of course, as you said, Lisa, behind the scenes, or even more so out front, the U.S. and the money they're putting into the United States in terms of semiconductor chip building one, but also the rallying behind the business community in other countries around the world to divest away from China and to make sure that there are other supply chain routes, because that is what the pandemic really exposed, this reliance on China. Just similarly in Europe, it's reliance on Russian gas and oil, the fact that the West is too reliant on some of these countries. So it's an interesting moment right now in China, but the U.S., the administration hasn't come out and really said something direct or dramatic about these protests. They don't see it into supply chain.
How did some of this play out at the G20?
When it comes to supply chains, a lot of what the G20 cares about, what the United States cares about, is making sure they're shoring up these allies in like places like India, etc., that they can have stronger supply chain outlets. And you do see some companies moving what potentially would have been a factory in China to a factory in India. The United States wants to make sure that they are there as a partner for some of these developing countries to be another lifeline instead of going through China, whether or not that's for debt sustainability and relief and working that out, or whether that comes to supply chain access.
Anne-Marie, great to have you back in the seat down in Washington, D.C. AMH there, back with us here at Bloomberg. Clearly there's been a change in the labour market, a massive change. We were talking about the amount of leverage that employees had over the last 18 months. There seems to be a shift, and you can see that, I think, in the communication coming from a company like Snapchat. There's real tension now in tech across major companies. Don't know if you consider Snap a major company, but this line from Evan Spiegel about getting back to the office for 80% of the time, what each of us may sacrifice in terms of our individual convenience, I believe we will reap in terms of our collective success. Does that kind of communication, dare I say that cult-like stuff, really resonate with people anymore at tech firms? Given what you've seen take place at Meta, massive cuts, if you drink the Kool-Aid, does it make a difference?
Is it really getting through, or is it basically just saying, come back to work 4 days a week? This is what we need from you. Sure. If you don't, we're not going to have you still here. They already engaged.
Collective success.
I mean, we can. You could talk about HR speak and sort of the, kumbaya.
It's not HR speak. It's like that Kool-Aid. Drink the Kool-Aid. You are more than just a company. Buying that anymore in Silicon Valley, does that mean anything?
Will we see a complete culture shift? Because it's been a harsh reality after buying up and basically adding a ton of staff, putting ping pong tables in and having booze at 4 p.m. and yoga sessions. Look, I think that it's a well taken point. The bigger picture here, Wall Street's been seeing this, and that they've been not saying it, but the same kind of kombucha message, which is, we need you back in the office. We're much better with
The company fired 20% of the workforce.
But that's exactly it. I mean, they're firing the workforce, and then they're saying we're still going to hold to this sort of, very touchy-feely kind of
sit there
message.
year-end at the drinks and sing Kumbaya and how you've drunk the Kool-Aid and you think that culture's so important with family, and then all your mates get laid off.
Look, I hear you.
Give me a break.
I hear you. Will this be a big culture shift? But at the same time, it is a pivot point to come back to the office.
Do you know why I go back to the office? Job insecurity. Nothing.
But that's exactly it. But they can't say that. Come back to the office, they're going to fire you.
Because
your
we're a
friends.
family and we need to be together. Stop it. It's just positive too.
How do you really feel?
I'll tell you.
Evidently you will.
From New York.
You just did.
To Bloomberg.
At SAS, we love bold questions because with the right analytics, we make data do amazing things like make the world safer, faster, healthier, and kinder. All we have to do is act the data. SAS. You shed light on dark matter. You make aging optional. You turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Guys, feel free to message us in the live chat, ask us for anything. As you can clearly see from the chart, we're expecting things to push up higher. You've got a nice signal over here, Litecoin, lots of potential. Final time, well, you've got 4 take profits there. You play it how you want to play it. Either take out profits incrementally at each of those take profit levels. 87 looks like a very, very good target to go for.
Futures looking a little something like this on the S&P 500, positive a quarter of 1%, on the Nasdaq 100 up a half of 1%. Big day of losses yesterday, biggest one-day loss on the S&P going back to early November 9th to be precise. Treasury yesterday a 10-year, 376, 365.71 rather on a 10-year, on a 2-year, 442.99. There is a bid in the bond market over in Europe as well. Downside surprise for CPI Spain. Likely to see the same thing from Germany 90 minutes from now. So looking at single currency, euro dollar shaping up as follows. With all of that, euro dollar 103.73. Euro dollar positive, a third of 1%.
Yeah, interesting to see how the dollar has really been the weak player overnight and over the past couple of weeks. I want to bring this. Stephen Major just put out his major bond letter where he puts out his outlook. First of all, he just said the early stages of this year's World Cup remind us that football is a funny old game, so we can just start there. But he also didn't try to project what's going to happen. It was a range. Well, I was looking at the 5% yield scenario and that the 10-year yield could go to 5%. That seems process. He's a certain spot on because he doesn't necessarily say what I think is going to happen. He's going to game out the potential scenarios and how that could play out and give you some sort of probability.
You know, you joked about me talking about what I actually want to talk about.
Yeah.
You think that's Steve writing about what he actually wants to talk about, which is the World Cup and maybe not the bond market?
It's literally every note that I've gotten is trying to draw analogies to the World Cup, which is what they're actually watching, and then they come up with a range of possibilities saying, we don't know what's going to happen in markets, so let's go back to soccer.
A little bit later, 2 p.m.
Yeah,
Eastern
US.
Look, you can watch that.
Yeah, I am.
I love that.
I actually did this.
Do you know how happy that makes me?
Well, I actually genuinely do it. I'm not just doing it to make you happy.
I never do anything just to make me happy.
I really wouldn't. You know, so that's okay.
Joanne Finney wouldn't either. She joins us now, portfolio manager at Advisors Capital Management. Joanne, can we start with the tech names because they've been hammered this year? I'm thinking of Meta. I'm thinking of Amazon for that matter as well. When do you start to think about picking up the pieces here?
Well, good morning, John, Lisa. Clearly the higher interest rates, has reduced valuations across the board for anything that has substantial growth in it. But also there's fear of that recession, earnings numbers coming down. You look at it relative to not just history, but what they have in front of them. And some of those tech companies are better positioned than others. They have bigger, deeper moats. They have stronger, more secular growth in their end markets. A company like Amazon, Microsoft, we like those because the internet is not going to stop growing. The use of data is only going to get larger, more pipes, more data handling, more analytics. And so these companies we think are still really well positioned. They've gone a lot cheaper, and the growth outlook in front of them, 3 years, 5 years, 10 years, substantial growth ahead. And we think that, as interest rate increases start to peter out, not necessarily reverse, the headwinds that have caused those valuations to come down over the last year, those headwinds are going to evaporate. And eventually they're going to, turn into tailwind as rates do come down. I don't know when that starts, but we do think that the headwinds now are really diminishing, and that makes it a particularly good time, potentially for building positions in these tech names. And if you're a long-term investor, I think you're going to be...
So guys, feel free to follow us. We do bring out market updates every single day of the week. And as well, just ask us any questions in the chat. Anything that you want us to take a look at, give us, give our opinion on it. More than happy to do that for you. Any market, equities, commodities, forex, whatever it may be, we shall cover it for you. Any altcoins. So as you can see from the screen, the outlook is for prices to push up higher. They are slowly pushing up higher. Let's assume that much on Ethereum, but let's have a look at Ethereum. Guys, this is bullish. As you can see, we're getting wave, another wave, another wave here. So if we get another one just like this, bam, 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 we will start to skyrocket. So, yeah, keep a close eye on it. Things will push up higher. We are positioned short and long. Our outlook is for, short-term outlook lot, process to push up higher. So we're taking some short-term long positions, and then on each of those highs, we're going to add an average into our short positions for kind of the turnaround in the market. We are expecting prices to shoot way lower once they have found resistance, once there's a little bit more clarity on direction of the economy, the EU, the US. Now, what's interesting is what's happening over in China, right? In terms of protests for the COVID zero or zero COVID restrictions. So, which is putting obviously pressure on Xi to reopen. So, which kind of adds implications for the West, right? So we're all in the winter seasons now. We are pumping energy to keep our houses warm through this season. So the last thing that we kind of need is China reopening, putting more pressure on the use of energy. Big Jedza, how are you, my man? I will have a look at CVC for you right away. Just give me 2 seconds. Let's have a look. Let me open. Let's do it on. Let me open another screen. I'll have a little look for you. So yeah, I mean, Binance obviously gonna list, delist. Not only Binance, I mean, a lot of exchanges do that. It's just mainly due to liquidity issues. So obviously they have a liquidity threshold. Once they reach that, they're able to list a crypto. But then, so normally, obviously, on the listing, there's a lot of kind of thoughts on it pushing up. So a lot of people get involved. And then over time, you will see that volume completely dies down, especially in a bear market. Volume especially dies down. Yeah, when there's literally no liquidity in the market, they just delist it. Yeah, it's just not useful to them. So CVC Civic. I think this chart is on spots, but let's have a little look. It's just the problem is here, right? That it very much runs on minimal volume. Okay, so as you can see here, we are at a very nice level. In fact, very nice level, as you can see here. This order block. Okay, lots of support at this level. However, the current structure is not looking too great, so we could actually look at it coming all the way down to about here. Okay, this range here is your bottom. Okay, so this is your order block, guys. Okay, so that could potentially happen. However, we are really not getting any volume whatsoever. So because we're not getting any volume or any institutional buy side action prior to seeing a move like that, it's unlikely that we will get that. So this is kind of your resistance level up here. So you've got 1, 2, 3 order blocks. So yeah, price is likely to push up towards here and then make a move down. This is your buying range. I'm not sure whether you're invested in it or whatever, but this box here is where you kind of want to look to buy for the long term. That's where the bottom is likely to be put in. There's volume being held there, and obviously we need that institutional buy side action to come in, and you will only ever see that coming in when you get cheaper prices, where at price levels where they're willing to buy at, of course. So yeah, that's where we're at with that.
Coming up at 7:30 Eastern Time, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Nancy Pelosi are moving forward to prevent a strike that would shut down the nation's freight railroads. The House is preparing to take up legislation to impose a labor.
But yeah, hopefully that answered your question. But a lot of the time, especially if Binance delists an altcoin, it's never good news. I mean, yeah, it's mainly due to the low liquidity levels, and just not many people getting involved in it. Also, being in a bear market doesn't help that scenario. But yeah, I don't know a whole load on the fundamentals of Civic, but if you think that it's got good fundamentals, good potential for the future, it's something that you can potentially hold. My outlook, just being in crypto for so long now, and going through a couple bull cycles, especially not the most recent bull run, but the previous one, I think is 2017, where you kind of got that new influx of a whole load of altcoins entering the market. So the ICO sort of bull phase. Just honestly stick to those that have got really good fundamentals, got good liquidity, good interest, good roadmaps, good team behind them, and mainly those are the ones that are towards the top of the kind of market. So yeah, the best case for your investment portfolios or your crypto investment portfolios, keep it safe. Just keep it to the big ones. You'll make a whole load of profit on it. Don't go searching for the one that's potentially going to make you a millionaire. 99% of the time, it won't. So it's just really not worth it. Just play it safe. You'll be a lot more profitable in the long run, if you do just that.
Company share prices are driven up and down by speculators, but in the long run, share prices are driven by how well companies execute the opportunities they have. If they can build successfully, so can their value. That's why actual investors do not frantically buy and sell, because it pays to keep your eye on the ball. Bailey Gifford, actual investors.
But yeah, that's your Civic anyway. We will go back onto this chart, the juicy chart. But yeah, any other recommendations that you want to go through? Yeah, I'm more than happy to do that. Just type into the chat, and we shall go through all of that analysis for you. That's not an issue whatsoever. More than happy. Start off for 5 o'clock ish, as the European session closes. But as you can see, we got a nice sort of block here. So, what are we expecting on the lower time frame here? So, we had a nice push up, back down, push up, back down, and then bam. We're going to just continue pushing through, breaking through these levels all the way up. That's what we're expecting to play out. I guess we can get this off, can't we? Kind of clear it up a little bit more. Just move that over.
Certainly possible that the zero COVID ends early, and that would be a game changer. But it's just as possible that the clampdown comes, uncertainties stays, supply line problems rebuild, and it just causes more economic slowdown out there. Great to catch up with Graham Weinstein, the Morgan Stanley Investment Management Head of Fixed Income. Live from New York with equity futures just about positive on the S&P 500 up 0.2%. Equities pushing higher, bond yields lower by a couple of basis points, 365.71 on a US 10-year, euro dollar 375. In about an hour and 10 minutes, you'll get CPI data out of Germany. We've had the regional breakdown so far. Downside surprise after downside surprise across Europe this morning on inflation, so that's worth a look. Just about hanging on to the 70s on WTI crude, 79.17, call it 79.20. We're positive 2.5% on crude this morning. Tweet in the morning so far. So what did China announce today, or are we using markets to imply that something was announced?
It's a good question. They did indicate that they were willing to increase some of the motivation to get the vaccines, and that seems to have generated some encouragement. Perhaps also we're not seeing as many protests because they were all cracked down upon.
And Karen joined us now, Bloomberg Chief Asia economics correspondent. And what has been announced in China overnight?
Well, they're getting to the Achilles heel that we've talked about in your show so many times. They came out today and said we are going to boost vaccination rates, especially among the elderly.
Guys, that's good stuff in. More than happy to touch a base on any altcoins, any market. Yeah, let's go for it. As you can see from the screen, we are expecting obviously prices to push up higher. So we're going to get some nice trades on the cards once we start breaking through. I mean, let's add another level of confluence on it. Let's get a trend-based fib. Let's see what we can add in terms of potential next targets. Now,
there's been a view, some could call it rational, that there was no need to get vaccinated when there was no COVID in the country. Obviously, that situation has changed. It does feel like it's reaching a point now where China is realizing it has to get its vaccination.
Let's get this trend-based fib. As you can see, the 1618 lines perfectly with these order blocks here and take profit too. Yeah, that's a very nice level. As you can see, we'll be obviously testing this previous structure here. Take profit 3 will break through structure, okay, and it's an order block as well, which is going to hold on to some nice resistance. So then we can start expecting things to turn around at that level, kind of slow down potentially as we get closer towards that release of US labor data. Obviously, Friday we get non-farm payrolls, we get some PCE data tomorrow and Thursday, and we get JOLTS, job openings data, the ISM, manufacturing PMIs, all coming out tomorrow. So tomorrow's quite a heavy day in terms of data. We also get European CPI data, so it's something to kind of really bear in mind and keep an eye out for, because that will start moving the markets. Dollar index, let's see kind of what's happened on here. Again, it's following exactly what we've been saying. It's going to move up and down, which is going to bring volatility to the market. As you can see here, we're starting to compress, right? So breakout is on the cards relatively soon. So yeah, it's going to continue to compress. Where do I see it going? I see this coming down. I see it coming down to potentially the 618 to the 786, which is going to give that push to the crypto market, potentially also to the equities markets. So there's some trades on the other side, outside of the world of crypto, to take as well. So yeah, bear that in mind, my friends.
That's very unusual to hear these commentary from the European chambers and the US chambers. And you're right, supply chains are being disrupted. We saw that recently, of course, with Apple. And there certainly has been some dislocation of the supply chain out of China into neighboring countries. So when you consider the optics and the negative sentiment towards China, and when you consider the downward pressure on the economy, one would assume the policymakers, of course, don't want to lose foreign investment. They don't want to lose those foreign companies and all the big employment that go with that. And it has to be a factor in their thinking. It's all part of getting the economy back on its feet.
And the consumer base in China is incredibly powerful. And I think we forget that sometimes when we have these discussions. Can you tell me how they could respond to, say, a company like Apple relocating its production base? Do you see that kind of nationalism underpinning consumer decisions?
Well, in the past, certainly there has been nationalism in terms of unofficial boycotts of.
But yeah, guys,
products from other countries.
expecting a move back up in prices.
Offensive to the Chinese people, or whether it's because of a geopolitical spat. For one reason or another, there have been, trade has been weaponized at times by China in an unofficial way. So you cannot rule out that if a company wants to pull out of China on a broad scale, there will be some kind of retribution. But this is where it gets complicated, John, because some of these very large multinationals, when you speak to them, they will tell you about COVID zero. But on the other hand, they will tell you, well, where else do you go to over the scale and the scale of infrastructure that China offers? There are many countries that are off that right now. That's one of China's key defenses. The other side of the consumer story, don't forget, it isn't just COVID, it's the real estate slump. That's still 1/4 of the overall economic output. That's a big part of what's happening too.
Well said, Ender. Appreciate that final comment there. Ender Curran there of Bloomberg out of Hong Kong. And at least we need to talk about that as well. It's not just for the COVID zero story that's dragged down growth to China.
But how much has to do with the fact that people don't have the income in the same kind of way, don't necessarily have some of the enthusiasm. That said, this does come with a time of tightening, right? This was a nation that was trying to remove some of the liquidity that really built up and generated some of the growth that really drove the world economy. They've been retrenching, moving away from that a little bit in the face of some of the slowdown that we've seen recently. But right, this is a country that in a massive inflection point in a lot of different ways. And how do they navigate out of COVID zero and keep companies there? They're having a really hard time.
Growth in China, a handle last year. This year, just about holding on to 3.3% is the estimate for 22.
Can it get back up next year? I mean, this is the one consensus in a lot of different outlooks has been China will be the bright spot next year because it's got to get better than this year. How quickly can they do that, especially if Enda's correct, and I'm sure he is, that it's going to be a very difficult road, and keeping companies is going to be tough.
The estimate in our survey is 4.9%. What happens with the F23? There's a massive asterisk next to that number, and it basically comes down to what they will or won't do with COVID zero.
Okay, I'm going to be sort of delicate, but not really. But I mean, do you think that people are honest in their assessment of what's going to happen next year? Do you think it's kind of clouded? Let's be optimistic so that we can sort of preserve face a nation that's going to penalize us for being
Is the South Side compromised when it comes to analysis around China?
I mean, we've heard that from
I've heard that from a million people.
A ton of people.
Over the last 10 years, sure.
That we never see the actual figures. Will that change because this is an administration that's actually putting out some real figures or closer to real figures? Maybe? I don't know. I just, there has to be an asterisk around it. There does.
There always is. Coming up in the next hour, 7:45 Eastern, Bill Dudley, the former New York Fed president and Bloomberg opinion columnist from New York. This is Bloomberg.
What if you were a trendy apparel company facing an avalanche of demand? To ensure more customers can buy more Sherpa-lined jackets, you call IBM to automate your IT infrastructure with AI. Now your systems monitor themselves. What used to take hours takes minutes. And you have an e-commerce platform designed to handle sudden spikes in overall demand. As in actual overall demand. Let's create IT systems that roll up their own sleeves. IBM. Let's create.
At SAS, we love bold questions because with the right analytics, we make data do amazing things like make the world safer, faster, healthier, and kinder. All we have to do is ask the data. SAS.
Right, give me 2 seconds. I'm going to go and get coffee. Perk up a little bit for you guys.
The yield curve, the labor market, and risk assets are all saying very different things at the moment.
We're all subject to the data. Inflation is what the Fed's going to focus on. It's hard to see inflation pressures easing off completely.
I don't think we're going to see inflation neatly fitting back into this 2% box anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Lots of World Cup talk coming up.
Really?
Yeah, no, that's the promo. That's how we're starting. That's how we're starting the show.
Okay.
Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance. Equity futures up by about 1/3 of 1%. I think we can call this some kind of a bounce back, but only a marginal one off the back of the news in China over the weekend. And did we really get a big announcement from the Chinese authorities overnight? There's going to be a push. It's a vow to make a push towards vaccinating more people.
It's a nod to the biggest question marks that a lot of people have had, which is how do you prepare your population for the end of COVID zero? This is the first steps to it. What that means in terms of expediting some sort of exit of COVID zero, we have no idea.
Massive consequences for 2023. Yes. Huge. And I don't even think we can really have a conversation about the outlook for 2023 without that conversation. The other piece of it, of course, is the Federal Reserve. Waiting for Chairman Powell tomorrow.
Right, we're back in action.
Does anything that Fed officials say really matter? We heard hawkish talk after hawkish talk over the past 24 hours. Bullard, Mester, name your Fed official that spoke, which is pretty much all of them, and they all say the same thing, which is we might slow the pace, but we're still going to go to a higher terminal rate. We're going to keep it there for the duration of 2023. John Williams saying this too, of the New York Fed. And yet we're still seeing rate cuts priced into this market because the market is looking past what the Fed is looking
Some short term.
The S&P 500 has been at recent levels 4 times over the last 5 months, while rates have been successfully and notably higher each time, with a 2-year yield of 175 basis points from the first time, suggesting it is not higher rates that drove the equity sell-off.
Tested some short-term support. Fantastic. Ready to make a move back up. Yeah, we're looking good. We're looking good.
Until it really affects how companies operate, it's not going to have material effect on stock valuations. I don't buy it because I think that, I'll be honest, I don't buy it, and that's the reason why I kind of grunted, but you have to think about the relative valuation proposition. There are people who are suddenly saying, like Terra, there are relative alternatives.
The fact that they need to tell us you don't buy it, as if we didn't already know based on that wasn't that noise you made.
Come on. You're the one that was saying, I'll tell you what I think in the break. I think that you tell us on quite often.
That's the sanitized version.
And otherwise, it's just a slew of expletives. I do think, though, that there is a point being made here, which is we have not seen the effect of rates where they are the way that many people thought previously.
To a podcast where you can curse. you know, you can curse about markets, and people can just really say about how they feel about
A lot of people listening. I think a lot of people
Fantastic,
listening.
wouldn't it? I agree. Futures positive at 1%. No one here at Bloomberg
Just
stand
about
for that. For life, if you want as well.
There you go.
Equities up by a third of 1%. Yields look like this.
That's so we're expecting German CPI to come out soon. There you go, an hour away. We'll see what happens on that end.
Though in absolute terms, still elevated in some of the ECB. What we can say about euro-dollar lease right now 103.83.
Yeah, I'm looking right at a 10-year German yields that is sharply lower, 1.8%. And this really doesn't speak to the...
Okay, guys, feel free to message us in the chat any altcoins you want us to go through. Just any trading related questions. Or just any questions in general. We're here for a good time, not a long time, or a bit of both. A good time and a long time.
We get housing data. I'm not allowed to say the name of this one because
Yeah, I mean,
there we go. And you can just do like a sort of underpinning of a beat of explanation. S&P CoreLogic Case-Shiller 20-city home price index for the month of September. How much does it roll over? You're right, it needs a rebrand. The S&P 20-city data set is going to come in, and can we see a real rolling over of house values, or is it softening in the pace of how quickly they're going up? We are looking for some sort of disinflationary kind of feel, potentially even deflation. At 11:30 a.m., I think this is going to be interesting. A news conference from Jens Stoltenberg of NATO. He's going to be talking about Ukraine and ongoing support, but also China. We're seeing a lot of pushback from U.S. saying, look, European allies, we have to have a cohesive energy and a cohesive strategy when it comes to...
Here we go.
Thank you. Looking forward to that. Joining us now.
Push.
Strategy at UBS Asset Management. Evan, always fantastic to catch up with you in the team. Let's just start with the core theme for you guys, which is that investors are going to be surprised how resilient the US economy will continue to be, perhaps deep into 2023. Evan, can you walk us through the why?
Well, we've got some work that we need to kind of dig at as well, so let's move towards completing that.
We still have a lot of excess savings on household balance sheets in aggregate. So we know that those excess savings are dwindling somewhat for some of the lower earners, but the biggest spenders in the economy are higher earners. We still have a very tight labor market for those lower earners and gasoline prices. That's going to be a big support for the U.S. consumer. You've got a Social Security adjustment, cost of living adjustment that's going to effectively boost incomes. The states have a lot of excess savings themselves, and there's direct support for consumers coming through there. So what we're talking about is a reasonably healthy economy despite all the rate hikes that we've seen today.
Can you be just as constructive on earnings?
Yeah, I mean, I think as inflation comes down, that's going to weigh somewhat on earnings. But I think a lot of that is known, right? A lot of that, even if you haven't seen analyst expectations come down as much, everyone's talking about recession. Everyone's talking about earnings coming down. And so the surprise is that they hang in there, right? We're not talking about a boom in earnings. They're definitely coming down, but we are talking about them just not hanging in. And at this point, that's probably enough.
Do you think we could see the outcome for 2023 flipped from what people are expecting? Was a good first half and a really bad second half?
It could be, because I do think that the tightness of the labor market can continue, and that's going to keep the Fed on edge. There's a lot of narrative right now that, okay, the Fed's going to do another 50 basis point hike, another 25 basis point hike, and more or less be done. Right? I mean, I think a lot of the rally is a result of people, and I think a lot of it too is then round trip that we've seen from the UK transitioning from fiscal stimulus coming from the Trump administration and fiscal austerity. So that's putting downward pressure globally on yields, but all of that is kind of played out, and now we get to the point where, you know, growth is okay, inflation is sticky, Fed might be doing more than people expect, and then right out there you have the Bank of Japan, right, which at some point next year probably.
This is a critical time for our security, and we are sending an important message. NATO is scared, NATO is vigilant, and NATO is ready to defend every inch of Allied territory.
Jens Stoltenberg there, the NATO Secretary General, live from New York this Tuesday morning. Good morning to you all. Equity futures are just about positive, up a third of 1%. Yields coming in just a little bit on a 10-year, down 2 basis points, 365.71. I'll talk more about the European bond market a little bit later this morning off the back of a downside surprise on Spanish CPI. Euro dollar at the moment 103.74. We're down about a third of 1%, up a third of 1% rather on that currency pair. The euro showing just a little bit of strength. Lisa, you mentioned a news conference coming up with Jens Stoltenberg. What time was that?
11:30 a.m.
11:30. What are we expecting from it?
I'm curious to hear not just what they're going to do in order to provide Ukraine with support, but also with respect to China and how the West is trying to reduce reliance on China, because we've heard that much more clearly spoken over the past couple of weeks.
Let's get you some team coverage. Joining us now is Bloomberg's Anne-Marie down in Washington, D.C., together with Maria today over in Bucharest. Maria, let's begin with you. What are you expecting from the NATO Secretary General a little bit later?
Well, Jonathan, I already had a preview because I was at a panel in which he assisted and spoke, and there were two things that he repeated time and time and again. One, NATO is the biggest military alliance. Perhaps that is a message not just to Russia, but also China. He also appealed to allies for a full comprehensive package of assistance for Ukraine, and right now this is not just money and weapons, but also winter equipment. This country is already under a lot of pressure because of the low temperatures, and then something that to me really caught my eye. He suggested, well, we should learn the lessons from Russia and perhaps apply them to other autocracies like China. We should reduce our dependencies from countries that clearly do not share the same values.
Well, and Maria Tadeo, this is really an issue, especially as you hear Volkswagen pulling back and actually closing down some of their factories in Russia, saying it's because of supply chain constraints, because of some materials that they cannot get. Is this a stealth way, a good excuse for certain industrial companies from the West to withdraw from China? Is that what we're actually seeing?
Look, it is hard to tell because on the flip side, there was also the German chancellor who went over to China a few weeks ago with a bunch of CEOs also, again, on that trip, official visit. But there is also right now in Germany a rethinking about essentially what was her foreign policy for decades. And that is that the more you trade, the better relationships that you have, and therefore diplomatic ties will improve with Russia. That entire playbook that Angela Merkel applied for years have gone out the window. You did a lot of trading with Russia, they got burned, and now you have a war. So I think with China, with respects to Germany, there are tensions within the coalition, how to treat the Chinese, but also overall in Europe, there's this idea that perhaps, yes, you have to decouple from countries that do not share your values, or at least not be be as dependent, to not be in a situation like the one we're in right now, in a perfect storm, high energy costs, still dependent on Russian supplies, a massive diplomatic fight over the oil and gas cap, and of course, inflation still being a problem.
And Marie, how united is the West when it comes to moving away from China, moving away from Russia?
So there's this issue where they're dealing with the economies that they are dealt with. This was, as Maria said, this is what Chancellor Merkel really had for years. The Germans really rely on China when it comes to their economy, the same way they relied on cheap Russian gas when it comes to their manufacturing. This is something that is going at the same time. It's not just going to be like switching off a light switch.
This is going to play out between Macron and Biden later this week.
Well, when it comes to Macron and Biden and the state visit, what is really going to be on the agenda is what Macron has recently called the U.S. Inflation Reduction Act and those climate subsidies that they're giving to U.S. companies only. He said that these are unfriendly practices, and he says that they're calling this protectionism, and this is something that the Europeans really behind the scenes want to work out the United States. But also to show a little bit of a fractured environment in Europe, you have the Germans who are saying we need to deal and communicate with the Biden administration, and we should not start an inflation trade war. So they're actually more welcoming a little bit of what the U.S. is doing, the Inflation Reduction Act. Very different stance than how France has been taking it, and this will be the main topic as President Macron visits Washington this week.
Anne-Marie, final question: who goes further, Team USA or Spain?
Oh gosh. Maria's going to be upset with me, but I'm obviously rooting for America.
Oh, yeah, you should.
I'm so fired up about this.
Oh, I know. That's why you're basically just setting her up.
Can we send Maria out on Twitter?
Yeah, are we going to let her speak or no?
Do you think Maria needs permission?
Go ahead, Maria.
The fact that you just gave me a question, I just cannot. I can't. Let's go to commercial. Just back to you guys.
Let's do commercial.
That's the subject between Spain and Washington D.C. right now.
That's not about Spain and Washington D.C. What are you doing? All I can say is that she'd have a field day on that podcast. You're going to concur. So I think that's. I think that she'd come in.
My first guess.
Yeah, Madrid.
Today at AMH.
I actually watched
the World Cup.
Spain versus Germany.
They play really nice football.
They play a great game, and they are young. She's right, and they're good.
They are good.
They're really good. Gavi was excellent. That was fun. She's very
like Gavi.
I mean, there are others that are very good too. I mean, it was really a great game to watch.
I'm pleased you watch it. Look at the shape of Spain. The way they play football is really interesting. They always have someone on either side of the wings pinned to the sidelines, and it's the way Barcelona plays football. They really stretch out defence. You see Dani Olmo on the far side and Torres on the other side, and they're always there in position whenever they've got possession.
It's a fast passing game. I like that. And just sort of the idea of one team moving as one, even though they're continually passing, is impressive.
Some people find it very boring as well, because it's just sort of like, you know.
I like that. I like chess.
Maria likes it too, clearly.
Yeah, she has lots
very fired up about it.
Yeah, and you knew this. You were just setting her up.
No, I'm shocked. I thought she'd be more diplomatic about it. That's why I asked the question.
That's what you really thought.
Coming up, David Rosenberg. Looking forward to that. The founder and president of Rosenberg Research. A must-watch, must-listen conversation just around the corner. Did I get to say thanks to Anne-Marie and Maria? I don't think I did.
I think we should say it again. Thank you.
Anne-Marie, today both of you. Thank you. As always, Equity Futures shaping up as follows on the S&P 500. Team Spain playing in a couple of days. We'll get Maria's thoughts on that.
Just follow her on Twitter.
Surveillance. If she comes back, I mean, she's very unhappy off the back of those comments. Equity's up a third of 1%. Yields down a couple of basis points. 366. She wasn't joking.
Did you see her eyes?
Oh.
She was really angry. She's like, I can't even be on this. She almost ripped off her
I don't
microphone.
want to be on this show anymore.
I basically go to break. I don't really care. Like, I don't want to be on with you guys. That's basically what it was.
Hey, she's not the only one, is she?
No, probably.
So that's why Tom's still on.
He basically ripped off his microphone and said,
I'm not coming back.
Forget it.
From New York, this is Monday.
Well, yeah.
To adapt in a fast-changing world, you could hire a professional pit crew. They deliver
real-time data and business forecasts when you need it.
I think it was fine how it was.
To help you stay ahead of the curve. Or you could use Workday, the finance, HR, and planning system that helps CFOs make better decisions faster.
On the other hand, we had a great report.
Accelerate your decision-making world. Workday for a changing world.
Here on the S&P 500 by about a third of 1%, trying to bounce back from the biggest one-day loss on the S&P. Going back to November 9th, up about a quarter of 1% now on the S&P. On the Nasdaq 100, up a half of 1%. In the bond market, deeply inverted yield curve. The 2-year versus the 10-year negative, something like 80 basis points. At the moment, 443.40 on a 2-year. Yields lower again on a 10-year to 366. More curve inversion for you. And a bit abroad as well in Europe. Firmer bond markets in Germany, in Italy, off the back of downside surprises on inflation in Spain and potentially in Germany in about 30 minutes time. We had the regional breakdown in Germany as we often do on CPI a little bit earlier this morning, indicating you could get an easing of inflation in Europe as well. So your 10-year comes down 10 basis points in Germany, down 15 in Italy, and the euro is a little bit stronger.
How much is it a head fake? Is it just having to do with energy prices and can people shrug this off?
Don't know. Is your answer. The ECB's in a tough spot, and that's the big debate when the ECB convenes on December 15th, and we've talked about this a few times. Inflation's still pretty elevated in Europe. A lot of that is the energy story. It's not the same as what's taking place here in the United States, and the ECB is hiking into a downturn, and they're set to do it again in a couple of weeks' time. maybe it goes away from 75 and towards 50, a little bit like the Federal Reserve off the back of this data, but still double-digit CPI.
Significant deflation, and that 40% of the CPI called materials. So when he talks about that inflation can come crashing down, there are already measures in real time that are crashing down. I mean, oil is down, 35% from the peak. Copper's down 25%. Most shipping rate measures are down roughly 60%. Those were actually the factors that precipitated that rocketing up of inflation, came out of the commodity markets and came out of the supply bottlenecks that had a big impact on transportation costs. Those have gone into major reverse. They're not falling like a feather, okay? They're falling like a stone right now. And that's going to show up, I think, forcefully in the CPI data between now and 12 months from now.
David, falling like a stone to what? What is the level that you see it kind of remaining sticky?
Overall inflation, I don't think it's going to be altogether that sticky. I think that we've already peaked. When you take a look at some of the leading indicators, like the pipeline measures, core intermediate PPI, core crude PPI, they are actually not just decelerating, they're deflating. And that's going to create downward pressures on the good side of the CPI over the course of the next year. I actually think that we will be either at or below 3% on headline CPI year over year by this time next year.
People would push back pretty vociferously, including a lot of Fed officials, particularly with respect to the labor market that continues to be pretty tight and continuing to see wages increase pretty significantly. How do you view that and pair that with this disinflationary view that you hold?
Well, what I find interesting about the Fed is their prevalent focus on lagging indicators. You mentioned wages, for example, labor costs. They're in the Conference Board's index of lagging economic indicators. Wages lag the cycle. In fact, you can argue that inflation lags the cycle. It usually peaks and goes down 6 months into the recession. The labor market is tight, but it is starting to loosen up. And the labor market is always tight. You always have either a 3 or 4 handle on the unemployment rate at the peak of the economic expansion. My sense is that, the Fed's already told us that their forecast for next year is the unemployment rate to go to 4.4%. Depending on what the participation rate does, I think we're going to head up towards 6%. So this is a situation, where your forecast, your assumptions drive your forecast. I think that we're going to get much higher unemployment rate, and with a lag, that's going to create more discernible downward pressure on wages. And it's already starting to show up. When you take a look at some measures of compensation, yes, they're running hot on a trend basis, but they've started to peak out and started to roll over at the margin. And I think that's going to be a big theme. I don't think that the labor market today is going to be the labor market next year any more than you can tell me at the peak of the 2007 economic expansion or the peak of the 2000 economic expansion when the unemployment rate was about where it is today, to basically superimpose that on the next 12 months in the context of a recession staring us in the face. I think that these wage trends are going to be rolling over pretty significantly too.
David, what do you think the market consequences will be from all of this?
Well, I think that I'm taking a look at the stock market, and look, I'm waiting to shed my bearish fur and turn bullish. But in all seriousness, you have a forward PE multiple of 17 heading into a recession, and you have analyst earnings estimates which have started to come down in dribs and grabs. But you never had a recession where earnings were positive, and the consensus, and of course the valuations are premised, the forward PE multiples are premised on forward earnings estimates. They haven't really been cut that much yet. I think that for people that are buying the stock market at a 17 multiple on recession earnings, you're really buying the market at over a 20 multiple, and that is just too rich for me. So I still am outright, I would say, cautious, if not bearish, on the stock market. And I think that the bond market's behaving extremely well here. I think the bond market is giving you a view that the Fed is already over-tightened. And my sense is that my strongest conviction call is the long bond for the next 12 months. I think that you will get returns there that you won't get in other asset classes. So bullish on treasuries, most detested asset class, I'm fine with that. But in a recession, and as it becomes more widely accepted and inflation comes down, I think treasury yields out the curve are going to be the place to be.
David, what do you think the character of that recession will be? The consensus view we hear a lot, you hear it a lot listening to this program, short and shallow, short and shallow. David, you push back against that as well?
Well, The thing is that the same people that were saying that we're going to have the roaring 20s and there was not a recession on the horizon are now saying, oh, don't worry, it's going to be a short and shallow recession. I'm not so sure about short and shallow, but frankly, I don't really care because you could have forecasted a short and shallow recession in 2001 and you would have been dead right because GDP barely contracted. But you had overinflated asset values and you still ended up with almost a 3-year bear market in stocks, even with that mild recession. So a mild recession is not a get-out-of-jail-free card for long-only risk asset managers. And on top of that, we don't know the extent to which it's going to be mild or not mild. Here's the problem with the mild recession scenario. Mild recessions, you don't get V-shaped recoveries, at least in a sharp downward move in GDP, and you get the stimulus inevitably from the Fed, you get a V-shaped recovery. So I would ask those people thinking about equities as a long-duration asset, let's say we get a mild recession. What's the recovery going to look like? And then you have the Fed telling us that not only are they talking about the funds rate being higher, the terminal rate being higher than they were talking about, back in September, that now we're going to be north of 5%. And the Fed's telling you that no matter what, and remember, their forecast right now is 4.4% on the unemployment rate.
Yeah.
That would mean the cycle would have risen almost a full percentage point, which has never happened without a context of a recession. So they're telling you implicitly in our forecast we have a recession. Oh, by the way, we are so retentive on the inflation side that we're going to leave rates higher for longer. So even when it comes time for the Fed to cut rates like they've done in the past in the face of economic strains, this Fed's not going to do it. So, okay, let's talk about short and shallow recession. The next question is, okay, what sort of recovery are we going to see? And it seems to me that with a short and shallow recession and a Fed not stimulating policy, we're going to be bouncing along the bottom on the economy for an elongated period of time. I mean, ultimately, you're paying for growth as an equity investor. So fine, run with that view, short and shallow recession with no recovery, because we're going to have a still tight Fed well into next year, if not beyond. And so that means that the longer-term outlook for assets, for long-duration assets, are still going to be very challenged.
And you'll be in treasuries. That's all that's going down. David, this was wonderful. We could keep this going for a long, long time, but I'm told we can't because we've got to get to a commercial break. David Rosenberg, thank you. Absolutely fantastic. A lot to think about there.
You're right. So, getting a little bit of pullback just prior to this US Open in a couple of hours. Yeah, it's holding. Let's have a little look at this Litecoin trade. Yeah, holding as well. We're at this very key level, a lot of volume underneath. So should start looking at a move back up to the upside very, very soon. Get involved. Don't want to miss it. So yeah, it's looking good.
Forests are the current dominant carbon offset solution. Carbon remains stored in building materials even after harvest. Working forests not only provide wood as a resource, but also provide clean water, wildlife habitat, recreation opportunities, and a source of living wage jobs in rural communities that align positively with ESG frameworks and the UN Sustainable Development Goals.
Yeah, so let's go through the market again. Those that have just joined us, welcome. Just a little bit on us. We do a brand new market update every single day of the week. So don't hesitate to hit that follow button. So we are kind of getting started with these live streams. So we're going to try as well hit these live trading sessions every day of the week, or at least Monday to Friday, and just kind of give you a little insight into a live trading session, as well as give you some trade signals. So in terms of the market, okay, we are getting German CPI coming out relatively soon. We've got the New York Open coming on relatively soon as well. So we're going to see a bit of volume coming into the market, which is exactly what we need for this push up higher in prices. Now, the markets are obviously awaiting US labor market data. Non-farm payrolls on Friday is your big one. We got JOLTS data coming out tomorrow. We've got EU CPI coming out as well. We've got US.
It's going to be a dangerous recession in the sense that the Fed can lend at any time and end that recession, which is very unusual compared to past cycles. This is not a recession that has to be driven by financial instability. It's not going to be a recession driven by household and corporate balance sheets being overextended. It's a recession that's induced by tight monetary policy regime. So the Fed can end it when they think the time's right.
Given the strength that we've continued to see in the economy, and Evan Brown of UBS Asset Management was talking about them seeing it sustained through the first half of next year, do you think the Fed could go even higher than you previously thought in terms of benchmark rate?
I'm thinking the peak is probably in the 5 to 5.5% range, just for the point you just made, that the news will probably be stronger for longer. It'll be very hard for the Fed just to stop if we're still at an unemployment rate below 4%, and underlying inflation is still running 4% or higher. So I think that it will get a series of smaller rate hikes, but that will probably push us up above 5%. But clearly, the Fed's strategy here is they're stressing the longer rather than the ever higher. So I think once we get to 5.25, 5.5, I think they'll relent, and they'll just sit there and wait for that restrictive monetary policy to slow the economy down, generate more slack in the labor market, and that will gradually push both wage inflation and services price inflation down.
This is what Fed officials have been saying, Bill. I mean, this is basically pretty much in line with what they're saying. The market is not buying it. They are still pricing in rate cuts by the end of next year. What does the Fed have to see to start becoming less restrictive? And I don't mean that with respect to keeping rates where they are. I mean actually lowering them in a significant way.
Well, they have to be highly confident that they're going to be able to achieve their 2% inflation objective. Doesn't mean that inflation has to be at 2% when they finally relent, but they have to be highly confident. Now, what does highly confident mean? It means that they have to see significant slack developing in the labor market that brings down wage inflation to the 3 to 4% range, and they need to see the inflation pressures be much less persistent and broad as they are today. So they need to see probably inflation in the sort of 3% range headed down. And once they've accomplished both of those things, then maybe they can start to relent. But I think it's going to take quite some time because the economy still has a considerable forward momentum, and it's going to be sustained by the past inflation that we've seen. For example, Social Security recipients are going to get an 8.7% increase in their checks come January. And they're going to go out and spend a bunch of that money, and that's going to keep the economy moving along. And that's going to make it hard for the Fed to restrain things.
Bill, you wrote yesterday on Bloomberg Opinion that the Fed shouldn't raise its inflation target. You said changing the objective now would be bad for the economy and for central banks' own credibility. But I did wonder when that quote published, I wondered why you wrote it. Are you really worried that they might actually go through with that next year?
Well, I enjoy being asked about it all the time, and so I thought I should write that. But the answer is, the argument for raising the inflation target really sort of two potential arguments. Number one, you can't hit 2, so let's make the objective a little bit easier. That's obviously not a very good argument. The other argument is a little bit better, because we have a higher inflation target
then the peak in short-term interest rates during the cycle will be higher, and a lot more will be the recession is, and there will be less risk associated as a bound for interest rates. I think that risk, though, has diminished considerably because the peak in short-term rates this cycle is probably going to be about 5%. So the Federal Reserve has plenty of ammunition to cut rates in an environment where their inflation target is still 2%. So I think this idea that the zero lower bound continues to be this huge risk and is a big constraint on monetary policy, I think that's overstated at this point.
But Bill, how concerned are you that the Fed will not have the same resolve in the middle of next year to keep rates where they are if we do see the unemployment rate going up and we do see the U.S. entering into recession?
Well, I think the committee, it'll be interesting to see whether the committee is united 12 months from now as it is today. I think Chair Powell means what he says. He wants to behave in a way that he's not like Arthur Burns, so he doesn't have to be like Paul Volcker. But whether he can keep the rest of the committee along with him as the unemployment rate goes up, and the trade-offs between the two objectives of the Fed, price stability and maximum sustainable employment, become more in conflict with one another. So I think we don't know the answer to that. I'm hopeful that Powell will carry the day.
I remember when inflation was sub 2% and people were talking about raising the inflation target then. Do you remember that?
I do.
You should raise it to 3.
Absolutely.
Because then they'd be more ambitious and people would believe they're committed to getting inflation higher. Then they might hit 2.
Yeah, do you remember when they were also talking about free money and modern monetary theory? We did that too.
Crazy times. Bill Dudley, thank you. Appreciate it as always. Really thought-provoking. It always is. Bramo, the idea that if you say, let's say, I'm going to go with 3, and it's no longer 2, it's 3%, isn't it just as hard to hit 3 now? Because you start to believe, from an expectations perspective, if they're worried about inflation expectations, if I don't have any confidence in the central bank's commitment to a target of, say, 2%, and I'm in the market, aren't I going to question whether they're really committed to 3?
That's Bill Dudley's point, that this actually will allow inflation expectations to become unmoored. Also, that there is a benchmark price stability that's necessary for businesses to be able to have reliable pricing strategies and be able to chart out some sort of policy going forward. He's saying that 3%, studies show that it's harder for businesses to do that. I mean, there's actual academic research behind what price stability really means for a major economy.
How do you think it would show up in you, Mitch? If they moved to 3, away from 2, and they call people up.
They'd be like, yeah, they would respond immediately.
My expectations are 100 basis points higher than they were the month before.
It's been remarkably accurate in reflecting, okay, all right, you don't buy it just because you haven't been called. If, University of Michigan, if you call John, he'll be more positive on this particular survey. So here you go. He'll stop,
Where do you think inflation will be in 5 years?
Well, it's been notably consistent in tracking market sentiment.
Alicia Naveen in the studio next from BNY Mellon. Looking forward to that from New York. This is Bloomberg.
To adapt in a changing world, you could hire a professor of theoretical mathematics.
We all know this equation, right?
He'd crunch numbers day and night.
That's it.
To maximize profitability.
Morning.
I have quarterly numbers. They're beautiful.
And forecast revenue from every corner of your organization.
Is that important?
Or you could use Workday, the finance, HR, and planning system that helps CFOs make better decisions faster. For a solve problems like a genius world, Workday for a changing world.
it justifies what the Fed's doing. The CPI is the objective.
The wage numbers may become more important than CPI.
The yield curve is definitely telling you a recession is coming. It's not here yet, but the check is certainly in the mail.
It's very, very difficult for the Fed to land the plane here successfully.
We're entering 2023 where there's just so many unanswerable questions.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz and Jonathan Ferro, together with Alicia Levine of BM White Mellon. We'll get to Alicia in just a moment. Equity futures are positive by about 1/3 of 1% on the S&P 500. Bramo, a few key events still to go. Jobs data, jobs on Friday, and Chairman Powell tomorrow.
Which do you think is most important?
Chairman Powell on the data.
Yeah.
At the moment, I think this market's just trading on the data and not on the Fed speak. And you've seen that with CPI, you've seen that from PPI, you've seen that from some of the recent data. And the recent Fed speaks push back against a lot of what we've seen in markets. And have markets listened? Not so much.
The Fed credibility, to me, is really in question, given that markets have completely pushed back and Fed officials come out and keep trying to jawbone this market lower and say, no, we're going to hold rates around 5%, we're not going to cut rates, et cetera, et cetera. And the market says, we're still going to price that in, so we don't buy it. So I actually think that JOLTS data might be the most important data point of the week. If it comes in hotter than expected, more job openings than expected, how much does that shift the narrative and go for what the Fed is trying to say, but perhaps isn't really communicating to the market?
Great to have you with us in the studio, Alicia. Your thoughts on that? What is more important, the Fed speak or the data?
So I think it's the data, and I think it's precisely the labor data, because the Fed has explicitly targeted the labor market here as inflation has remained higher and stickier and not transitory. They've been talking about the labor market, trying to get rid of job openings, the beverage curve, which is the JOLTS data, and then of course, the
Let's talk about what went right, or rather what went wrong for some of these calls around sterling, which is now pushed through 120.
Well, look, I think, first of all, there has been a fundamental reason in the sense that there has been the pricing out of the...
Right, guys.
Related to the fiscal...
Markets are now starting to make a little bit of a move. Litecoin is in profit. Currently at, let me double check for you, 60% profit and breaking it in. So, yeah, looking good. You've got the trades open, but they are still yet to make a turn around. So, yeah, we're looking good. We're 70% now profit. 72%. Pumping, pump.
Yes, absolutely.
Guys, get in on it. Get in on it. It's about to take off. About to take off here. You take profit. Now, there is another take profit, okay? The 1618, which is just under $110 valuation. It's a bit of a mooch from here, however. There has been a lot of volume in on Litecoin, so something that could potentially occur. Guys, we're 132% going.
Identify the places where housing markets are most vulnerable, and in us, at least in Europe, if you look, Sweden and the UK are by far the most vulnerable ones. But aside from that, I'd like to add
what do we get? We got German CPI. Let me send this into the group. Bear with me.
Yes, I think
German CPI slightly slowed down. Not by much, by 0.4%, but still a slight slowdown. It's still at 10%, which is very, very, very high. But yeah, a little bit of a slowdown, which is slightly good to see. So we'll look at Litecoin again. Is it going? Is it going?
So I think there's going to be very gradual opening. We also have a very comprehensive property package, which is putting a floor underneath prices, which will release some consumption impact, like the wealth effect, potentially is going to start putting outside pressure on Chinese imports. But you know what? I think the genie's out of the bottle as far as China is concerned.
What do you think the best line of proxy is to push that view through?
Guys, we do have a full market update on our Trading View channel, as well as some other altcoins that we kind of just mix up every day of the week. So feel free to give us a follow. Again, we do give a market update every single day of the week, as well as updates on other crypto. So yeah, feel free to join the team. We will start to do these live streams more often. So hopefully every single day from Monday to Friday. We start in about 7 o'clock and in about 4:30, 5 o'clock UK time. So yeah, feel free to come and join us every day. Ask us any questions. Yeah, feel free to hit up that chat with any queries that you have. We are more than happy to go over any TA, any bit of news, anything really. Let's build a long-lasting community. It's always a pleasure.
Now, why these places are much vulnerable? I mean, in the UK, you have to understand, in vast comparison, in the great difference with the US, where here you have 30-year fixed rate mortgages, and then here you have 2-year, 5-year fixed rate mortgages, which means that every point in time you get a bigger percentage of the population going out there to refinance. So, just to compare it, you have had about 2.5% mortgage rates in the past 10 years. Right now, you're potentially
A little bit of resistance. That is fine. Let's see if we can really get a push up. That's what I really want to see. Yeah, we need Bitcoin to return. But just from the current price action, the Litecoin is setting the mood and pushing up higher. Let's have a little look at the others. See what we've got. Dash is starting to make a turn around. Fantastic. So yeah, build some positive structure and then boom, just back up profit. That's what we're looking to happen. So yeah.
Eastern time. Yeah, that's Florence. How much does he discuss the ramifications on the housing market that could be decimated, but not just because of interest rates, but also just because
the general economy?
And did you see Goldman Sachs moving some of their
cities
of London to Milan? Partly because of this.
But look, I think what was really impressive was during the last press conference, Bank of England, Bailey actually said, I hope that the market is getting the message mortgage rates are going to go lower after an interest rate hike.
I viewed it from the Bank of England at the time. I don't know, Vasiliy Janakis said it's great to catch up. So, yeah, wonderful futures. I've had a 1/10 of 1% on the S&P. Yields high by almost a basis point. Live New York, heard on radio, seen on TV. This is Bloomberg.
We say actual investors are focused, frantic, but why does it matter? In the short run, any share
We will rock you.
in the long run, share prices are driven by how well companies add value. That's why actual investors do not frantic buy up, because it pays to keep your eye on the ball. Bailey Gifford, actual investors.
At SAS, we love bold questions because with right analytics, we make data do things like the world safer, faster.
Caution on the part of consumers pulling back on their expenses, which would make this recession a bit deeper. And we have to remember that the context is honestly the U.S. economic activity. We're not going to get a big bailout for progress in this high inflation environment.
So it's hard to get a handle on what's going to happen. It's also hard to get a handle on what's actually happening, especially when you take a look at housing prices. And I go there because Vasiliy Janakis was talking about that being a massive driver of currency differentials and growth next year. I'm looking and I'm waiting for the S&P CoreLogic City Composites. I just wanted you guys.
Can't even say the full name of that data without laughing anymore,
you've absolutely blown it for me. They do need to rebrand. We'll get your view, Greg, on what they should rebrand to. But how quickly is this housing market in the U.S. deteriorating, and how much further do you see it going?
I think it has some further downside in terms of home sales.
Back at the top of the range, so we're at resistance. So hopefully we can see dollars starting to topple over, and in doing so, building on some support on Bitcoin, crypto in general, seeing a nice pushback up into this. So yeah, let's see how things can develop. Yeah, seeing a little bit of weakness, not much. 382 is looking like a very nice level as support if we do kind of break through this level. Previous structure here, support, resistance, to be a nice level to kind of test the support and then seeing an uptick back up in prices. That would be ideal. So we just need to keep an eye on everything and see how things kind of develop here. But yeah, still very much struggling, not really moving with any anger. So we'll see how things kind of play out. Very, very weak sell side volume. Very weak sell side volume. This isn't sustained. So we should see a push back up to.
Over the next 12 to 24 months. If you have built that resilience to navigate this world of uncertainty, then you're going to be better equipped to take advantage of whatever conditions appear over the next 6 to 12 months. It's not about banking on one specific scenario. It's being prepared, resilience on the talent front, resilience on the organizational front, on the pricing front. All of these factors are very important to be able to navigate this highly uncertain and highly volatile macroeconomic backdrop.
What's the one consideration, Greg, heading into 2023? Is it China reopening? Is it the price of energy? Is it the war in Ukraine that really sets some of your base cases?
Well, it's really lying at the intersection of macroeconomics and geopolitics. We are in an environment where when you look at what's happening across the world in China with the zero COVID policy, with the political reappointment of President Xi, when you look at what's happening in the property sector in China, that is having a big impact, not just on China's economic activity, but also on the broader context in Asia. You look at what's happening in Europe, we still have elevated tensions, and that's feeding into the energy complex, that's feeding into the food complex, it's feeding into the supply chain strains. And then when you look at what's happening in the US, you also have this intersection of political developments and economic developments. And all of those combined make this very uncertain environment. So there's not necessarily one pocket of risk that we have to monitor. It's really monitoring the whole spectrum of risks around the world. And the intersection of geopolitics and macroeconomics is really the key to understanding the outlook and making sure you're well equipped and prepared to navigate that environment.
Greg, wonderful catch up with you today, buddy. As always, Greg Daco there of EY Parthenon. Speaking of some of the risks that Greg's talking to, this is from Andrew Hollenhorst, the City this morning. The House, urged by President Biden, will move forward with legislation to force rail worker unions to accept an agreement that includes a 20% plus wage increase over 5 years, after 4 of 8 unions failed to approve it earlier, with the deadline of December 9th and a 60-vote threshold in the Senate. Passing the legislation may be difficult. Lisa, he goes on to say, a potential alternative would be lengthening the cooling off period. This is going to become a bigger story potentially in America.
If rails end up not becoming functional, that will cause prices to surge dramatically heading into year end. A lot of people have gamed this out because this is the main way that a lot of goods get transported around the nation. That is the reason why President Biden is trying to go ahead with this. Very curious to see also the fact that Citigroup is talking about Bullard and Williams both talking about this. I wonder how much they end up really trying to respond to this, or do they end up pulling an Andrew Bailey and trying to basically say, you know, if you guys do that, we're going to have to raise rates even more because, you know, we have to counter the inflationary push.
Yeah, I don't want to hear central banks get involved in negotiations. Isn't that something they've just got to respond to?
I know.
Not give advice about.
Okay, but if you respond to it, right, you're responding to it by raising rates.
Have you seen what some of these guys are running as central banks when they go and do a speech after they've left the Fed?
Oh, yeah.
Have you seen some of the earnings of Bernanke and Yellen post-Fed Reserve?
This is not enough time to discuss this. I know that you have disdain, but how do you?
I'm very happy that people go out and earn money. No problem.
What's the motivation to go into public service if they can't make bank out?
It's not my point. I just think as a policy maker, you're in a good position that you can't see on how much people should.
No, I would agree with that. Everyone agrees.
Thank you. Factories is coming up. Alongside Gershon Distenfeld, Everlast Bernstein, Victoria Greer, G Square, Private Wealth.
Yeah, guys, so we're just waiting for a test. 382 looks like a nice level. Obviously, we've got previous structure here. We've got 200 even average on the area. And then should start seeing a little push back up. Sensing structure here. ahead of a much larger move up to around 17,000. Dollar index is making a push up higher, currently at a order block acting as resistance, as you can see here. But yeah, I'm expecting things to start turning around, especially on the dollar index. Yeah, I don't see this holding too much strength here. Looking for a move to come all the way back down to around 0.6, 0.786 fib. But yeah, we'll see how things kind of develop here. We did just get some CPI from Germany. It's at 10%, went down by 0.4%. Slightly weaker on that end, so it's giving a little bit of strength to the dollar. But yeah, it's not much. It's going to turn around once it's soon, guys. Yeah, as you can see, we're already finding a little bit of support here. Our Market Snipers account, welcome. We are going to start doing these live streams on a daily basis, as well as obviously upload our crypto market update every day of the week, as well as updates on other altcoins. Okay, so feel free to follow us, join the family, and yeah, you can expect updates every single day of the week. So you know exactly what to kind of expect, our outlook on the market, and what we are seeing, and our argument as to which direction or our expectations on how the market's going to play out. Okay, but yeah, feel free to hit that follow button, hit that like button. Obviously, if you enjoy the content, and yeah, we'll see how things kind of go.
Where we at? Oh shit, what am I doing? Don't know, you know. I actually don't know. I just jump aside. There's two pieces of that. Oh! There's an escalation over in Ukraine by the sounds of it as well, so that can start potentially affecting the market a little bit. So I'm holding shorts for now, personally. Let's see. Mass didn't hit. It did. The bot wouldn't tell me that it didn't. You make sure you're trading on futures. Well, surely that's the only way that you're shorting the coin. And then if you want to show you, change yield because it definitely hit on Binance and Biden. Rav, thanks for the likes, mate. Thanks for the likes, guys.
You've heard definitely telling you a recession is coming. It's not here yet, but the check is certainly in the mail. 2/10 that inverted. Fed Fund 10 now inverted with further hikes coming. That tells you a recession.
Right.
Probably
What we get? Yeah.
there will be a recession in the United States, and it probably will happen next year. Matt Isak, Merrill and Bank of America.
Little bit of support. Hopefully we can get an uptick. Yeah.
This is to me one of the most interesting points.
Dollar index is really playing games, so it's getting a little bit of market uncertainty. So getting a little bit of an uptick. So we'll see how things can develop here. I am expecting it to turn around soon. Yeah, I feel like because the markets are running off better than expected CPI, that they're going to start expecting better labour market data. So I mean, there's a whole load of volatility here. I mean, it tested the 0.5, which is a nice level, but I see this turning next.
Protestations where they're basically saying no way, they're not going to cut rates next year.
Nice one, block. So we'll see how things come around.
Where it is right now, bring it back down to 2%. The self-inflation has been a concern, and we've been talking about it all morning, that the short and shallow, is that the new transitory, right? That we're going to basically be able to come out of this quickly because inflation will right-size itself. Yanko was just saying, they basically were just saying.
I mean, as you can see, I mean, crypto's kind of holding. It's not really moving.
So much of market action.
It's still yet to really come to that support level. But even at its current point, it's holding there. So we'll see how things kind of play out. Hopefully we can get a nice wick on bottom. If we can get a nice wick on the bottom, we should see a turnaround soon. A push back up to the upside. So yeah, we'll see how things play out.
Give more buying power to consumers. That's what Evan Brown was saying of UBS Asset Management, that if you give more buying power to consumers come next year, you could end up with a stronger economy than many people had previously expected because they can keep going out and spending. And we heard again from other people that we do have some sort of
I'm starting to hold on to support, especially on the alts.
The Social Security payments as well that are going to be risen, I believe, more than 8% come next year. John, what Jim was just talking about, that stealth inflation. Jonathan Farrow joining us from his other location. It really is interesting and probably underpinning what we hear from so many people about rate cuts next year.
I thought I'd gone away. Just bring back in.
I can't help myself, John.
You know what they think the risk is now? And you hear it from Loretta Mester, and she was speaking to Colby Smith over at the FT yesterday, and it comes down to risk management. And I think we heard it from Chairman Powell in the last news conference. They still believe that the risk of doing too little outweighs the risk of doing too much. And the biggest fear is that they move away prematurely, and you have a flip-flop scenario that Mohammed Arian warned about earlier this summer that takes us back to the 1970s. And I think you heard that loud and clear from Loretta Mester yesterday in the FT when the Cleveland Fed president said the cost of stopping too early are high. We want to be very diligent about this. With that framework, there is risk here, Lisa, and some people are extremely worried about this. This Fed is committed to over-tightening, and some people think they've already gone too far, and we heard that from David Rosenberg about an hour ago.
And Jim Bianco was just referencing that, this idea that under their breath they whisper, it's coming down a lot more, don't worry about it. And that's we keep
There we go, I'm up to support. See what the other markets are saying. Still looking like day. Getting a little bit of downside. Let me get back on here.
Do you think that people are starting to say it a little more loudly, and that there are certain Fed officials that are listening, that perhaps inflation is rolling over faster than they expected?
That's nice support now.
The problem is you don't know, and it could be a one-time thing, or they could be surprised again. And since they were surprised with the transitory that didn't happen, they're going to be much more cautious going forward. But a lot of them have said that there is not only more tightening in the global system than is reflected in the markets,
Very, very, very little sell side volume here. It's not sustained. I'm not seeing it. Seeing a little bit of uptick, but very, very little. We should start seeing a nice rebound.
It's a balancing act too between what the public is going to focus on and what the Fed sees sort of behind the scenes.
The labor market. We get labor market data tomorrow, as well as Jay Powell speaking
Yes,
at
we do.
1:30 p.m. Tomorrow at the Brookings Institute for a panel there. We do get the JOLTS data, which I think is going to be really interesting. And then on Friday, we get the job report. What are you watching most closely? This is something we've been talking about all morning. I mean, people say Jay Powell speaking, but all of the Fed speak hasn't seemed to matter. It has been the data in the front seat for the most part.
Differentiated, I think jobs is going to be important in the sense that people want to know are job openings starting to go away because the Fed's focused its whole sort of policy on the idea that the labor market is tight because there are so many job openings, and we've seen it bounce around a little. So does that really start to change? And then, of course, we get the jobs report, and unemployment is what people are going to be watching because the Fed has said it's going to go higher, and a lot of people who make the case that the Fed's going too far say it's going to reflect, unemployment's going to reflect a lot of people losing jobs pretty soon. The problem with unemployment is it's a lagging indicator, and it takes sometimes several quarters before the unemployment rate really starts to rise. So it may not be a completely reliable predictor this time. And of course, I'll throw in that last caveat that I keep doing is this is a very weird time coming out of this pandemic, and there are no models that really tell us what's going to happen.
Okay, so then perhaps just weigh in quickly on something that you can give a concrete answer on. If the S&P CoreLogic Case-Shiller 20-city composite city home price index were to rebrand, what do you think the rebranding should be to have a more kind of adjustable name?
I still call it Case-Shiller.
So that's what we'll go with. Case-Shiller,
It's been so long. Yeah, that's there. I'm sorry to the S&P folks. I know that they want to get their name on there.
All right, the Case-Shiller. Michael McKee, thank you. Rejecting the rebrand and debranding. Coming up on Balance of Power on Bloomberg TV and Radio, Mary Kay Henry, International President of the Services Employees International Union, a fascinating conversation at a moment where there still is this question of whether that agreement that President Biden is urging will get passed through Congress to bring all the unions to the table. Citigroup's Andrew Hollenhorst raising questions about whether he has enough support for that agreement that includes a 25% wage increase over the next 5 years. In markets, we do see a bit of softening in futures coming off the earlier highs. 39.67. This is Bloomberg.
Right, so we're holding on to some support here now. Let's see if we continue. In time, we should see a nice build up a structure, then a push back up. So to hit resistance, got some nice resistance here at 107. Career Patrol, just get a nice turnaround. Let's see.
Wood is a resource, but also provide clean water, wildlife habitat, recreation opportunities, and a source of living wage jobs in rural communities that align positively with ESG frameworks and the UN Sustainable Development Goals.
Great food straight to your door. Download the Deliveroo app now.
Right, we're seeing a little bit of uptick now. Let's get it. Still could see a little bit more downside, a little bit more as dollar index pushes towards this order block here. Could see a little bit more downside with a nice little wick on the bottom. Yeah, we'll see how things could still get a bit more of a test. But as you can see, we're holding on. So let's see how things hold up.
Live from New York City this morning. Good morning for our audience worldwide. Equity futures just about unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Yeah, we're going to get a little bit more downside by the looks of it, just a little bit more, which is fine. If we can get a decent reaction, that'll be nice. So we'll see. Yeah.
Now inverted with further hikes coming. The inversion is coming from the long end of the curve. The yield curve is definitely telling you a recession is coming.
We will have a recession. The 3 months to 10-year tells you that.
Right now, we respect that signal. You're supposed to watch the yield curve. It's inverted in almost every area. It's the market telling you something. The market is perceiving that the Fed is going to have to over-tighten and really send this economy into recession. The Fed may be vulnerable to going too far here. The market believes that we're likely entering in a recession.
It's not here yet, but the check is certainly in the mail.
The check is in now. Rodriguez and Gershon, distant out of AllianceBernstein. Tony, what how much signal is there in that yield curve?
Good morning, Jonathan. Good to be with you. I think it's a very strong signal and one that certainly we and I think the markets need to take very seriously. No matter what curve you look at, 2s, 10s, bills, 10s, 3 months, 18 months forward, which Fed likes to look at, all are inverted. I think all are sending the same signal. Our view is we are likely to see a recession. I think really the more important discussion is around how deep and how long that recession may be. We have to be in the camp that it's going to be a relatively mild and short recession, and of course that changes the dynamics of the construction. But it is a very serious signal, and we think an accurate signal.
Gershon, do you agree?
I think Tony said something very insightful there. I think we all believe there's going to be a recession. No one has said investors look at Bank of America last night. Everyone thought we were going to do a recession. The question is, how deep is it going to be? But I also feel a little bit differently. I try to be a little more positive than the Fed is, at the end of the day, going to be successful with inflation. Because if the market felt like they weren't, that we're going to have persistently high inflation, you would see long-term rates a lot higher. I try to touch it a little more favorably.
Well, the question is, Gershon, what cost? What cost would it take in GDP to get inflation back towards target?
That's an open question. That's what the Fed is really trying to debate here. We're all sitting and trying to figure out if they're going to go 50, 25 the next move. You can make it, either way, either can. You can say we know that monetary policy works with a lag, therefore we should keep on going. We should pause because we're going to overdo it. On the other hand, the Fed's credibility is at stake. What we think is going to be much more important is not what they do now. It's do they have the discipline to hold rates? Right, the market is now pricing in, or has been pricing in for a while. Rate cuts at the end of 23. Is that a mistake? That was a mistake that was made in the 80s. The Fed ended up cutting rates too soon, and they had to jack rates up tremendously. I'm not suggesting we're in the period of the 80s right now, but that's a dilemma the Fed's going to have. They're going to have to weigh the data that comes in, both on the inflation side and
risk management. The Cleveland Fed President, Loretta Mester, speaking to the FT yesterday, I've quoted her a few times. She said this: "It's very easy to be caught out by the good news, but we don't want wishful thinking to take the place of really compelling evidence. The costs of stopping too early are high. We want to be very diligent about this." Tony, does that quote tell you to this yield curve?
We're going to let the market play out. We'll be back. We'll leave the stream open. But yeah, we'll be back. Just 15-20 minutes. We'll be back in 15-20 minutes.
I think really what the quote tells me more is that the decision the Fed is going to make about holding rates at a high level, whether that's a 4 3/4 to 5% funds rate or a 5 1/4 to 5.5% funds rate, it's going to be about holding it throughout 2023. Right now, we think the markets are maybe a bit too either optimistic about the Fed pivoting or pessimistic about how deep the recession will be, therefore causing the Fed to pivot sooner in 23. So we think the pricing for Fed cuts in the second half, fourth quarter of 23 is a little bit too optimistic. Our base case would be that at the earliest you would see a Fed cut would be at the very end of 23, but it's more likely to be a 2024 scenario for Fed cuts, that they will be patient, given that we think they're going to need to be because inflation is going to be sticky throughout next year.
So, Tony, let's talk investment implications. You said two things in the last 5 minutes. One, you said recession short and shallow. Two, you said the Fed and Fed funds could stay high for a whole lot longer than people think. So what are the investment implications of a Fed that stays at, say, 5% through next year? At the same time, we get a recession, even if it is short and shallow.
Sure. So, John, I think there's two implications primarily. One is with respect to how you position for rates. And our view is that at the long end, rates have really made the majority of the move. We don't expect to see much higher rates than where we are today, and we expect to see lower rates than where we are today in the long end of the curve by the time we get to the second half of next year. So we think you can be comfortable around taking rate risk at this point. When it comes to kind of risk assets and spread risk, there's where I think there's also a message being sent that we think it's okay, given that shallow recession and strong corporate fundamentals, to be in investment-grade credit and the higher quality segments of below investment-grade sectors like high yield, leveraged loans, emerging markets, where we think you need to be careful because of that. Holding rates for longer is in the very low quality end of all of those higher risk, higher volatility segments of the market.
We'll pick up on that theme in just a moment. Equity futures right now just about unchanged on the S&P 500. We're positive by a couple of tenths of 1%. On the Nasdaq, that move sticks just about up by 0.2%. Ton of Fed speaks still to come this week, including Chairman Powell tomorrow. Then on to payrolls on Friday. Mike McKee, you'll be breaking it down for us.
Yeah, and John, you give speeches. You know what the instructions are for framing your message. You tell them what you're going to tell them, and then tell them what you told them. And that's pretty much where we are with the Fed. You go back to November 2nd at the press conference, Jay Powell came out and said the ultimate level of interest rates will be higher than previously expected. Well, it's been almost a month now, and the message is still the same. Not a massive change, but somewhat higher, John Williams said yesterday, endorsing that view. And Jim Bullard said the FOMC will have to be more aggressive rather than less. So what is it that Jay Powell can add to the conversation? Probably not a whole lot. The market has pretty firmly priced in the idea of a 50 basis point, half a percentage point move at the December 14th meeting. And it's unlikely that Powell will dissuade people from that. The question is, does he give any advice about that terminal rate you guys were talking about and how long they'll hold it there? Williams yesterday saying throughout 2023. Now, what could change the market's minds between now and December 14th? Economic data, and there's some serious data coming out tomorrow, Jolts. The Fed's whole argument has been that the labor market is tight because there are a lot of job openings. Is that still the case? PCE inflation is what the Fed follows, and it's going to come down in a different way than CPI because housing isn't such a big deal in PCE. The jobs report we're talking about now, a lot of people are going to look at the unemployment rate, but that's a lagging indicator. You can go many months before it starts to rise when the Fed is in a tightening cycle. CPI, that's going to be the one that gets everybody's attention. It's the day before the Fed decision is announced. Unfortunately, it's the day before the Fed's decision's announced. So we won't know from anybody at the Fed what they think about it until we get that 2 p.m. December 14th decision. One interesting thing, and since you quoted the Financial Times, I want to point out one piece today by Robin Wigglesworth, who, by the way, has a great cartoon in connection with this, and it's worth looking at. But basically saying, what if we do have a recession? We've had them before, and everything turned out okay. Interesting question.
I love Robin. He's great. He didn't fit Team USA in there, Mikey, on the calendar. I thought it might fit in later on this afternoon.
Well, I think we got to get through this afternoon for it to be relevant by the time we get around to the next Fed meeting.
Fingers crossed. I think we can make it happen. Mike McKay, great to catch up with you, as always, sir. Gershon, I want to come back to you about the economic data of the markets. Do you think there's a bit of a disconnect right now between what you're seeing in, say, the PMIs and what you're seeing in spreads?
Yeah, no doubt. But what I want to say, I'm glad that you're reading the USA, John. I don't know who you were rooting for last Friday, but I'm very happy you're reading USA.
I'm on board. Totally on board.
Okay. Well, us USA people, we're soccer fans once every 4 years. Anyway, yeah, I do think there's a disconnect. Especially, you mentioned the PMI. Exactly. The PMI actually has one of the highest correlations to high yield spreads. And a PMI of just north of 50 is indicating that we're likely to go into recession. And spread probably should be wider given that. So you know, John, that I'm a long-term bull on high yield. I do think that these levels, given the starting point, we're going to have some pretty attractive returns coming up. But I have some concerns in the near term about spreads in this marketplace, and do think we can go wider in the short term.
So you don't think PMIs improve here, Gershon? You think it's spreads that have to give?
Well, I should have captured that, John. You're right. If we don't see PMI improve something, there is a disconnect. So if PMI does improve, then the spreads are supported. They need to go tighter. I was making the assumption that we weren't going to see PMI improve.
When you see the time horizon of, say, 3 to 5 years, is that what you're talking about, Gershon, to make this work now, to buy now and wait for that kind of time period? What's your time horizon for that trade?
I was thinking a little bit shorter, John, maybe a 1 to 3 year period, but you do make a good point in that 5 years is actually a good time horizon. It's a little bit longer than the duration of the high yield market. We misuse duration and big things up. You think it means all sorts of things. What it really means is how fast does my portfolio turn over? And that means that you should earn your yield over time minus any losses that you're going to have. So we're starting with yields of 9.5%, let's call it. And let's assume some really drastic losses. I think it's one that's what I'm expecting, like a 5 or 6% default rate, 50-cent recovery. You're still looking at 5 to 7% return. So yeah, I do think the long-term investor is going to be rewarded here, but there's going to be continued volatility in the short term.
Tony, final word on this one?
Yeah, so I agree with Gershon on two of those notes. One is that we do think that there are going to be better entry points over the next 1 to 2 quarters. So we do think spreads need to widen to reflect the PMI data and the weakness that we're expecting in the economy. And we do think that at that point, it will be a very attractive entry point for credit risk. And if you take it today, we do think that over a 1 to 3 year horizon, you will make money. But we do think there'll be better entry points with wider spreads over the next couple of quarters.
Hey, Tony, stick with us. Tony Rodriguez alongside Gershon Distenfeld. Coming up on this program, strike risk threatening to undo Biden's rail deal.
I am very pleased to announce a tentative labor agreement that we reached between the railroad workers and the railway companies. This agreement is a big win for America.
The tone has changed down in Washington since then. That conversation up next.
What if you were a global energy company with operations in Scotland, technologists in India, and customers all on different systems? You need to pull it together. So you call in IBM and Red Hat to create an open hybrid cloud platform. Now data is available anywhere securely. And your digital transformation is helping find new ways to unlock energy around the world. Let's create a hybrid cloud that can change an industry. IBM, let's create.
I am very pleased to announce a tentative labor agreement that we reached between the railroad workers and the railway companies. This agreement is a big win for America and for both the American people.
Down in Washington, D.C. Anne-Marie, how tense is this one getting?
Well, it's getting very tense, but Jonathan, we need to remember when the president was speaking in September, I was there in that Rose Garden announcement talking to some of the both sides with the union and the companies. The fact is it was tentative. That was the key word, a tentative agreement. You have these labor unions that needed to sign off on these 13 agreements. 12 agreements were signed off on them, 4 were not. And what the heart of this issue, when it comes down to, is sick leave. These workers want paid medical leave, but right now it's a tricky moment for the president. A key part of his statement last night I want to bring you is he says, as a proud pro-labor president, I am reluctant to override the ratification procedures and the views of those who voted against the agreement. But in this case, where the economic impact of a shutdown would hurt millions of other working people and families, I believe Congress must use its powers to adopt this deal. So the president leaning into the fact that this would just devastate the U.S. economy if there was supposed to be a rail strike, and he wants Congress to override the fact that some of these unions voted down these agreements, and he wants to make sure they can avoid this strike.
At 10:30 Eastern Time, interesting meeting just dropped on the calendar, didn't it, for the president a bit late this morning?
Yep, that's right. We just got word from the White House that the president's going to be convening with leaders of Congress. Likely, this will be number 1 on the list, along with a number of legislative issues that this administration wants to see get done before they lose control of the House come in the next Congress next year. So that would be 1, funding the government, Jonathan. Don't forget, we still have to fund the government. The stopgap funding measure, that's going to be ending in December. On top of that, they want to get same-sex marriage laws passed, potentially some election laws passed, but for them right now, really key is going to be making sure they can avoid this rail strike.
Wall Street weighing in on this already. Andrew Hollenhorst of Citi, Anne-Marie, had this to say a little bit earlier this morning. I'll read the quote for you. The House, urged by President Biden, will move forward with legislation to force rail worker unions to accept an agreement that includes a 25% wage increase over 5 years after 4 of 8 unions failed to approve it earlier. With a deadline of December 9th and a 60-vote threshold in the Senate, passing the legislation may be difficult. A potential alternative would be lengthening the cooling off period. Anne-Marie, can you help us frame just how difficult it would be to get over that hurdle?
Well, there are some Republicans who are going to agree with the president. They want to avoid this as well. They realize that this can be devastating for the economy, especially inflation is high. This is still top of mind for everyone's voting memberships, right? All their electorate, as well as the fact, Jonathan, that we're going into the holiday season. But you also may have, that's a Republican side that may come and join this, and likely many will. But then you have progressives from the president's own party who are going to want to line up behind workers' rights and say that even though they're getting wage increases, the fact of the matter is these individuals are asking for sick leave, especially when you talk to labor workers. They say we were there during the pandemic and working during COVID when most people were working from home. They kept the economy really running. So you're going to have progressives like Senator Bernie Sanders potentially wanting to vote against this unless there's any movement on sick leave.
AMH, great work as always down in Washington. great to have you back in the seat as well. Look out for our conversation with the Labour Secretary, Marty Walsh, a little bit later this week. Due to catch up with him on Friday, typically catch up with him around payroll. So waiting for that to be confirmed, but expecting that conversation to take place, and a big conversation around negotiations with unions, not just over rail, but also on the West Coast at certain ports as well. Looking ahead to payrolls Friday, the estimate in our survey so far, moving target always is, but at the moment the median in our survey is 200k. The previous number was 261,000. Tony Rodriguez and Gershon Distenfeld is back with us. Tony, I want to come to you on that. Your expectations for this labour market going into next year?
So we expect to see some softening in the labor market, but we don't expect to see a real collapse. And I think that's kind of what the Fed is hoping for in their own soft landing scenario, is that ideally they would see the softening of the labor market come more from a reduction in job openings, for example, and that would help ease some of the wage pressures. Because the ideal scenario for the Fed is that as we move into the middle of next year, that you'll have inflation coming off such that wage gains, while not increasing, can be above inflation, so that we'll actually have positive real wages. So that's the ideal scenario. We do think you will see that softening of the labor market. We're just not quite as confident that it's going to be the soft landing to the labor market and avoid a recession, hence our base case of mild recession kind of in the middle of 23.
Tell me, how instructive do you think job openings data is, Joel's data? Now, I understand it matters because it matters to the Fed, so of course it matters to us for that reason. We want to understand what it means for policy. But tell me how instructive you actually think it is. Do you think it's a decent reflection of what's happening in this labour market?
You know, Jonathan, I would say that it's a mixed story. So I don't think it's as important as the Fed has given it importance as a result of Powell's speeches and his focus on the number. However, I do think it does give us some useful information about job openings that are out there, and hence the demand for labor exceeding the supply. So we look at that, we look at the labor force participation, and then we actually look at the job gains that we're seeing from companies in the monthly labor report. I would say that the actual job gains is still more important, so you can't completely dismiss the JOLTS data.
It's the $1 trillion question, isn't it, Gershon? Can you rebalance this labour market without sending unemployment a whole lot higher from here?
I think the answer is no. And the question is just how much. I must be an outlier here because I actually don't think that the numbers we see this month or even next month are all that significant. We know monetary policy works with a lag. We only got to 2% of the Fed funds rate in August, 3% in October. So, and that's not very restrictive. I think the real thing, I know markets are going to focus, you have to focus on the data you have in front of you. What's going to matter is as we get into the first quarter and the second quarter, what's that going to be? And that's the dangerous game the Fed is playing right now, and they have no choice, is they don't know what the right terminal rate is. They don't know how far they're going to push. We don't get instant feedback on that. It takes months, if not maybe a year sometimes, to see that. And so it's a guessing game. It's a little bit of feel. I know markets don't like that. Markets want certainty. Markets are going to parse, every bit of data that comes out. But the fact is that monetary policy works on a lag. It just limits how much we actually know about what's happening right now.
And Gershon, to make it even more problematic, the one place they get instant feedback from is the market, and financial conditions have been easing. Doesn't that just mean they double down going into next year?
Yeah, maybe, John. I'll tell you what I'm looking for. And I thought we were getting a little bit of it yesterday morning, but then it quickly reversed. We've been in this pattern for the past almost year where we've seen the correlation between equities and treasuries break down. Normally when equities are selling off, treasuries are rallying. And we know why it happened, because of inflation. When we start to get a more of a normal environment where bad news means that the long end of the curve rallies, that's when we know that we're probably in a better scenario. To the discussion we had earlier, I think that the yield curve could get even more inverted because the Fed is going to have short-term rates high, so short-term rates have to be high. But the market will be convinced that it's going to cause a significant slowdown, and you're going to see long rates rally. I think that's the signal that we need to look for in markets.
Some Amazon debt on sale today as well. We'll talk about that another time. Tony Rodriguez and Gershon Distenfeld, to the two of you, thank you. Off the back of that announcement, yields a bit higher in treasuries. 10-year yields higher by 7 basis points. The 2-year up by about 3 basis points. Equity futures this morning unchanged now on the S&P 500. Coming up in the morning calls and later, Goldman, Deutsche Bank, Barclays, all sounding the alarm on the equity rally. G Square's Victoria Green echoing that view, expecting the S&P to hit a low at 3,200 potentially in Q1. More on that conversation around the opening bell.
Forests are the current, dominant carbon offset solution. Carbon remains stored in building materials even after harvest. Working forests not only provide wood as a resource, but also provide clean water, wildlife habitat, recreation opportunities, and a source of living wage jobs in rural communities that align positively with ESG frameworks and the UN Sustainable Development Goals.
Away from the opening bell this morning. Good morning to you all. Just about positive on the S&P and just about positive on the Nasdaq, up 0.2%. As the price session, let's hear some morning calls this morning. Kicking off first of all with KeyBank downgrading Roku to sector weight, pointing to recent market share losses and a street's overly optimistic growth outlook. Your second call from Deutsche Bank running UPS to buy 220 price target, expecting a new initiative to drive positive revenue growth. Their stock is up by 1.7%. And finally, Bear downgrading Darden Restaurants to neutral, highlighting the stock's recent outperformance in a challenging macro environment. Coming up, Wall Street pushing back against the rally. G Square's Victoria Green expecting stocks to make new lows as the relief rally fades. That comment.
Why do we get up in the morning? We'd say to pass on what matters.
Tuesday morning, good morning to you. About 20 seconds away from the opening bell, equity futures look like this, just about unchanged on the S&P 500. On the Nasdaq 100, up by not even a tenth of 1% going into the opening bell. Now on the Russell, the small caps, pretty much unchanged as well. From New York, your opening bell just about to ring. There it is, into the bond market. Treasury yields looking at something like this on a 10-year, higher by 6 or 7 basis points. That turnaround in the last hour or so. There will be a multi-bond deal coming from Amazon a little bit later. We'll give you the pricing of that when we get it. Euro dollar 103.30, negative a tenth of 1%. Some better news for the Europeans, I guess. Softer CPI out of Spain. Things easing up a little bit out of Germany as well, relative to the previous month. The next off the ECB, December 15th. Crude looks like this, 78.76. We're positive there by about 2%. On the S&P then, about 25 seconds into the session, we are negative by just 0.04% on the S&P. On the Nasdaq, we're positive by just 0.03%. Wall Street casting some doubt on the recent rally. Goldman Sachs warning that stocks aren't accurately pricing in the risk of recession. Katie Nice has more. Hey, Katie.
Hey, John. Well, the recent rally has really been over the course of the month of November, but really it goes back to October 12th. Since we put in that low, the S&P is up more than 10%, about 2% of that coming in the month of November. And actually, since the NASDAQ 100 reached its low early this month, it's up about 8%. So likely some degree of support provided here by the fact that the 10-year yield is 26 basis points lower today than it was when we started the month. It actually was on pace for its biggest monthly drop since March 2020. So that rally in bonds has been much more substantial than the one for stocks. But inevitably for stocks, we have a chorus of voices saying that this rally is overdone, including Barclays, which said it's just seasonal. It's mainly driven by short covering. And Goldman, as you mentioned, saying that stocks are not accurately pricing in the risk of a recession. They say there's about a 39% probability of a slowdown in the U.S. in the next 12 months, while risk assets are only pricing in 11%. So they prefer bonds over stocks overall, and expect the S&P is going to end the year just above where we are now at 4,000, which is the median consensus on the street. The average is actually about 2% lower at 39.31, and there is a lot on the street who think we could go even lower on the way there. Vicky Chada over at Deutsche Bank says we'll see a drop to 32.50, which is 19% below current levels in the third quarter as the recession begins. Morgan Stanley saying to drop by as much as 15% by March because of QT, and Bank of America also expects the S&P will put the bottom partway through the year and then rebound to end basically where we are now by the end of 2023. And at Bank of America, they are differentiating within stocks in terms of market cap. They like small caps here. Joe Carey-Hall and the team noting that those smaller stocks are already trading at recessionary multiples, and therefore they think their downside next year looks a lot more limited relative to large caps.
Katie, I'm doing a survey. Does a college football loving Katie Lyons watch Team USA a little bit later?
Yes.
Oh my God.
I think it's during my crypto show.
Is that about how enthusiastic you can be? It's not. Your crypto show will finish by then.
Okay.
2 p.m. Eastern.
I prefer U.S. football.
Katie, go.
NFL.
Okay, forget I ever asked. Katie Lyons, thank you. You've been warned. This is about to get very bearish. Listen to this quote from Victoria Green at G Squared. The relief rally is petering out, and we're still in the bear market. We've had 4 of these bounces prior to this one, but still hitting lower highs, which will lead to lower lows. We're looking for the S&P to hit 3,400 to 3,200 before getting excited. Victoria joined us now. Victoria, that could be 20% away. Can you walk me through what's going to take us down to those kind of levels?
Well, sure. I mean, it's all about the earnings math and where we are with multiples. Yeah, the market came down, but earnings came down as well, so you're really not that cheap. So we think there's another shoe to drop here. We think seasonality got pulled forward a little bit, so we got an early Santa Claus rally. You know, it's kind of like Mariah Carey and Thanksgiving. Christmas is happening earlier and earlier. I think the Santa Claus rally's already happened. So I think there's a lot of risk right now in the markets. We didn't invalidate the chart. The dollar bounced off. You know, I know that right now everybody on the street is fashionable to say dollar bull is done next year, but right now the dollar's still on an uptrend. The market's still in a bear market. We haven't invalidated the pattern, and when you see this pattern, we did this summer. From June to August, we went up 17% and then came right back down. Every time we put in a lower high, which you saw us hit these resistances and bounce off of them, I think that gives more fuel to the fire. This is a traditional bear market rally, and there's still downside risk.
We'll get deeper into the equity story in just a moment. You brought up the dollar. What's the dollar in uptrend again still? Euro dollar has gone from the lows of the year from about 95 at the end of September to 103. Cable sterling's gone from 103.50 intraday back at the end of September to 120. What's it in an uptrend against?
Well, we're still going to see tightening rates, and I know maybe the Eurozone with the inflationary picture over there is possibly going to be more hawkish than we are, but listen to what the Fed is saying, especially Bullard. I know he's the uber hawk on the street, but as long as we're still tightening, as long as we're still raising rates, as long as the dollar is the place to be in the safe haven, I think you still see support there, as well as we bounce off that 200-day moving average. So again, you're not invalidating any patterns yet. So yes, there is some pressure. You've seen a lot of calls recently this week on the street saying this era of dollar bull is dead. I think it was JP Morgan and Morgan Stanley saying that, and we need to look at emerging markets and the euro currencies. But if I look at the Eurozone and how much trouble they're in with inflation, I'm just not excited about buying the euro yet.
And that's what we've had overperformance in European equities, up by more than 20% since the end of September. These relief rallies, they get sold and they get sold again, and we keep waiting for a Fed pivot that doesn't transpire. Victoria, Bank of America and Savita Subramaniam, I think on the same page as you, near term. Longer term, the end of 23, they look for 4,000 on the S&P 500. They have this to say, though, on EPS cuts. That's where the near-term pain's going to come from. For 2022, it was all about the Fed. 2023 is all about the real economy. How bad do you think, Victoria, these earnings are going to be relative to what you think the street is looking for?
Yeah, I think fourth quarter is going to come in light. I think FactSet was estimating that this is going to be the first year-over-year decline ex energy and quarterly earnings in Q4. So I think there's still a pullback. Where that EPS number ends in 23, I think that's the wild card. You know, Bank of America has it at 200, I think, along with Goldman. Morgan Stanley's at 195. Ardini's up there like 325 or 225. Sorry. And where we end up, that 200 to 225, put a 17 handle on 200, and that's looking a little bit dicey if we're going to hit that 4,000 mark, because that comes in well below that. You're looking at 3,500 for a 17 multiple on a 200 earnings. So I think EPS is at risk. You know, the consumer, we're all watching these data points this week, and how healthy is the consumer? And one argument I've been making is the consumer necessarily isn't spending more because they want to. They're spending more because they have to, because of inflation. So your basket of good costs more. So yeah, we're celebrating large Black Friday numbers and the $9 billion spent by consumers on Black Friday, but that wasn't necessarily because they were buying more. It's just that they pay more for their basket of goods. So I think you need to watch, you know, these data points. You know, I don't think the Fed right now. I think we're excited about, you know, we're looking for a slowdown. We've gone from pause to pivot to slowdown to any type of good dovish rhetoric, and it's just not there. I mean, we'll be interested what Powell says tomorrow, but Bullard, you know, you got your Fed speak this week that says we are hawkish. We are going to stay above 5% through 2023, and that's not what the market's pricing in. So now you have a disconnect, which is dangerous. The market's pricing in some cuts, right? We're seeing that 5.25 terminal rate, and then if you look at what the market's pricing in with swaps, you're seeing that tail off at the end of 23. If that disconnect from what the Fed does, that can be very painful.
You hate the index then. Let's talk about what you like. And that's big, old, ugly cash cows. Let's talk about a few of them. JP Morgan.
Yeah.
JP Morgan, how does JP Morgan work going into next year, given everything we've just said?
Yeah, so one of the things I look for is strong leadership right now, because this is no longer a rising tide lifts all boats. This is something that you need a CEO and a board of directors who understands you may need to be decisive, you need to do cuts, you may need to reorganize. And I do actually really believe that Jamie Dimon has that. So we think JP Morgan has a quality balance sheet, exposure to more affluent consumers, which right now we do think that Wall Street may perform a little bit better than Main Street. And so we think they're well positioned. They've got a strong dividend. And I'm just curious what he'll say before earnings. Because the last two times before earnings, Jamie Dimon's come out with these like draconian statements about how terrible it'll be. And then JP Morgan does great.
Then
So
we
I
have a
think
very different
everybody will
earnings call. I think we've all experienced the same thing. The tech question is the one I wanted to squeeze in as well with Victoria. Amazon's down almost 70% year to date. Facebook Meta's down 67%. You've got that confidence in the likes of Jamie Dimon. Do you have the same confidence in Jassy, in Zuckerberg?
No. I think they're just off on a exactly. Let me sugarcoat it for you. No, I think they're also seeing their companies have to change and pivot, and that's a harder position for a CEO. Facebook is or Meta, sorry. As you can tell, they're still figuring out exactly who they are and where their future earnings are going to come from. Amazon with the retailer versus AWS, and then also then you have your media section. These companies are changing in real time. That is harder for a CEO to manage, and it's harder for us to understand expectations for earnings when your earnings are no longer as steady, and we may see new streams become more important and old streams begin to deteriorate. So I think it's not only the CEOs that are under pressure, but their businesses are changing at a very difficult time, which makes forecasting harder. I want earnings today. I'm less excited about earnings tomorrow. So I think they're under pressure. You've got the advertising issues with Meta, and we'll see what that company comes into. And social media to me is so fickle, because as soon as you fall out of favor, then it almost becomes this like snowball effect that everybody hates on you.
Final question, Victoria. I couldn't get Katie Knight to watch Team USA a little bit later. I know how much you love college football. Can I convert you this afternoon?
You can convert me for USA Iran. Go USA. I mean, we got to win to get to the knockout stage. But I will put a nice cheer in for you versus Wales. You deserve it. You tried very hard in our match.
Victoria, you're welcome back anytime. You know that. Victoria Green, going to catch up as always. Thank you. Let's get you back to the broader market. 10 minutes into the session, equities look like this on the S&P 500. We are just about positive by 0.03% with some movers. Here's Abby.
Hey, John. Well, things are moving quickly this morning, as they are on many mornings. So we switched it up from Big Tech, Apple, and Tesla. And of course, an interesting battle shaping up there between Apple and Elon Musk. To the top two sectors on the day, ExxonMobil and Chevron. Energy, of course, both up more than 1%. This is oil rebounds to some degree. WTI crude just below $80 a barrel, so perhaps less fears around the China situation and the idea that there could be a reopening. And of course, Freeport-McMoRan up 3.3%, the materials company. China is the world's largest user of natural resources, so lots of grain here. As for China tech, we're seeing a rally. That was so interesting yesterday, of course, with lots of concerns and weighing on U.S. stocks. But China tech yesterday rallying today, that's the same deal. Bilibili, the online entertainment company, up 20%. Great quarter following in the footsteps of Pinduoduo yesterday. We have a bit of a bounce for Bitcoin as well, and some of the other cryptos. So we see Coinbase Global getting a little bit of a bounce, up 1.5%. Now, it's interesting, you all were just talking about Black Friday, Cyber Monday. Cyber Monday record 11.6 billion in sales, 8.5% growth. Etsy a little bit higher, Amazon a little bit higher, and maybe Amazon also being weighed on by that 5-part bond offering that you were talking about, the second of the year. Investors trying to figure out exactly what's going on there.
I bought some coffee table books, 30% off. I think that means I'm getting old, Abby. Abigail Doolittle, thank you. Coming up on this program, Chinese stocks surging on reopening bets.
China, the path is bumpy, leaving zero COVID, but the destination is reopening. I mean, they're going to have to reopen.
That conversation coming next.
People are always talking about the future of work, but we're living in that future. Collaboration enables teams to respond much faster and act more decisively. By adopting the right technology, leaders create structure for their organization and empower their workforce to achieve key objectives. It improves efficiency, employee morale, and reduces quit rates. So, in the long run, technology is really everything.
China, the path is bumpy, leaving zero COVID, but the destination is reopening. I mean, they're going to have to reopen in order to make sure that the economy just doesn't completely fall apart. The current situation is unsustainable in China.
China pledging to boost vaccinations among seniors in response to growing protests over COVID restrictions. Health experts saying the move is critical to reopening the economy. The policy shift triggering massive gains, with Chinese markets set for their best month in years. Team coverage starts right now with Bloomberg's Alan Wan in Shanghai. Kenny Knight here in New York on the price action. Alan, for you, can you run us through point by point what was announced today?
Well, first I got to say, I heard about the 3 p.m. briefing this afternoon, and there was a lot of excitement. The markets went up, and I was a little bit surprised because, we have these meetings, pretty much every week, right? And they haven't really said much in the past, just reiterating sticking to COVID zero. But this time, I would say investors got a little more than they expected, especially since this is the first time the health body spoke after the protests over the weekend, and it sounded quite conciliatory. There were 4 major points, and there was a big focus on vaccination for the elderly, which has been the biggest obstacle towards a reopening. And this time, the government basically is going to take in more excuses. They're going to try to strongly encourage the elderly to get vaccinated. And if they're not going to do it, they're going to have to explain why. They're going to use stuff like big data to see, who among the elderly needs to get vaccinated. And then another major point was they try to reduce people's fears about the virus. You got health officials saying how, how they had science explaining how the Omicron and its variants weren't as dangerous as people had feared. And the third major point was the health officials tried to minimize the impact of the virus on people's lives. And number 4, I think this is key. The government said that the local governments have been taking lockdowns too far, and the 20 points, the 20 measures that were announced earlier this month for more loosening have not been implemented. And so investors are really excited about this. And one economist told me that he was pretty pessimistic heading into this briefing, given what happened over the weekend. But now he's more optimistic because it sounds like the government is finally listening to the people. That is actually public debate about what's going on, and they didn't try to shut people out.
Alan, as an observer from the outside again, it's been unusual to me to see how the conversation around vaccine mandate has gone in a country like China, with an authoritarian state not going forward with it. But in America, in a democracy, we had a government that went through with some form of vaccine mandate. We had companies adopting the same thing. Alan, what's held back China from doing the same thing?
Well, I think that it was a big focus on the elderly, right? The government tried to encourage the elderly to take the vaccine. They offer all kinds of money and all kinds of, even household essentials, and they wouldn't do it because they were afraid of the possible side effects. But now the government recognizes that this has gone on long enough and they need to do something. I believe that 2/3 of the elderly over the age of 80 haven't
in fact, fully vaccinated. That's a lot in a country of 3 billion.
It's a massive number, that's for sure. And clearly, off the back of some of the announcements that were made today, Alan went through it point by point there, KB. This market's off to the races again.
Yeah, it was definitely true in Asia overnight, where stocks were roaring higher, and it's following right through to the ADRs of some of those big Chinese technology companies here in the U.S. Overnight, you had the Hang Seng China Enterprises Index up more than 6%, the Tech Index up nearly 8%, and as a result, the Nasdaq Golden Dragon China Index here in the States is up about 5.5% in the first 20 minutes or so of trading, adding on to a gain of nearly 3% from yesterday, with individual names like Alibaba and JD.com up in the ballpark of 5.5 to 8 or so percent. That said, there is still a long way to go for these stocks to recover the ground they have already lost this year. JD, for example, has had $31 billion wiped off of its market cap in 2020. For Alibaba ADRs, that number is $121 billion, and it's $221 billion for Tencent. So it has been absolutely brutal as these stocks have gotten hammered, not just by the COVID-0 policy, but also regulatory concerns, both from Beijing and here in the U.S. Now, of course, all of that has applied to the Asian listings as well. Clearly, optimism about the reopening of the Chinese economy has driven the Hang Seng China Enterprises Index to absolutely crush it this November. It's up 26% this month, its biggest monthly rally since 2003. But we have seen this before, and then we've seen complete reversals of those rallies. There's been multiple times in which this index has rallied 20% plus, and then that gain has evaporated. So the question now is, will this time be different? Can these gains actually be sustained? A lot of that is going to hinge on the COVID headlines coming out of China.
Kelly Lyons, what a roller coaster it's been. Reopening on, reopening off. Kelly, thank you. And a special thanks to Alan Wan over in Shanghai as well. Fantastic coverage from him over the last couple of days. In the equity market here, stateside, 21 minutes into the session, we are down by just 0.1% on the S&P. On the Nasdaq, a similar move. In the bond market, yields higher. Through the curve, 2s out to 30s, up 4 basis points on a 2-year to 4.48 on a 10-year. We are higher as well by about 6 basis points or so. 3.74 on a 10-year this morning. Let's get some sector price action. Here's Abby.
With that very small move for the S&P 500, John, not surprisingly, we're not seeing so much drama here sector-wise. The top sector on the day, energy up about almost 1%. No sector is moving 1% up or down, a true 1%, I should say, as oil does rally again. WTI crude, as I was mentioning earlier, close to $80 per barrel. Probably some hope around the idea that China is reopening. We have real estate, materials, financials higher, tech, the mega cap tech sectors, they're all kind of in the middle, down about 0.3%. No big deal as rates rise a little bit. What I do want to hone in on, we're going to do China Tech. Kelly just did a fantastic job of outlining that rally. Let's take a look at an unusual move here because we have rates higher. Typically, that would press both real estate and utilities down. Today, utilities acting as they should. The dividend is looking less attractive as rates go higher. But real estate, it is higher, John. It's not really entirely clear what's behind this, but most of the rates in that sector are up. And overall, that sector up about 0.6%. Highlighting this because we've had so many strange moves on the year. Here's one of them on the day.
Abby, thank you. Thank you very much. That's the equity breakdown. A little bit earlier this morning, I mentioned that Amazon was kicking off 5-part bond sale, the second bond sale of 2022 from Amazon. Earlier this year, back in April, they sold bonds in a $12.75 billion deal. We understand the target size of this offering is $7 billion. That could change according to a person familiar with the matter. The 10-year security, that would be the longest portion of the offering, may yield 1.15 percentage points over treasuries, again, according to a person with knowledge of the matter who asked not to be identified as the details are private. Any more details on this, I'll bring them to you. But some bond sales picking up and treasury yields up off the back of some of this. The 10-year yield higher by 6 basis points, the 2-year up by 4 basis points. Up next, we'll get you the trading diary from New York. This is Bloomberg.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
rather than ever higher. So I think once we get to 5.25, 5.5, I think they'll land, and then we'll just sit there and wait for that restrictive monetary policy to slow the economy down, generate more slack in the labor market, and that will gradually push both wage inflation and services price inflation down.
I've always found that the former Fed officials tell you what they really think and don't hold back in quite the same way as they might have done when they were at the Fed. That was Bill Dudley there, formerly of the New York Fed, and now a Bloomberg opinion columnist. Fortunately for us, equity futures were positive through much of this morning. Then we got the opening down and things rolled over just a little bit. We're down about 0.2% on the S&P 500. On the Nasdaq, we're down by about a third. That's some of the price action. Let's get you the trading diary. Consumer confidence coming up at the top of the hour. President Biden convening with members of Congress at 10:30 Eastern, promoting his economic agenda from Michigan later this afternoon at 3:30. A host of US economic data, including US GDP, core PCE, and jobs data coming up tomorrow. Plus, we'll hear from Chairman Powell alongside Governors Bauman and Cook. Another round of US jobless claims coming out on Thursday. And finally, closing out the week with payrolls Friday and the estimate in our survey, something around 200K. From New York, this is Bloomberg.
We are facing a perfect storm of uncertainty. But with over 225 years of experience, we know there's only one way through, forward. An unstoppable sustainability transition is already transforming our economy with innovative investment solutions. Our role is to calmly guide our clients towards a future that has already begun.
Any metal cut to size in just a few clicks. Visit metalsupermarkets.co.uk.
Let's just take a bit of that one, we'll pop it down there, get that on, and then we'll just get some paint on, get our nice green. Is that the key? Is that the key to push that right in? Not really, I mean, you dirty fingers, the only reason I use this here is because I do 100 fingers down here, so rub your fingers and I'll have literally no problem, so that's the only reason. But actually, the other part is
from the Financial Centers of Europe, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on Tuesday, November 29th. Here are the top market stories. We're following
at this hour. You got Fed hogs versus some dollar bears. Fed officials make it very clear more hikes are coming and staying for longer, but the dollar bear yawn and carry on. Calvaria's 2023 pick. We're going to speak to Wall Street veteran Leon Calvaria, chairman of Citi's institutional client group, to get his take on bankers, bonuses, and his predictions for next year. And consumer crush or cracks. I finally stopped shopping. Maybe. We have the latest read on the consumer with Dan Peterson of the Conference Board as the data drops right now from New York. I'm Alex Steele with my co-host London Guy Johnson. Welcome to Bloomberg Markets. I'm a healthy consumer, but I'm done now. What does the data tell you?
Are you really done? Honestly, I thought you were done yesterday, but no, the shopping continues.
Just one. It's one deal. It was really cheap steak knives, but I'm done. I'm really done this time.
No one else has got that. Just us.
I believe that when I actually see it, when those last minute deals start flooding through. Apparently, Cyber Monday was pretty strong. I think we need to bear that in mind when we look at the data that is dropping onto the screen in front of us right now. Because the Conference Board consumer confidence numbers come out a little softer than last time, but pretty much in line at the headline level in terms of expectations. The headline number comes through at 100.2, down from 102.5. The expectation was 100. It's the forward-looking indicators that I think are worth paying attention to. The present situation's 137.4 versus 138.9, which has been revised lower to 138.7. But it's the expectations one that I'm looking at, because this is where Alex will be actually happen on what is happening with the recession that we're pricing in next year. 78.1 last time was 75.4.
Let's say you've got some working for you and they leave that out overnight.
That's where I want to pay attention.
Especially now
That's where the recession indicator might be coming from.
Yeah, and I think that this also tracks with my shopping experience, right?
You
Like,
don't
strategic
see it,
shopping,
you
like, you're not just
won't
going to go
know.
out there and forget about everything. Like, you're going to get the things that you need at discounted prices. It feels like it all kind of tracks into the same story here.
That's why these go back in the box each time and you absolutely because
Alex is back buying shoes. I think
now you can put that in the bag. You come back a year later.
This data series, though,
Perfect.
the conference
Colour intact, no drip, no dust, no moisture, ready to go. There you go. So when you need it, that's perfect. So please, keep it in the box.
And also expectations continue to signal that consumers expect recession at some point over the next 6 months. And it's been signaling that for several months. So consumers are definitely showing that the economy lost momentum as we are rounding out to the end of this year.
What is keeping the consumer cautious right now?
Well, it's really about inflation. Food and energy prices are rising. Indeed, when we looked at the inflation expectations gauge, that ticked up, and that's the highest that we've seen since July. Also, when we asked consumers about the present situation, they gave mixed signals with respect to business conditions and also mixed signals with respect to employment. So that's really important. If business conditions aren't doing well, then they start to fear for their jobs. And certainly when we look at the expectations gauges for income, business conditions, and employment, all of them dipped in the month.
Dana, how good is the consumer at picking a recession?
Well, I mean, it's not the case that you necessarily map it against GDP, but certainly it is a very important forward-looking indicator because certainly the consumption is roughly 75% of GDP. So if consumers lose hope and they stop spending, then you're probably going to see a recession in the U.S. economy.
Do we get a sense of what kind of recession everyone's sort of expecting at this moment in terms of their expectations?
Sure. Well, our own expectations are that the recession is brief, maybe 3 quarters, and it's pretty shallow. And indeed, when we ask CEOs what they think, they've been saying since May that they think that, yes, there is going to be a recession, either starting the end of this year, we're almost at the end now, but certainly next year. But that is going to be brief. It's not going to be too bad. And indeed, they're still thinking about hiring, even though they're facing down a recession.
What do you think the Fed should be looking at, therefore, within these numbers, Dana, to get a clue as to what is going on? The overriding narrative continues to be that employment is holding up. You see it in the claims data, you see it in your data. I'd be interested to know what your take is going to be for Friday's number. What should the Fed take away from the series, though, that you just presented?
Sure, I think the Fed should take away the fact that consumers are definitely feeling the pinch. When we ask them about their buying plans, plans for buying big ticket items like cars and furniture and homes, all things that you tend to finance are ebbing, and that's because interest rates are rising. And so in that sense, yes, demand is cooling, and that the Fed should be pleased that that's happening, because cooler demand will help bring down inflation, which we all know is quite elevated.
So, Dana, then what kind of reluctance or sentiment do they not like?
Well, I think that, certainly if inflation expectations continue to rise, and in the case of our indicator, at least 1 year ahead, it did, that's not good. And the Fed is really trying to address not only the level of inflation, which is high, but also inflation expectations, making sure that they don't become unanchored either over the next year or even over the next few years. And so that's why the Fed is engaging its very aggressive tightening to make sure that they don't have inflation expectations rise out of control.
They are, though, focusing very much on the employment picture right now. It does seem to be one of the key metrics that they are setting policy by. Dana, are you surprised how strong the labour market continues to be?
Actually, I'm not. When we look at the labor market, we're still facing considerable shortages, right? You have entire industries like in-person services, hotels and restaurants are included in that, as well as healthcare, but also manufacturing and trade and transportation. The common denominator for all those industries is that you have to show up to work, and hence you're seeing labor shortages be the most extreme there. And so those industries are still hiring, and indeed, labor shortages are probably going to keep many businesses from laying off their workers en masse, because they're going to afford workers. They spent a lot of time and energy and money trying to attract and keep labor. You probably don't want to undo all of that great work if you think the recession is going to be brief and it's not going to be that deep.
Yeah, I guess just not if you work in tech. That feels like a whole different beast. Dan, thanks a lot. Dan Peterson of the Conference Board and Chief Economist. Thank you very much. All right, coming up, we got the Federal Reserve officials doubling down on higher rates for longer. The data continues to back that up. The market's pushing back, though, against the hogs. We're going to break that down with David Kostin of Goldman Sachs next. This is Bloomberg.
they're counting the first 250 basis points as if that was a tightening monetary policy, but really that's just getting up to the long run neutral level of the policy rate.
Right, we are back. Just need to grab some food, re-energize for the action. So, finding some support exactly where we said. Great. Let's see how things develop over the next hour and a half. Seeing some price act, fantastic. Let's see what we're getting. So exactly, guys. I mean, we even drew it in exactly how it's done. Dollar index toppling over exactly how we were expecting, and we are expecting it to continue pushing down, giving some strength to our under 2 hours from now. So yeah, let's see how things develop between now and then. So yeah, we're seeing a little bit more of a push down. That is fine. Still got that 618 to be tested. So that's kind of the last point of support that we're looking to hold, and then start to make a move back up to the upside. So yeah, let's see how things go from here. We're seeing prices holding up quite relatively.
Next year, although probably 10% lower in absolute levels, probably $900 billion compared next year, compared with around $1 trillion of corporate repurchases this year. So that's one source of modest reduction in demand. Again, that's on a baseline assumption of a soft landing of the economy. In terms of the other sources of demand, so I believe a good way to think about liquidity, where's the demand coming from? It's likely to be outflows in the case of households.
We are looking relatively good from here.
And as other sources of demand have been ebbing or likely to ebb in the future, historically speaking, that's when pension funds tend to step in looking for opportunities. So I think those are the sources of supply and demand that I would think about and focus on in terms of the demand for equities.
Hey, David, the calls for 2023 are coming out. Bank of America had theirs yesterday. A pretty wide band, though, between the bulls and the bears, 4,600 to 3,000 for the bull and the bear. What's your strongest conviction for next year, and how much conviction do you have about your conviction?
The strongest area, Alex, in terms of the area of vulnerability, would be on earnings. Earnings can be flat. Why is that the case? Well, the economy is likely to keep growing, in our view, and on a nominal basis, given where inflation is, that is helpful to revenues. However, margins are likely to come lower. Why do we have this view? Well, for the first time since the pandemic, margins inflected lower in the third quarter. So we have now the canary in the coal mine. We've just seen this piece of evidence, and when we look out into the coming year, margins are likely to come lower. Well, why have they been rising to the high level that they are? Well, it has been a reduction in SG&A costs, selling, general, and administrative expenses. That has diminished to around 13% of sales. That is much lower than it has been over the long term, maybe 14.5%. That has been basically a transfer.
Well, that's all the data to come out today. Obviously, German CPI fell by 0.4% to 10%. Dollar index continues to fall. That's going to put some nice upward pressure. And we're currently holding this level, so yeah, things are looking good for a continuation back up to the upside. So we'll see how things kind of play out from here. But yeah, things are looking good. Things are looking good.
Because the consensus seems to be that we're going to get a mild recession. Is that your view too?
No, the assumption, Guy, we're assuming that we're making is that we have a soft landing, which is to say the U.S. economy continues to grow on average around 1% next year, so modestly. In that scenario, you have no earnings growth. That's an optimistic scenario, if you will, and you have stable kind of evaluation. The scenario in a hard landing that you posit, what would happen in the event of recession? Well, historically speaking, earnings fall during a recession by around 13%. In a scenario, when we look at some inputs, that would lead to earnings falling by around 11%. So put some numbers around that. That's like $200 of earnings per share next year. Our baseline is $224, $200 and a 14 multiple. But as you look forward, that would put the S&P 500 guy around 3,150. So think about that as your downside, maybe 20% lower. Again, that's a scenario, not a baseline, but a scenario as opposed to a market falling maybe 10%.
We'll see how things come out from there, guys. So we'll touch base with you for this European close. Okay. But yeah, things are holding up nicely. We'll let them play out for a little bit and then come back and touch base with you. We'll leave the live stream running. But yeah, I mean, we're just gonna have to let price action do its thing a bit. So yeah, we'll touch base with you shortly.
Number two is balance sheet strength. Larger cap companies tend to have stronger balance sheets. Rates are moving higher. Broadly speaking, individual and corporate balance sheets, broadly speaking, are strong, but on a relative basis, they're stronger in the larger cap companies. So I think those are the two areas: balance sheet risk and margins would be areas that would lead us to a preference for larger cap companies as opposed to smaller cap companies.
David Graney-Ketchup, thank you very much indeed. David Kostin, Goldman Sachs, Chief US Equity Strategist. Thank you very much indeed. Still ahead, he fired Twitter employees. He tinkered with key features. He restored banned accounts. Now, Elon Musk is picking a fight with Apple. How risky is that? Details to follow. This is Bloomberg.
I want you tonight.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The US housing market pulled back even more in September. Prices in 20 large cities fell 1.2% from the previous month, the third straight decline. That's according to the S&P CoreLogic Case-Shiller Index. Mortgage rates have more than doubled this year, slowing demand. HSBC has agreed to sell its Canadian unit to Royal Bank of Canada. The price, $10 billion in cash. The deal will allow RBC to expand its roster of business clients and bulk up its retail presence on the West Coast. The transaction represents a rare domestic acquisition for one of
Canada's big banks. And a surprise departure at AMC Networks, known for series such as The Walking Dead. CEO Christina Spade has stepped down after less than 3 months in the job. No reason was given for her departure. The company's board says it's coming up with a replacement. AMC shares have fallen some 50% this year. And that is your latest business flash. Alex.
All right, thanks so much, Ritika. All right, time now for the Red Eye, where we run through the top tech stories making waves in the Bay Area around the globe and want to get the view from the Valley and bring in Bloomberg Technology co-anchor Ed Ludlow from San Francisco. Ed, one of the top stories is Musk taking on Apple. Why? How? What's the logic behind this?
Yeah, there are several grievances that Musk outlined with Apple on Twitter, unsurprisingly, in the last 24 hours. The first is the revelation from Musk that the ads by Apple have been pared back. If you go on Twitter right now, onto Apple's account, it has more than 8 million followers. It follows 0 people, but you'll see its timeline is completely blank. And Twitter has always been a mechanism for Apple that it advertises on. It pays to have ads placed in the timeline. It just doesn't tweet of its own volition. And what we're hearing from sources is indeed Apple has pared it back. The situation is a really interesting one because according to sources, Apple was spending more than $100 million a year placing ads on the platform. For Apple, it's a really key mechanism. Apple does not use Facebook for ads, for example. So that's the first grievance. The other one, the accusation leveled by Musk at Apple and its CEO Tim Cook, is that Apple hates free speech. Which is an inference or conclusion Musk has drawn based on the idea they're paring back their activity on the Twitter platform.
Ed, if you would walk around San Francisco and talk to people that work in tech, would they agree or disagree with Elon Musk when it comes to this story surrounding Apple?
I think this is a really interesting one because we reported on the layoffs at Twitter, but we also reported that a lot of engineers left of their own volition. And yeah, we speak to lots of people around San Francisco, out in the broader Silicon Valley area, who are on the engineering side, and they don't agree necessarily with the platform changes that Musk's making. Apple's instance is really specific because it's a very top-tier advertiser. You know, sources were telling us that until very recently, a whole Twitter team was dedicated to Apple. And you acknowledge that this change from ad-based model to subscription model doesn't happen overnight. So why alienate one of your biggest advertisers? Why go after and start a fight with one of the biggest publicly traded tech company in the world?
Because Ed, they charge 30%. And this was the issue that Epic had. This is an issue that lots of people have with Apple, that they take 30%, and a lot of people don't agree with that. So that's kind of where I'm coming from here. Do people agree that actually picking a fight with Apple is the correct thing to do because they're overcharging? They don't deserve this 30%.
Yeah, and Musk's opposition of the 30% is not new, right? He's tweeted about it in the past, the famous meme, turn in the road highway, where you pay the 30% or you go to war, and Musk said he would choose to go to war. I think what's really interesting is Twitter's fate vis-a-vis the App Store, right? So Musk said that Apple would consider taking Twitter off the App Store without explaining why. When you think about Twitter's business model and wanting to charge $8 a month for the verification or subscription service, actually there is a mechanism for them to do that without the App Store. They just do it online. The difficulty, and you can read about this on our story on the Bloomberg Terminal, is what if they start advertising on the Twitter platform the idea that you can circumvent the App Store rules by doing this? It's then that they might have an issue and they'd encounter this kind of argument about Apple's monopolistic practices, which of course are also being debated in court as we speak.
And where does this debate go now? I mean, I feel like we're going to have to get used to Musk using Twitter as a platform to attack companies that he has problems with. How does Apple then respond to this in an official capacity?
Yeah, I think it's really interesting. One of the key points, right, is that he is doubling down on the idea that freedom of speech is an essential right and that Twitter is going to be a place where freedom of speech is protected. But right now, some of the biggest concerns are over moderation. You know, this goes back to the layoffs issue we were talking about. Who right now now is enforcing policy. If you go on Twitter's website right now, the other piece of news is that the COVID-19 misinformation policies were suspended as of today. So the question that a lot of people here in San Francisco, broadly around the world, have is who's policing any of this? Who holds Elon Musk to account on the Twitter platform? Yep. He talks about this oversight council, but that seems now to be on the back burner.
And that's where the EU definitely has a major problem with what is happening here as well. Regulators are certainly paying attention. Ed, great stuff as ever. Bloomberg Technology co-anchor Ed Ludlow joining us from San Francisco for the West Coast Wake Up.
No,
Our next guest.
no. We're debating titles right now is what's happening.
So yeah, basically. And we're doing it on air. We're saying what works. China's healthcare system could be...
Why do we get up in the morning? We'd say, to make a mark. But I want you tonight.
Into the U.S. trading session, Abigail tracking those moves. We are a bit higher, and I keep forgetting that tomorrow's month end too.
Yeah, it's pretty amazing actually. This has been the month that has just snuck by, but right now we have very small moves, and what really catches my eye in the month, the Nasdaq Golden Dragon Index, its best month ever, up 31%. Today, 6.5% gain. A piece of that, but relative to U.S. equities, a little bit of a gain to Alex's point on anemic volume once again, more than 30% below the 20-day average. Oil up 2.6% in China on the possibility that there is going to be a reopening there after yesterday's fear. Now, today we have yields up a little bit, not holding back stocks all that much. And of course, a big piece of this pop, well, actually now coming back in for the 10-year yield. But Amazon has announced its second big bond deal of the year, 5-part bond deal. But there's a very interesting article out on the Bloomberg Terminal today, Bond Blitz. There could be 10 IG bond deals today. So some competition for yield. Now, if we speak about competition
between yields and stocks. The big one, of course, it is the terminal rate relative to the S&P 500. This is an inverted terminal rate in blue. If it was going the right way, it would be higher. So that story of yields up, stocks down. But the interesting point right here is you have the terminal rate basically going higher, but stocks more recently have been going higher. So investors are getting a little bit more comfortable with the idea that the Fed is raising rates. The question, of course, will be that pace. We'll be getting more detail on that tomorrow from Fed Chair Jay Powell, and of course in a couple of weeks at that FOMC meeting. And then here's a little bit of a breakdown, more of a breakdown, I should say, on the China tech rally. I mean, this is really incredible, guys. Take a look at JD.com, up 9%. Billy up an amazing 24%. The online entertainment company following in Pinduoduo footsteps yesterday. Both of those companies put up tremendous quarters, very strong quarters. The outlook, I guess, for Billy, not great, but you wouldn't know it taking a look at these stocks. I think it's a little bit of that catch-up thing where investors don't want to miss out, given the fact that if you took a look at these stocks on the long term, they're all down more than 50% over the last roughly 2 years or so.
Abigail, thank you very much indeed. Abigail Doolittle, thank you very much. Let's talk about China. The big story yesterday, having an impact on oil today, I think. The reopening story is going to be a big struggle for this country. Airfinity, which has been crunching data throughout the pandemic, is now warning that China's policies have left the country with little or no natural immunity. This is a huge problem, particularly for the elderly population. Joining us now with the details on the latest report is Rasmus Berg-Hansen, Airfinity's co-founder and CEO. As I said, you guys do data. You've been tracking this throughout. We've come to you every time to figure out what is happening. Rasmus, just talk to me what the picture looks like right now in terms of natural and acquired immunity in China. If it was to open now, how exposed would the population be?
Yeah, China is facing a very, very difficult situation. I would say it's almost as difficult as it was 3 years ago when COVID just hit for a number of reasons. The protection levels overall, when you model the number of the vaccine uptake, the vaccines they've taken, they've used the homegrown vaccines that are less effective than the Western vaccines, and then also take into account that this strain of the variant, the Omicron, is significantly more transmissible. And to a naive population as the Chinese that hasn't been exposed to the virus, it is as deadly or deadlier than the original strain. When you take all of that into account, model it, also look at what happened in Hong Kong. Hong Kong is quite a good proxy for what would probably happen in China. Then what we're seeing is that up to 2 million people could die in the coming 6 months if COVID runs wild. So a full opening of China, in my view, seems like a very risky endeavor and maybe not very likely.
That's a huge amount. I mean, 2 million deaths. Obviously, China's trying to find a middle ground. Can you walk me through the models of vaccination for the elderly, like how quickly China can do that and how quickly there can be some kind of immunity? And does it change based on the vaccine that they choose?
Yes, so I think the way forward for China would really be to model the Western playbook, which is buy yourself time to get vaccination uptake. Really what's quite remarkable now in China is vaccination has almost stopped. You know, there's been very little vaccine uptake over basically since the spring, which means that even the vaccine protection is quite low. And then taking into account that the vaccines were 20 to 30% less effective against hospitalization and death than the Western vaccines, that gives you these picture. I would say that it's important to bear in mind that the case rates in China are still relatively low. They're lower than they are in most European countries, lower than they are in the US. And if you look at South Korea and others, they're much higher, right? So the cases, it's small enough that China can contain what they have now and then can boost with a vaccination campaign. I think the part of the problem is that maybe the Chinese population is skeptical of these vaccines, because even the high-risk groups have fairly low vaccine uptake rates, which is different from what we see in the West. So I think importing Western vaccines is one of the obvious way forward for China. They could do that gradually while still track and trace, keep the infection under control to confined areas, and then buy themselves time to get more of the population vaccinated, and then gradually also acquire immunity, natural immunity, as we've done in the West.
Rasmus, if we were to see China reopening, if we were to see case counts balloon, how big a risk would there be that we would see a new variant emerge from that group that would pose a threat to the rest of the world?
Well, we're seeing new variants all the time. I think that would be part of the threat, but really the bigger threat is to the Chinese people. You would see overflown hospital, Chinese hospitals. If you look at spare capacity of ICU, spare capacity of hospitalization, there isn't a lot already in China. If you see what happened in Hong Kong, it was a very dire situation Hong Kong was facing. I think that's what you're going to see, and I think it's unlikely that the Chinese authorities will be able to accept that.
Right, which is why it feels like at least getting the elderly population, which is exactly where the West was at, a year and a half ago, 2 years ago.
Yeah.
So, Rasmus, to that point, how many shots would the elderly have to have for that to ease the pressure on ICU and ventilators?
Well, if you just got one shot of good vaccine, you'd go really far. Ideally, you'd have a double shot, but just one shot of a good vaccine there. We modeled how many vaccines are available in spare vaccine stockpiles of Moderna, Pfizer, and other Western vaccines. So there are more than 1 billion available. So the vaccines are actually out there. Omicron-produced vaccines are now in the number of like 150 million a month. The Pfizer and Moderna are producing of those. So those could also be shipped to China. So I think, we're seeing that actually the shortage of vaccines that we saw early on in the pandemic, that's not the situation. The vaccines are there. They're available. They could be shipped to China. They could be applied. And then also I would mention that therapeutics, we have now, part of the reason we're seeing lower mortality rates in the West is also because we have better treatments. We have very effective treatments, and China could also buy more of those and start applying that. That could also ease the pressure.
Is what you're saying basically that unless China decides to buy huge quantities of vaccines and therapeutics from Western pharmaceutical companies, there is no obvious and easy way out for it? Are you suggesting that really is the only route that they have open to them?
I don't think they could use their own vaccines. That would be better than nothing. But you got to ask yourself, why is it that the vaccine uptake in China stopped in the spring, right? Why was that, right? Probably one big reason is that the population was unwilling to take it, right? So it would be better to use Western vaccines. Second best, use their own vaccines. But this kind of constant lockdown with no end in sight, it's not like China can protect itself from the virus forever, right? They will have to have the virus living in the population at one point. There's no other way. No country, not even China, can protect themselves against this virus. It's impossible.
Okay, so to that point, you mentioned the staggering number of 2 million deaths. It was just like a broad reopening. What kind of deaths and hospitalizations can you guys model if we do see an uptake of vaccine? Like, where is the tipping point? Like, if you get 70% of the elderly population vaccinated, does that death rate come down?
Yeah, definitely. So it would all depend on the uptake, and especially uptake of the vulnerable population, and then also the treatments, the type of treatment. So that would be difficult to put a precise number, but I think it would be significantly less. It's unlikely that China will have no deaths. It will probably be more, hundreds of thousands, no matter what. But the 2 million, that would be like a third to a fourth of the total deaths of COVID worldwide. So that would be, very, very much. I think they could bring in much less than that. 10% of that also would, or maybe even less. But it depends on a lot of factors.
Hi, Rasmus. We'd love to catch up with you. It's been way too long, Rasmus Hansen, Airfinity co-founder and CEO. Thank you so very much. Just some breaking news for you here. The BOE sells a total of 346 million pounds of debt. This is the first in their sale of emergency holdings. Remember, the BOE had to step in and help backstop the gilt market when there was such drama caused by Kwasi Kwarteng and Liz Truss's mini fiscal budget. They are trying to get rid of this now in a way that's not going to hurt or affect the market. So they sold about 346 million pounds of that debt. We will talk more about this within the next hour. Coming up right now, we're going to be speaking with Arnold Donald, the vice chairman of the world's biggest cruise operator, charting a course out of the pandemic. This is Bloomberg. you up to date with news from around the world. Here's the first word. I'm Ritika Gupta. President Biden and House Speaker Nancy Pelosi are moving to prevent a strike that would shut down the nation's freight railroads. The House is preparing to take up legislation to impose a labor settlement despite the objections of some unions. A rail strike could hurt the economy by crippling supply chains. NATO is discussing how to improve Ukraine's defenses against Russia over the winter. Speaking in Romania, the alliance's Secretary General vowed that NATO will stand for Ukraine as long as it takes.
This is a critical time for our security, and we are sending an important message. NATO is here, NATO is vigilant, and NATO is ready to defend every inch of Allied territory.
Stoltenberg also said the war has demonstrated what he called the dangerous dependence on Russian gas. China plans to increase COVID vaccinations amongst its senior citizens. It is a step that health experts regard as crucial to reopening an economy stuck in harsh COVID-0 restrictions. Still, Beijing stopped short of announcing mandates that helped raise inoculation rates in other countries. The move comes after a weekend of protests demanding an end to COVID limits. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. All right, Ritika, thank you so very much. All right, so Thanksgiving weekend is done. Now we're all looking ahead for the Christmas holidays. Now, travel executives are relatively optimistic about what is ahead of the industry. At a conference, many spoke to Bloomberg about what they look at for 2023.
We're coming into this year with a record bounce back. It's a £1 billion bounce back that we did. We achieved also the highest earnings ever in the last quarter in the company's history. So what we're seeing now for this winter going forward is that the peak periods are doing really well.
What's happening is business travel on a global basis is coming back very rapidly, and meetings and events is coming back as well. And there's a massive amount of pent-up demand for both of those categories of travel.
With what's happening in the world, with inflation, with maybe recession, thank God we had a good 2022. I think we're going to have a good first semester 2023. And then the odds are, I don't know. But I'm a true optimist. So it should be carrying on as long as people have the wherewithal to travel and money to spend on leisure.
That was a great answer. First half, sure. Rest, I don't know. Well, the cruise industry was one of the hardest hit by that pandemic. All their ships are back in the water, and Carnival is hoping to return to pre-pandemic levels in 2023. Now, joining us from Riyadh at the World Travel and Tourism Global Summit is Arnold Donald, Carnival Vice Chairman. Arnold, it's good to see you. So I think the Accor CEO said it best. First half of next year is going to be fine. After that, I got no idea. We're dealing with recession risk and high inflation. What's your outlook?
As chair of WTTC, I'm happy to be here in Riyadh at our global summit. It's spectacular. The energy is high, as you saw from those you interviewed. Because as we look ahead, things look pretty promising, frankly. And the only thing I think that can slow down the growth in travel and tourism is people not being able to travel or people being afraid to travel. I think if there's any issue in terms of go forward on people traveling in the future because of recession and that sort of thing, there'll probably be a reallocation. In other words, they may change their specific plans, but I think they're still going to travel. People have a pent-up demand to travel and an intrinsic desire to do it.
Arnold, good morning. It's Guy, or should I say good evening there in Riyadh. Do you think they're going to be spending less, though?
I think it depends. We don't know. We have to see to what extent the recession occurs and how deep it is. People may choose to spend the same. They set a budget and say, I can't spend any more than that. But clearly, depending on how severe it is and what location it happens and how even it is across the globe, of course, it can ultimately impact spending if people get really nervous about their financial futures. In the case of cruise, we've learned that during recessions, where it's not recession-proof, but our industry is recession resilient. People choose to cruise because it's a great experience, but it's also, from an economic value standpoint, a better value than you could a land-based vacation. So we don't see big impacts from recessions in cruise, but some other forms of travel and leisure might.
Arnold, I wonder though if the patterns change in that when we talk to airline executives, they say, oh, well, we're seeing people who are worried about money go to tier B cities or go to smaller destinations so they don't have to travel that long. Are the patterns changing out of the pandemic and into a recession?
So far, in terms of out of the pandemic and into a recession, I would say this. The patterns would certainly change if there was a deep recession that was consistent around the globe. Patterns would definitely change. Patterns have changed coming out of the pandemic, not so much in terms of closer in and all that, but coming out of the pandemic, they've changed because people have a pent-up demand for travel and experience. And so you've seen a big boom. Some of it is probably because some people had stimulus money tucked away, but a lot of it is just because they weren't able to for so long.
Let's talk about what you're spending within this industry. Arnold, can you get the people that you want? Are you having to continue to pay more? What's happening on the cost that you're having to get from your suppliers? Do you think inflation is anywhere near peaking?
There is obviously inflation on many items. In terms of generating demand, I wouldn't say that it costs more to get the demand today. We've got new approaches to generate demand. Media mix, for example, and advertising and stuff has changed. We've moved more to paying for people who actually book versus just general reach and that sort of thing. So there are ways you can manage your costs, be more effective, be more productive. And so in that regard, in terms of accessing guests, I wouldn't say the costs have gone up dramatically. In terms of servicing those guests, then of course, food prices in many places have gone up substantially. Obviously, fuel prices have gone up. They're starting to come back down. But these things all happen over time, and obviously we're taking a longer-term view of all this and not just the immediate near future. But in the coming years, we see tremendous growth. Here at the summit, we shared information real quickly that while the GDP growth is anticipated to be around 2.8% or something like that, will be over 5% in travel and tourism broadly. I'm talking all of travel and tourism growth.
Arnold, talking about costs, I wonder how you look at the labor situation. So first of all, do you have enough staff and how hard is it to hire? And second of all, if we do get a recession, how sticky would those jobs be? We keep hearing about, say, industries and companies that had a hard time hiring back after the pandemic won't necessarily fire workers in a recession because they're worried about getting them back. Can you tell me how you understand this in your industry?
Within the cruise industry, basically what happened is we, in our company alone, will hire 20 to 30,000 people every year. And so we do it from over 145 countries. But it's a pipeline, and that pipeline gets filled by agencies that do some preliminary training and whatnot for us. So when the crew comes, they're partially trained, and then we finish it when they come into our company. So that pipeline emptied during the pause. So we paused operations for an extended period of time, and all of that shut down. So with that, we had to refill that pipeline. So there was a period of time when it was very challenging. Also, there were visa issues, in the beginning, because of the different health protocols and what have you. Those have reduced. The pipeline is filling up again, and I don't see it being a crisis to be able to get talent. But again, we recruit from 145 different countries, and so over time, we should be in really good shape in that regard.
Arnold Donald, sir, thank you very much indeed for your time. We really appreciate you joining us from Riyadh. Arnold Donald, Carnival Vice Chair. This is Bloomberg. as we come towards the end of the day here in Europe. Stocks doing nothing, to be honest. At a headline level, we're barely budging. We're up by around 0.2%. I think the action is elsewhere. Brent crude rallying. We're up by 1.85%. That appears to be on the back of the idea that China is going to vaccinate more people, which potentially could mean that lockdowns get eased. But as we've just been hearing from Airfinity, that's going to be a tricky line to walk. The German 10-year, I think, is interesting today. The yields are generally lower, Alex, here in Europe. The Spanish data was a little softer. The German data was a little softer as well. But actually, if you look through the details, I didn't think it was that soft, and it's still relatively elevated. And the debate is around 50 or 75, and it's a similar conversation that we're having here in the UK as well. It's interesting. Catherine Mann's been talking about embedded inflation, kind of sticky inflation around 4%. You've got Andrew Bailey currently giving testimony to the Lords as well, just talking about the fact that the gilt market just remains broken. And this whole issue of the labour market is really problematic for the Bank of England, Alex. It's really embedded here, this problem that we're having with this tight labour market.
Yep, and that's not something that the BOE can solve at all, because part of that's going to have to do with immigration as well as Brexit. But what's also interesting about this whole conversation is that even if you say have overall inflation lowered, the underlying inflation can get much stickier. That's unrelated to, say, fuel prices or natural gas prices. And that's, I think, where the problem is. We didn't get that level of granularity today for Europe, but maybe we'll get that tomorrow.
Absolutely. The message, though, from the ECB and the Bank of England, though, is, I think, on balance, slightly more hawkish than maybe the market's got priced. Anyway, we're going to talk about European banks. We're going to talk about what's happening in banking more broadly. Leon Calvaria, chairman of Citi's Institutional Clients Group, is going to be joining us in the next hour. Really looking forward to this. This is Bloomberg.
Why do we get up in the morning? We'd say, to make a mark.
WebSwing migration, the most meaningful way to migrate your legacy Java app to the web. Try it at webswing.org.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Tuesday, the 29th of November, European equities broadly bid, but fading into the close. You've got miners doing well today. The banks just continue to do well. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So, Stock 600 up by around 0.2%. London outperforms a little bit. The miners are the reason for that, doing a little bit better today. Commodities generally broadly up on the back of maybe more positive China news, maybe a little early to say on that front. You're also seeing the banks continuing to perform. We'll talk about HSBC. We'll talk about why banks are continuing to perform here in Europe, outperform in many ways in the second hour of the program. Euro dollar up a little bit today. The inflation data we've seen from Spain and from Germany starting maybe to roll over a little bit. Was today's data consistent with 75 basis points from the ECB next time round, or for 50? I think it probably looks like the latter. And some single stocks. There are a number to choose from today. I've gone with the football theme. Juventus down by 0.9%. It was off significantly earlier. Again, we'll talk about this. We're going to take you to Milan to talk about what's happening with Juve. The Agnellis, are they looking for an exit? We will find out, I suspect, over the next few weeks, Alex.
Yeah, same with football. 3 hours, and then you got that U.S.-Iran match. Okay, here in the U.S., S&P is up by 0.1%, but I have to say, volume is still really light. Tomorrow is the last day of November as we head into the end of the year, so it's hard to take a lot of signal from what we're seeing. The dollar a little bit softer, peculiar, because the Fed hawk language is out there, higher rates for longer. The 210 spread, which is what everyone's now watching, how much can it invert, how long can it stay inverted for? We're now at 73 basis points, well off that deeper inversion that we saw from yesterday. And the VIX is interesting. We're at under 22, but some DeMark indicators, he's that technical analyst, are saying that maybe we could see a reversal of the VIX and what that would wind up meaning for the rest of the market. And on the eco data front, it's kind of steady as she goes, like softer data. We know that's happening. Then how does the Fed interpret it and take that as we head into Jobs Friday, Guy?
Yep, the data. Do you follow what the Fed says? Do you follow what the ECB says? Do you follow what the data are telling you about what is happening with these relevant economies? Today we're starting to get an early glimpse of what is happening with the European inflation picture. The ECB is going to be paying a great deal of attention to these numbers. We've had numbers out today from Germany and from Spain. We're going to get the rest of these numbers throughout the week. We're going to build up to the Eurozone data later on in the week. Both numbers softening up a little bit, but still relatively elevated, I think, certainly by historical standards. Germany dipping from 11.6, these are headline numbers, to 11.3. Spain, 7.3 to 6.6. But the core number also is critical here, and it remains elevated. And I think that's going to be an ongoing and consistent problem for the ECB. Alex, you heard what Lagarde had to say yesterday. She sounded hawkish. Isabel Schnabel also sounding hawkish as well.
Yeah, what I found really interesting, if I just dig into Germany for a second, and this goes back to shopping, no surprise, package holiday prices fell about 25% on a year-on-year basis. And I'm curious, is that like high comps? Is that a supply issue, or is that a demand issue? Like, are we seeing the pandemic supply issues ease, in which case that could fall even further, or is that a demand signal, which would be much more negative for the European, for the German economy?
Well, you think about what's happening with the German consumer at the moment. They are certainly under significant pressure. Gas prices are rising. Energy costs are rising as well. Food prices are certainly incredibly elevated. It's really hard to tease apart what is happening here, because the broader picture is, and we're seeing on both sides of the Atlantic, the consumer in so many ways is actually still in fairly robust form, which is really interesting. The other thing that we've got to think about here as well is, does raising rates solve the problem? I know that the ECB is worried about second-round effects, and I know we're starting to see some evidence of that. But at the moment, this remains an energy shock in so many ways. Does raising rates actually solve that problem? Christine Lagarde, as I mentioned, saying that actually, and talking about this, inflation hasn't peaked yet. Is she right? And what about this whole kind of question about whether or not raising rates is going to reduce inflation at this point, given that this is, in many ways, in terms of trade shock? Here's what Irene Tingali, an Italian economist and also European Parliament's Economic and Monetary Affairs Committee chair, had to say on that very subject a little earlier.
Well, the problem with inflation in the euro area compared, for instance, with the inflation in the United States is that we have, on one hand, a peculiar kind of inflation, which is mostly driven by energy prices that both directly and indirectly affect the inflation rates. And this is something that unfortunately cannot be changed easily by just hiking the interest rates.
Yeah, if you've only got a hammer, maybe every problem looks like a nail. Jamie Rush, Bloomberg Economics Chief European Economist, joining us now. Jamie, let's start off and talk a bit about the data. Is that data consistent with the idea that the ECB at the beginning of next month should be going 75 basis points or 50 basis points? Can they downshift like the Fed is hinting at as well?
I think there's a feeling on the Governing Council of the ECB that there isn't actually consensus for a 75 basis point hike unless there is a surprise. And, the ECB doesn't like surprises. We don't like economists not being able to explain why inflation is higher than they thought. That is bad news, right? So, I think the data at the moment, what we've seen from Spain, from Germany, are pointing in the other direction. It looks like energy costs are falling a bit faster than anticipated, and maybe we'll actually get a downside surprise, the first for a while, on inflation, and that will allow the ECB.
Is that what you think is going to happen?
I think that's what our forecast is. We have a consensus call for.
Well, Jimmy, can inflation then keep falling with the same kind of speed? Or does inflation then fall like we're seeing and it kind of stays there? Because that, in essence, will also determine if 50 or 75 bips.
Inflation is going to fall at a similar sort of speed. It's going to keep falling through 2023 as we see those energy costs disappearing from the annual comparison. But this is the moment, of course, at which the ECB is going to switch from focusing on headline inflation to focusing on core inflation. And we've already started to get a flavour of that. And the question is, how sticky is core inflation going to be? And our analysis says that we're going to see that it's kind of plateauing until the end of the first quarter, and that's when we think there might be a possibility the ECB brings the hiking cycle to an end.
Given the fact that wage rounds are happening now, is this the moment for the ECB in any way to turn dovish? The message, given the fact that wage negotiations are happening right at the moment, presumably still needs to be relatively hawkish.
I think that's a justifiable position because we don't know exactly how these wage setting processes happen. And if the ECB is saying, "Oh, we can take," I can see a position. I think what's crucial this pay round is how much of it's like one-off pay support relative to
bonuses, etc.
Relative to things that last for the rest of eternity. That's what I think that we're going to be looking at over the coming 6 months. So far, we've seen a lot of those one-off bonuses.
Hey, Jimmy, what's your forecast for the terminal rate, and then how long the ECB stays there? Whether or not we get 50-75.
Right, guys. So those that have just joined us, welcome. A little bit on us. We bring out a brand new market update every single day of the week, as well as these live trading sessions. They do run. So at the 786 as well, so we can see prices at those levels. So essentially looking at a little bit more weakness, but things should start to turn around relatively soon. So we'll see how things play out. So the to your question, let's get Chainlink up. Let's see what's happening on this side of things.
Structure for their organization and empower their workforce to achieve key objectives. It improves efficiency, employee morale, and reduces quit rates. So, in the long run, technology is
Where's Binance? Let's get Binance one up. There might be already some TA on here. Just give us 2 seconds. Sorry, just need to amend something. Okay. Chainlink. Looking relatively good at the moment. Seeing a little bit of a rebound, which is nice. So let's zoom in a little bit. Let's see what's happening. Okay. So we've got a nice order block just beneath, as you can see here. We've already got it on the chart. We have found support at this level here, roughly. Okay, so this previous side quite nicely. So we are currently, by the looks of it, accumulating somewhat. So it could actually be the case that we do potentially continue in this accumulation range here. So, long-term outlook. If we get a trend-based fib here, from high to low to high again. Now, bearing in mind that this is the high, so this just indicating that there's serious accumulation happening. So, for instance, if we go over to Litecoin, I'll show you exactly what I'm talking about. Hence why we've gone for a long on Litecoin. So we sent out an update not too long ago, and we've kept it on here so we can show you exactly what we're on. This is institutional buy side activity. So apologies for how slow things have been, but the range has it's a much larger accumulation range. So from top to bottom here. But as you can see on this very last part, huge amount of this is institutional buy side activity, and look at what happened. We've got a huge explosion to the upside by institutional buy side activity back here. So this is ideally what you want to see on Link happen as it continues in the range. Now, if we don't see it, then yeah, we're going to topple over, push towards this range over here. $2 is probably the very, very bottom that you're looking at. Spike up, and then you start seeing that institutional buying activity again. That's if it doesn't stay in this range for a period of time with that institutional buy side activity happening in here. But yeah, anywhere between this whole level between 4.6 and rough 1.7. This is a huge liquidity zone down here, so it can come anywhere in between this region and kind of bounce up. But yeah, sub $5 is looking likely for Link. So yeah, that's what we've got here for you. What else have we got? Yeah. As you can see, we're kind of holding quite nicely. So hopefully, what we get, okay. The dollar pushes up to this order block here, potentially creates something like a double top, and then really starts to come back down, turn around. It's kind of being a little bit persistent here, potentially because of that test of that 200 moving average on the 4 hour on the daily, I think. So yeah, it's setting some levels. However, obviously we get job openings tomorrow, which is expected to come in much weaker. So if it comes anywhere in the region of 200k, then yeah, we can expect a rally in risk on assets, and for the dollar index to make a move back down. Now, in terms of where we're expecting the dollar index to land next is down towards the 618 to 786 fib level, and then create some more structure and potentially push back up. But but again, it does kind of depend on the results of the data that we get today. So yeah, we've got to keep an eye on it. If the US labor market comes in much weaker, that's bullish for crypto. Our kind of last standpoint is if we break that moving average on the dollar index, that really does switch up the narrative for dollar bullishness. So yeah, we're kind of tweeting around the very pivotal kind of point here. So we do need to bear that in mind and keep a close eye on the dollar and what's happening, especially what's happening over with China, because that could be a big catalyst. Now, if China does decide to open, that will be a catalyst for the dollar index to gain strength again. Just because of the strain that it's going to put on energy prices, on food prices, as China reopens. Now, there's a bit of skepticism around the whole reopening. The forecast is if they reopen, they're probably looking at around 2 million deaths. So I presume the government on that side are probably going to stamp down on heavier measures to kind of curb what's happening over there. But yeah, apart from that, there really isn't much else. We're going to keep these trades running. So yeah, we'll see what's happening on this side. Keep close on it. But yeah, it's looking like we're going to hold some levels and then really start to push up higher. Again, we are running off better than expected inflation data. So that's what the markets are going to hold until they get some of this US labor market data being released. And if we start seeing weakening signs of the US labor market, we can expect prices to kind of really start to push up higher again. We are still running a relatively low volume as well. So yeah, see how things got to play out here, guys. But yeah, the way that they're setting up for a nice push back up in prices. But again, this whole market is run very much on data. It's a data-driven market, so that's what we need to really gauge and kind of look at as we go forward. But yeah, if you guys got any other questions in terms of doing any of the TA for you, feel free to type it into the chat. We are coming offline at 5 o'clock as the Euro region closes. Yeah, we have obviously been on this stream for I think since 9 o'clock this morning, so 7.5 hours currently, so we'll be running for 8 hours today. So it's been a good day. I mean, we're still waiting for some decent profits to come in, but I mean the levels are getting tested, so and currently holding, as you can see. So soon will come a move, and the moves will start to come tomorrow. So bear that in mind as we move towards that data.
It's time for the Bloomberg Business Flash and look at some of the biggest business stories in the news right now. I'm Ritika Gupta. HSBC has agreed to sell its Canadian unit to Royal Bank of Canada. The price, $10 billion in cash. The deal will allow RBC to expand its roster of business clients and bulk up its retail presence on the West Coast. The transaction represents a rare domestic acquisition for one of Canada's big banks. The CEO of Airbus says supply problems will persist until the end of next year. At a conference in Brussels, Guillaume Faury revealed the full extent of the crisis that has gripped the plane maker suppliers, amongst them soaring inflation, raw materials shortages, a labour squeeze, and disruption to Chinese parts makers. There will be a few more empty
seats in the Goldman Sachs offices in London. Bloomberg's learned that Goldman is shipping some to Euroswap's trading desk to Milan. The firm will also be hiring staff locally. It's the latest example of banking roles moving to the continent after Brexit. And that is your latest business flash, Alex.
All right, thanks so much, Riddick. Let's get more on Goldman's move to Milan. I want to bring in Bloomberg's Tommaso Ebhardt, who joins us. Tommaso, is this like, is Milan going to become a big player now in the banking industry? Are we there yet?
I mean, big players is probably a strong word at the moment, but yes, we are seeing several bankers moving to Milan. Goldman is the last example, many of them coming from London. We have hedge funds setting Milan as their base. Somehow Milan is becoming one of the places to be. There's also some very important fiscal benefits for people to move to Milan, and so we are really seeing like a new era of Milan's financial district. Is clearly still smaller than London, Paris, and Frankfurt, but it's growing.
Tommaso, the Italians need to talk about football, but it must be tough watching everybody else playing in the World Cup right now. So we need to talk about Juve. Juventus front and centre at the moment. Gives us a great opportunity to talk about what's going on. What is going on? We're just seeing the Agnelli's resigning, the board is resigning. They're playing okay on the field at the moment, but financially it's not going quite so well.
I've got 3 minutes until the European close. So we should see some volatility coming in. Well, yeah, we should do. So let's see what it brings.
Then we go into Juventus. So what's happened at Juventus? Juventus is under investigation by the Turin prosecutors and also by the market watchdog for false communication. Which are the accusations? We saw the papers filed by prosecutors. So essentially, Juventus is accused to have inflated the value of its player during transfer, and also is accused of having made some miscalculation, I would say politely, during COVID when they decided not to pay some salaries. The investigation went further, and so we ended up last night for a shocking resignation by the entire board of directors of Juventus, including Chairman Andrea Agnelli, one of the members of the Agnelli family. What's the story behind it? The story behind is that Exor, the holding company of the Agnelli, is taking essentially control of Juventus. Who is running Exor is John Elkann. John Elkann is the leader and the heir of the Agnelli family. Essentially, the Agnelli family holding company decided that it was time to go and look what's going on at Juventus, and they have to do it starting from scratch with the new board of directors, including a new figure as chairman.
Great stuff. Tommaso, thank you very much indeed. This is...
With the pace of change today, you need to quickly mobilize teams around critical business initiatives. How quickly you can pivot and align teams is a competitive advantage. The old and inefficient ways of working are causing unnecessary friction, employee turnover, and frankly, costing companies millions in revenue. Leaders have a huge opportunity.
We are building some positive structure on the lower time frame. I'll show you. So we're looking good. Looking good. I think it's on 1 minute. So yeah, as you can see, building up some nice positive structure here. I mean, it is on the 1 minute, so we'll see how well it kind of holds. But yeah, this is exactly what you want to see here. Bam, bam, bam. Test of previous structure here, and then an explosion right back up. So yeah, we're looking good. We just need that dollar index to really start moving down, and then we should get a very nice push back up in prices here. As you can see, we are doing just that. Alright, we are in the European close now. Got 29 minutes, so 29 minutes to go. Let's see how things play out here.
Surface, there's some interesting things happening. London is outperforming a little bit. You've got the miners tracking a little bit higher. The banks continue to do well. I think actually the miners and the banks are doing relatively well for pretty much the same reason. That's China at a sort of headline level. We've also got the HSBC story. We'll talk about that in just a moment. DAX is now around 0.2%. CAC absolutely flat. IBEX absolutely flat. The Italian market absolutely flat. Nothing really to see at the headline level. This is how the session has developed. This is how we've worked our way through this Tuesday. Not any real major catalysts, I don't think, in terms of what we've been seeing of late. So the session has looked a little choppy. We've just been rolling over.
Yeah, let's go.
But at some point, hopefully, we might be able to. The real sort of story is below the surface. There you go. There's the choppiness. We're down by 0.1%, but it has just been a little fade below the close, into the close. So you can see. I don't think there's any real signal in terms of kind of left to right. We've basically just gone sideways. 437 is where we're trading right now. The GRR looks a little bit like this. The ranked returns from a sector point of view clearly show the impact of China. Basic resources up by 2.9%. The energy sector's up by 2.19%.
Here we go, my friends. Let's get it.
Looks like Standard Chartered had a good day today on the back of that China narrative. Cars also. Big China exposure there. Bottom end of the market, chemicals, real estate, media, telecoms, that's where the weakness has broadly been. But I think the China narrative is the kind of the clear message I think you can take away from today's session.
So after we get this European close, obviously we can look ahead towards the US close, or the New York close. Comes in about 7:30, 8:30 UK time. So we're to expect volatility at that time as well. So we'll see how things kind of leave off on this European close, and then we kind of get a little bit of time between then and the New York close to see how things kind of play out. Recently, the Asia sessions have provided a lot of movement. Okay, so do bear that in mind if you're holding positions overnight. It's important that you do note that down. The Asia sessions are causing volatility. Okay, so yeah, something to note.
Are we just seeing European banks outperforming because we're seeing a series of sort of idiosyncratic stories around individual names that are fairly positive? Or is there a broader reason why, over the last 3 months, European banks are the best performing sector in Europe, and critically, European banks are outperforming US banks?
Okay, you just took my intro, man. But yes, to that point, it feels like it's much more of the latter. I think the question then is, how much longer can that continue? So, guys' point, you take a look at Eurostoxx Banks Index. It's up for 8 straight weeks.
So dollar starting to find a bit of resistance.
That we saw back in October. You're looking at almost a 20% increase just in the last few weeks. So let's get more with Tom Metcalf, who joins us. Tom, first off, what is leading the rally in European banks?
Yeah, it's a really fascinating trend, as you say. It's been for years and years, the US banks have been the leaders, and I think it's actually probably, arguably, that there's been so many years that European banks have been laggards that they've basically got a bit more of catch-up, effectively. So when the world changes with these interest rates rising, you know, they haven't done such a good job as US banks in low interest rate worlds, but they have a bit of a almost larger margin they can catch up to quickly. So you've seen that kind of, as I say, sort of uplift over the last few months, but a lot of it is also based on sort of individual news as well.
In aggregate, though, they're outperforming US banks. Does that feel logical to you?
When you put it in context of, like, you know, the last 10 years or so, you know, there had to be some kind of outperformance at some point just to try and narrow that gap. And, you know, they're outperforming US banks, but they're still way valued far less. Yeah. So, I mean, I would just say, you know, as a proud European, I'm saying they've been hugely undervalued for a long while, and they're just trying to come back a little bit at least.
Do we need to see 75 basis points from the ECB for them to continue their rally, or 50 basis points?
I think something big is definitely priced in. You know, I think one of those two numbers is probably going to be any less than that. It would definitely be a nasty shock for shareholders.
There is an expectation to be going into recession next year. There is an expectation maybe we're already in a recession. Normally, the banking sector is a reflection, a beat to play on where the European economy is performing? Is it just that the valuation is so dinged through the pandemic, through the sort of the previous years?
Here we go, guys. Seeing some nice push up.
I mean, you're right. There is definitely a disconnect, and that's what I find most fascinating. When I'm watching these bank executives talk about it, they are extremely, gloomy about the wider economy. But as soon as they talk about their individual sort of books, they're like, "Oh, but we're not seeing any sign of distress among, our customers, our clients." So whether it might just be a time lag, their customers built up a lot of cash over the pandemic, so perhaps those defaults are, on a historical basis, a bit less extreme than perhaps bankers are looking like. But we are starting to see a few sort of signs of worry. We had the Lloyd CEO at a conference today talking about, how they're talking about helping people with mortgages, avoid default and stuff. So all eyes on Q4 is coming up. Will you start to see those pain points? And when they do, that might, really puncture this bubble, I suppose.
We also still have windfall tax happening in certain banks in certain countries. Do you think that that's already priced in at this point?
The Spanish banks in particular are sort of pushing back very hard against this move by Madrid. And, I think most people seem to think there'll be maybe a middle ground there. So there may be some kind of charges, but perhaps not as extreme as you're seeing, say, from Spain, etc.
In terms of where this could ultimately go, if we have a more healthy banking system, does that change Europe's ability to navigate the downturn? If we have a healthy banking system, are we going to see more consolidation? We've been waiting for a relatively healthy banking system in Europe for a very long time. It plays a huge role here in terms of the transmission mechanism from monetary policy through to the real economy as well. If we do get some strength here, when you talk to CEOs, how do we build on that?
Yeah, I think the consolidation answer is one, and there's always like that frisson of excitement, and then followed by sort of the inevitable, it's highly unlikely. But pretty much everyone would say that's what would really change the game in Europe. It's clearly over banks, just in terms of number of banks. So there's always speculation. It's hard to see it happening right now, and I think, it's more likely, rather than be some huge kind of cross-border type M&A situation, maybe more like piecemeal. So let's buy the asset management unit of, this firm, or look at, kind of very well-priced fintechs at the moment. But certainly I think as long as the banking industry doesn't sort of, go into a downward spin, then I think acquisition is going to be what you'll see.
Great stuff. Thank you very much indeed. Bloomberg's Tom Metcalf on why we're finally seeing the European banking sector performing. Let's talk about where European stocks have finished on the day. The banks, again, one of the strong performers in the narrative. But as we've come through the close, a little tick lower during the auction. The FTSE 100 finishing up by around 0.5%. Banks have been strong today. The miners have been strong. The DAX dipping into negative territory. The CAC 40 finishing absolutely flat. Alex and I are going to be talking what's happening with the central bank story, the inflation narrative coming out of Europe on the cable show at 5 p.m. London, 12 p.m. New York. We'll be on DAB digital radio. Andrew Bailey, the Governor of the Bank of England, continuing to give testimony down in Westminster to the Lords. Just talking about the fact that the gilt market remains broken and how tough it is, really, Alex, to deal with this labour market that remains very, very strong and tight.
Well, coming up, we're going to sort of wrap all this in a nice, neat bow for you. We're going to be joined by a Wall Street veteran and get his strongest call for 2023. Leon Calveria, Citi Institutional Clients Group Chairman, joins us next. This is Bloomberg.
See a nice push up in prices here.
Increases. Consumer prices in Germany, Europe's 11.3% in November. That is down from October's 11.6% jump. European Union talks on a price cap on Russian oil exports remain stuck. A cap of as low as $62 a barrel by Russian attacks.
Yeah. Thank you for joining us. Hopefully you got nicely positioned and you kind of got a little bit of enjoyed the live stream just in general. Like I said, we will start doing these more often. So join us tomorrow. Yeah, the way things are looking, just gonna set out some more levels, and then potentially break up higher. Tomorrow is going to be a big day as we get that US job data. So keep in touch, join us on the live stream. Don't forget to hit that follow, very much appreciated. And also don't forget to go and check out our profile. We've got a whole load of useful stuff on there, as well as obviously bringing out that market update every single day of the week. Don't forget that. So yeah, thank you for joining us. We'll catch you all tomorrow, and enjoy the rest of your trading day. Don't forget New York Open, New York close is still yet to come, and that the Asia session or the Asia sessions lately have been showing. Right now, how do I stop?